Okay, so good morning, everybody. Hopefully you can hear me and got our little technical issues hopefully resolved. My name is Emil Gomez. I am a longtime member of Community Tax Aid. I first started as a volunteer. I became an assistant manager. I became a manager. I became a board member, and now today, my role here is one of the instructors of our training class. We have an annual training class every year given to all our volunteers, and I thank you so much for sharing your Saturday with us. We have this Zoom meeting, and you should see in front of you. The outline, the federal outline of today's class. So if anybody does not see this outline, please indicate in the chat uh, whether or not you don't, and we'll try to get that issue resolved. So I'm on the very first slide. It says, welcome to the volunteer training for 2024. All of the forms and outlines are in those various folders you see there, the outlines where this outline can be found, and the New York State outline that we're going to look at this afternoon. Another form with CTA forms, including our checklist, quick reference guide in terms of helping you answer certain questions very quickly regarding tax issues, and other folders that have federal forms and New York State forms. We are going to refer to the materials in these folders throughout the day. At the end of the day, I will go thoroughly in terms of reviewing our forms in the CTA's forms folder. We want to make sure we get to the meat of the course today, this morning, that is, and this afternoon. And towards the end of the day, I will review the forms in our CTA folder. Okay. What's our day going to look like? Let's see, how are we doing this? Where are we? Okay. It's called the disclaimer. Do you guys see that? Tom, is that there?
Yes.
Okay, great. So I'm doing well, I guess. Okay. You need to know that this course of ours that we developed here at CTA is supposed to answer any questions, is developed really to answer any points regarding preparing taxes for the low-income individual. Now, if anybody has experience preparing a return or has taken a tax course, and knows about the IRS code and all the tax literature that's out there, it is big, it is voluminous. We have tried through our training materials to really take a certain section of the tax code, of certain tax forms, and really develop this course that's going to help you prepare returns for the low-income individuals. This disclaimer form saying we've done our best to do that. There's certain things that might come out even after today's presentation that it might affect what's being said today. And again, some of this material, as you can see there, has is only germane to the low-income individual. And there might be some changes even after, once again, today's course. What about today's course? What is the structure of today's course? We're on slide number 2. All the slides are numbered on the lower right-hand side. What's the agenda today? Oh, we're going to give you an introduction to CTA because there's a lot of people watching this class today who might not know about CTA, who heard about us through their friends or returning volunteers. If you are returning volunteers, welcome back. So happy to see you virtually right now. We're going to talk about what CTA is all about. Then we're really in section 2 going to talk about the meat of this course. You see the certain topics we're going to talk about, and we see slide references. So after today, if you wanted to review certain slides regarding certain topics, those are the slide references we have for you. And then part 3 of the course is the review of the CTA materials I talked about, and maybe give you an idea of what's to come in terms of our training course. Welcome to CTA. For those of you who are new, or for those of you who have heard this before, I think it's just as important just to review what we're about. CTA, Community Tax Aid, is the nation's oldest tax preparation service. As you can see there, it was started in 1969, and it is our 55th year. we can say with confidence that we are the oldest volunteer group of our kind in the nation. My understanding is 6 months after CTA came into existence, the IRS heard about this group and more or less launched the VITA program. Some people might have heard of the VITA program, and my understanding is that's how VITA got started. And over the years, other volunteer groups have taken the mantle and have helped people prepare their tax returns. So this is not really to disparage other groups. We're all here to help people, the low-income people in particular, prepare their returns. But it's good to know that we were the first and we set the standard, and that's a good feeling. We're all unpaid. We're a not-for-profit group. We don't charge a fee for what we do. Everybody here, myself, some of the other people you're going to be listening to today, all of our volunteers, we don't get paid for what we do, and the people we help, we do not charge a fee for what we do. So it is a volunteerism in the true sense of the word. We have a board of directors. I'm a member of the board. Some of the people, other people you're going to meet today are members as well. And our board runs throughout the year. Hopefully you've liked CTA and you like what we're about, you like our mission, and perhaps you can join our board and contribute that way. We're not part of the IRS. We are separate and distinct from them. And we're not aligned with any government agency. So what do? We prepare tax returns for low-income individuals. Those are our income limits. The lower number, the $35,000 number you see, is the limit for single individuals, married individuals. That is our income limit as well. We're an all-year organization, so even if somebody were to be audited or get a letter even after the tax season, we'll do our best to reach out to them, and they'll reach out to us even after April 15th, and we will help them. We consider ourselves professionals. Everybody here listening to this chat, I consider you guys to be professionals. And what I mean is, I respect your opinion, hopefully as much as you respect ours. I've been doing this a very long time, and perhaps with the new people who are listening, and once we get to know each other and do some work in some of our storefronts, maybe you will see something that can help us better what we do. So make sure you reach out to us and tell us what you think about what we're doing, and we can always change. We're always evolving. So I consider you guys professionals, just as hopefully you consider us professionals. Okay. Where do we operate? We have what's called the storefront presence. We have space that's donated by various not-for-profit agencies, but we also do things virtually. Really started during the COVID years, and even after COVID has more or less subsided to a certain extent, we have this virtual presence where we can prepare returns virtually. In other words, the person whose return you're preparing, you need not to see them face to face. Okay. Again, our return season more or less is going to start mid-February through April 15th. And like I said, we are also available throughout the year. Let us do this. What are we? Let's see. Here we go. Okay. Slide 4. We have a code of ethics here at CTA, which means that we're committed to doing a professional job. We try to prepare a return in a complete and accurate manner, which means that if you don't have enough information to prepare a return, you just can't go ahead and use whatever you have to complete it. If there's some documents that are missing, some questions that have not been answered, and that the taxpayer has to come back, say, the next week to complete the return, then so be it. We're all volunteers. We don't, once again, accept any compensation for what we do. I will say this, that on certain occasions, some of our returning taxpayers say, we do such a great job, and here's some cookies that I brought for you so you can keep going. So of course, that's de minimis in nature, and that is acceptable. No shortcuts are, again, taken in preparing return. A lot of taxpayers say, get me the best refund I can get possible. But if the numbers are such that it leads to a refund that's not acceptable by the taxpayer, or even the reverse, even if somebody is owed money, so be it. And that person has accepted. If they don't, then we won't complete and process that return. Okay. You're never alone in terms of CTA. There's always other taxpayer, excuse me, other volunteers who can help you out, managers who review your work. So in other words, you're not alone. We check all of your work. We reach out to you and let you know what's going on, and that's how the learning curve for yourself goes in terms of learning what we do throughout the tax season. Let's look if we can now a form you're going to see a lot this year, and hopefully that can be shared by one of our managers here and it'd be one of the presenters. Tomer, if you can call up the 2024 tax return, we're just going to look at that. So the final product of preparing a tax return is this federal form that's called 1040, and maybe some people who have prepared their own returns for themselves or others know about it. Tomer, can we share that form? Can you do that?
Yeah, hold on.
Okay. And if you like, ladies and gentlemen, if you want to follow what I'm about to say, this 1040 form is in your federal forms folder. So if you can open that folder and call up the 1040 form, you can do it that way just as well as what we're trying to do now. Okay. So how's that coming, Tomer?
You don't see the shared screen or
Let's see. Let's try it here. I don't see it, but again, that doesn't mean it's not being shared. But anyway, we'll keep going forward. Parts of the 1040 form. Let's see. Okay, so towards the top of the form, it asks about certain information about a taxpayer. Yeah, I see it there and there. And hopefully, let's do this. I can share from my screen, and hopefully you guys see it now. Yeah, so I've shared it through my screen here. So again, the final product of what you're doing today is this form, this federal tax form, 1040. And towards the top there, you'll see certain information you're going to get from the taxpayer: name, social security number, address, et cetera, et cetera. Towards the middle there, we talk about filing status. We will talk about filing status in this morning's lecture. Everybody, for tax purposes, has a certain tax designation, and you'll see the various filing statuses there. It's a question on digital assets. As you can see, more and more of our economy is based on the payment of digital assets, being Bitcoins or things like that. The IRS, the government, is still formulating regulations in terms of how Bitcoin transactions, how digital asset transactions should be generated, and how it's affects somebody's tax return. They're getting close to having, our understanding is having a certain way of doing things. But when those things are finalized, then we will embrace people who deal with things in digital assets. It is the policy of community tax aid. If somebody deals with digital assets, we will not prepare their return, because again, our understanding is this topic is so volatile that we want to make sure we're on firm ground in terms of preparing returns of taxpayers who have digital assets. We do have to ask the question, though, as you can see there, does that person deal at any time with digital assets? Standard deduction. After you get an idea of somebody's income amounts, you can offset or lower the income subject to tax by finding out whether or not the person qualifies for a standard deduction amount. We will talk about that this afternoon after lunch. Dependents. Someone other than a taxpayer can be used by a taxpayer. And I'm going to talk about that right after this opening lecture. And having dependents helps somebody in terms of lowering their tax bill and even generating some income through tax credits that can benefit them. The bulk of page 1 of the tax form, the 1040 form, as you see here, talks about income items. One of our presenters, Tomer, will talk about incomes, be it taxable or non-taxable, and we need to know that. Towards the bottom of page 1 is we have an idea of what the income is, and then there's certain, again, offsets to lower the income subject to tax. We talked about the standard deduction, which is line 12. We talk about some other adjustments to income. We'll talk about that this after, excuse me, towards the end of this morning. We'll talk about the qualified business deduction, and that's based on someone who is self-employed. And Toma will talk about that during the income presentation and also the adjustments to income presentation, which is going to be towards the end of this morning. Then we have more or less an idea of what taxable income is. This is the number that is subject to tax. That's line 15. Our computer program, TaxSlayer, will calculate the tax. And then we talk about credits that lower that tax number and might generate a refund, be it through what's called withholdings. You'll see the payments here. It starts on line 25. And more or less, you will see income tax withheld numbers from what's called the W-2 form. And maybe you guys know about the W-2 form. Tomer will talk about that a little bit later. A major credit that could generate a large tax refund for our taxpayers is what's called the earned income credit. That's line 27. And another presenter, Shelley, will talk about that this afternoon. Okay. So then after all of these calculations are made, and again, that's going to be done through our TaxSlayer program, we find out what the bottom line is. So let us get out of this and let's do that. And let's go back here. Does everybody see our outline again? So we're on slide 5. Tomer, do you guys see that? Do you see that, Tomer?
Slide 5.
Yeah, we're back to the outline now. Does everybody see that?
I don't see it on screen.
Okay, let's see if we can do it this way. And let's go back to this and this and this. Okay, so I guess now we're back to sharing. Is that right?
Yep. Yeah,
Okay,
I
great.
can see it.
Okay, so what I talked about in terms of the formatting of the 1040 and the bottom line can be represented this way, the math behind the return, okay? So if you want to refer to the 1040 while I'm going to this slide here, number 6, by the way, you can do that. So we've calculated what's called adjusted gross income, which is, again, income subject to tax less adjustments to income. The adjustments, again, reduce income subject to tax to that AGI number. There's also some deductions called the standard deduction, which we'll talk about this afternoon, and what's called the qualified business income deduction. And again, the standard deduction varies based on the filing status. We'll talk about filing status this morning. Once we have a taxable income amount, we have a tax. That again, what that is calculated through TaxSlayer. And then, let's try to go here. Okay. And then we're at this point of our little presentation, slide 7. We've calculated the total tax, and we offset it by the taxes that are withheld during the year, or even what's called estimated tax payments. Some taxpayers might do that. So we're in the middle column there in more or less yellow or tan. We have some non-refundable credits, and we have some refundable credits. So the interaction in this slide here says, if the total tax, the blue amount on the left-hand side, is greater than the amounts in the middle, the taxes paid during the year through withholdings, or the non-refundable credits, or even some refundable credits. If that number is greater than what's in the middle, the taxpayer might have to make a payment. This is the amount due. And you might see that little smiley face there, which is not really much of a smiley face. The opposite could be true, that the amounts in the middle, all the taxes paid, all the non-refundable credits, the refundable credits, is more than the total tax, or in this case, the tax is less than the amounts in the middle. The taxpayer will get a refund, and you may see that smiley face. Okay. Slide 9 is the tax preparation process, and just go through it very quickly. The taxpayer gives us all of this required. And again, what I'm about to say now is more or less true of people who see us on a face-to-face basis, who sees us through our storefronts. Next week, to give you an idea of what's ahead in terms of training, next week we're going to have a demonstration of our computer process, entering information into the computer. You'll have hands-on experience, more or less through this demonstration next week about how our TaxSlayer program is used. and get an idea of how these things are generated. We'll also have an explanation of what's called the virtual preparation process for people who might want to help us and do volunteer work in our virtual team. What I'm about to talk about now is more or less what we do at the storefronts, face-to-face basis. Taxpayer comes to us with all this information. We have, if that person was with us last year, get a copy of last year's return. And if not, the person might have brought a copy of his return that might have been prepared elsewhere. If that person doesn't have it, that doesn't mean we can't prepare his return, just that we have to ask some more questions and really rely on what the person has brought with him in terms of the tax documents. Okay, we interview the taxpayer and we use our checklist for that. If you want to look at a checklist, it is in our checklist folder. But like I said to you previously, we're going to give you a detailed review of all of the forms in that CTA forms folder a little bit later today. We want to make sure we really talk about the tax rules, and we're going to concentrate on that after this part of the presentation. Okay. During the interview with the taxpayer, you're going to enter information on the checklist about the person's filing status, qualifying children, things like that you see on step 4. You're making the determinations based on results of what the person is telling you about himself or herself and your training that we're giving you today. You are deciding the person's filing status. You're deciding the qualifying children that the taxpayer may use on the return itself. Okay. You take the information and you enter it into the TaxSlayer program. We are now on slide 10. The TaxSlayer program calculates this. You notify the manager that you've finished the work and it can be reviewed. Again, all review work that's done on a storefront and even virtually is reviewed by another set of eyes, in this case, the manager. After the manager approves it, he'll print out a return and we e-file the return, meaning electronically file it. It speeds up the processing of the return, speeds up the processing, say if the person gets a refund. And then if the person, if this is done at the storefront, 2 copies, one for our records, one for the taxpayer's records, and they sign off on certain authorization forms for us. And that's listed on step 14 here, slide 11. So if there's any authorizations, again, permissions that allow us to process the return for him, we will do that. Sometimes we cannot electronically process a return, and certain exceptions to that rule, which we'll talk about later, and we might have to mail it. So if it's mailed, we'll get a separate federal return. That's step 10. You'll see on slide 11, separate state return. We put it on separate envelopes because federal and state returns go to different locations. We have a cover sheet, which again, you will see in the CTA's forms folder. And like I said, we review what the cover sheet is. It more or less summarizes what the bottom line is for the taxpayer. Everybody gets that for every return we do. Okay. We keep a copy of everything we do. All right. Slide 12 now is our training schedule. So as you can see, this is the first of our 3 sessions we're having devoted to training, and it is this one. We're doing our training now. We're here from 9 to 5. We're on Zoom. 2 or 3 days after this class, we will have a recording of this class posted on YouTube. So if you want to review what's been said today, you can go on YouTube and review it. And if you want, you can go to YouTube sometime in your downtime, and you can look at past recordings of past trainings. Okay. Next week, we talked about our computer class, and we'll also talk about the virtual tax return process that is on Zoom, as you can see, next Saturday, February 1st, from 9 to 12. Today's class and next week's computer class is mandatory. Everybody has to attend those classes. The 3rd class we have there, the volunteer forum, is not mandatory. It is up to you. And what is a volunteer forum? Well, we essentially turn the tables on ourselves. You become in charge of this volunteer forum. You ask questions about the computer class that you had the previous day, or the training that we're giving you today, and you might have questions on it. So it is your turn to ask us questions about what you've seen, about the computer class, about our training schedule. Okay, so once again, it is not mandatory, but we have it available to volunteers who would like to ask some questions about ourselves and what we do. And once again, that's next Sunday, excuse me, a week from tomorrow, February 2nd, from 2 to 4, I believe. We'll confirm those times, because based on the availability of Zoom and some of our participants, that time might change. We'll look into that during the day to make sure that I've given you the right time on that. That's on slide 12. Slide 13. Everybody here who's listening to this this presentation, you can get a volunteer certificate. It gives you the number of hours you've contributed to us. We have timesheets at the storefronts. We have electronic timesheets for somebody who does virtual tax work. And we will give a volunteer certificate to everybody who requests it at the end of the tax season. And more or less those certificates will be distributed sometime around June. Okay, so everyone's entitled to that. If you happen to be a CPA, we give what's called CPE certificates, because our training qualifies us to give CPEs certificates to, in particular, New York State certified public accountants. You might be a CPA in another state other than New York. Whether or not our CPE tax training qualifies you for CPA credits in your state, that is up to you to find out. But we will give you a CPE certificate if you happen to be a CPA and you request one. And the policy on all of these certificates is we will give you a certificate based on at least 8 hours put in the field, be it through virtual tax work or work at the storefronts. Okay. Speaking of storefronts, we have at least 2 storefronts where we do face-to-face work. We have about 4 storefronts, but these 2 in particular that you see on slide 13, we really do need volunteers for. The other 2 storefronts do have their volunteers, but these 2 in particular we do need. And that is one here in Manhattan at Fountain House, and that's the address, Fountain House. And Fountain House will be open on 10 consecutive Sundays, starting February 9th. And that Fountain House is open from 1 to 5. So if I believe in your volunteer application, or a little bit later after this class or at the end of this class, please indicate to us whether or not you'd like to be part of the Fountain House staff. I will say, that I am one of the managers here at Fountain House, so you can work with me if you like. We have other managers who work at Brooklyn, and that place is called Impact Brooklyn, and that is the address there. And they'll be open on Saturdays for about, looks like 7, 8, 9 Saturdays starting February 15th from 10 to 1. And I believe the manager there is hopefully on this recording as well. And she can tell you a little bit about that as well. All right. Slide 14. Again, when it comes to virtual tax preparation, we do that as well. Again, it started during the COVID years, and it's proven so successful that we kept it going. So people can do the work virtually by sending their information those 3 ways: through our post office box. They can send us PDFs, or they can fill out our intake form, which I believe is still on our website. I just have to double check that. But in other words, they can send us PDF forms of their tax information that way. And then we will send information. We will start the process in terms of reaching out to them that way. Some people are raising their hands, and hopefully we have some of our seasoned CTA volunteers to answer their questions. If not, during breaks in our day, we will try to answer your questions. And a little bit later on, I'll monitor the chat and try to answer your questions this way. I see somebody named Lance who just raised his hand. Okay. Has anybody been a Boy Scout? I am co-opting their motto: be prepared. Well, just like the Boy Scouts, we want to be prepared. and how do we be prepared? Well, we'll talk next week about the tax layer program and access to that. So make sure you download the tax layer program. Make sure you have all of the documents that are in the various folders today. We'll give you other documents as the tax season progresses. And for everybody here on the chat, the old volunteers, hopefully you still have your CTA email. For the new volunteers, you're going to be given a CTA email. That is very important in terms of communicating with us. We'll communicate with you guys through your CTA email. You need to access the tax layer program through your CTA email. And that's very important in terms of issues of security and issues, of course, of identity theft. We want to make sure that all communications amongst us is through this CTA email. Okay. And again, for people on the chat, hopefully some people are monitoring that. And if not, I will answer your questions a little bit later, like I said before. Okay. So I thank you for listening to this introduction on CTA. And now we're really going to get into the meat of the course, and we're going to start on slide 16. And we're going to talk about the issue of qualifying children, QCs, and qualifying relatives, QR. So what do I mean by this? Well, if you remember the tax form, the 1040 form, we talked about a section that talks about dependents. In other words, could a taxpayer claim someone other than himself as what's called a dependent? And the dependent, we'll talk about the rules about someone qualifying as a dependent and what are the benefits of having a dependent on the return in terms of tax-wise, how it helps somebody tax in terms of their taxes. Okay, this part of the course is structured this way. We're going to talk about dependents themselves, and we're going to talk about the tests that have to be met for a qualifying child, a qualifying relative. And then we branch out, we're talking about the tests specifically for a qualifying relative or qualifying child. And then we bring it back, towards the end of this part of the lecture, and we talk about the benefits of having these types of dependents. Okay, so with that in mind, let us now go to slide 17. And again, if you wanted to follow along about what I'm saying, as you can see on slide 17, you can go to the checklist folder and look at the checklist itself, page 3, worksheet A of the checklist. And again, we really haven't shown this yet. Again, we will review this towards the end of the day. I just want to make sure we get the tax rules to you guys, and then we'll talk about how to record this on our forms. All right. Anyway, qualifying children, QCs, and qualifying relatives, QRs. There are certain tests that have to be met for these types of individuals. Okay, and they're listed there. These 4 tests that we're going to talk about. And the first one talks about what's called the dependent taxpayer test. So we're talking about the taxpayer, myself. Say if I wanted to claim someone as a dependent, which I think will help me on my return, I myself, the taxpayer, I cannot be qualify as a qualifying child or qualifying relative or anyone else. So if I wanted to claim that somebody as a dependent, I myself, the taxpayer, cannot be a dependent of anyone else. Okay. Second test is what's called the joint return test. So a joint return is for married individuals. They file jointly. So on a joint return, neither spouse may qualify as a QC or QR dependent on another taxpayer's return. However, there is an exception. And that's true of a lot of tax rules. We will give you the general rule, but there's always exceptions to the rule. And what this means, and again, it'll be devoted, we'll talk about again on the next 2 slides, is you can claim somebody who happens to be married and is filing a return with their spouse. We can do that based on this exception to the rule, which we'll talk about in a minute. That's more or less what test number 2 means. Okay. Number 3, the person you're claiming. Now, we're not talking about myself, the taxpayer. We're talking about the person you want to claim, the person that I want to claim as a dependent on my return. That person cannot be a qualifying child or qualifying relative of another taxpayer. That makes sense, right? We don't want double dipping. You cannot use the same person on more than one return. Makes sense. Number 4 is what's called the citizenship and residency test. And again, that'll be explained on the next 2 slides. And let us go to the next slide, and that is slide number 18. And now we're talking about the tests that are germane, that are really for qualifying children, QCs, okay? And as you can see, there are 1, 2, 3, 4, 5, 6, more or less 6 tests we're going to talk about. And the first one is what's called or the age test. And this age test is one long sentence that has 3 particular parts. So I'm going to read the sentence and then we're going to break down that sentence. So the age test for somebody you want to claim, that a taxpayer wants to claim as a qualifying child, is this. Part 1. The age test says that that person has to be under 19 years old and younger than the taxpayer or spouse, TP or SP, taxpayer or the spouse. Okay. Step 2 is, or that person you want to claim as a qualifying child is under 24 and a full-time student for any part of 5 months and younger than the taxpayer's spouse. And part 3 of this sentence, the qualifying child may be permanently and totally disabled at any time during the year, regardless of age. So when it comes to the age test, for in terms of somebody qualifying a taxpayer to take that person as a qualifying child, the age test is really in 3 parts, as you can see there. Under 19 or under 24 and a full-time student for at least any 5 months of the calendar year, or the person can be of any age but has to be permanently and totally disabled. Permanently and totally disabled means that that person cannot support himself, cannot function, and more or less cannot have a job to take care of himself financially. Next, H. H is the home test, and it says here the qualifying child had to live in the taxpayer's home for more than half the year. That's more or less straightforward, and that's more or less easy to identify with. Okay, next, C, citizenship and residency test. It says here this qualifying child has to be a U.S. citizen, a U.S. resident, or a resident of the U.S., Canada, or Mexico. So that's what that means. And it says here with an exception, and of course we're going to see that word a lot, exception to the general rule, an exception for certain adopted children. And what that exception means is if you had an adopted child who lived with you and happens to be a resident of another country, that adopted child had to have lived with you for the whole year. So they have an adopted child. So in terms of citizenship and residency, the person was an adopted child from another country. That person had to have been adopted by the taxpayer and lived with you for the whole year. Okay. Joint return test, the J part. If the qualifying child now is married, he or she cannot file a joint return except for a refund unless neither the qualifying child nor the spouse would have a tax liability if they file separate returns. What does that mean in English? What it means is if you want to claim somebody as a qualifying child, and by the way, that person happens to be married, and if that married person is filing a return with their spouse, and the only reason that they're filing a return is to get withheld taxes from their pay, but they're not even required to file a return. Say they had a small job during the summer and they received a W-2 form and there's withholdings reported on this W-2 form. And the only reason they're filing a return is to get back that withholdings because they're not required to file a return, but yet they got these withholdings, which they're entitled to. So if that's the reason that this married couple is filing a return to get those withholdings back, that does not disqualify you, the taxpayer, from claiming these individuals as a qualifying child on your tax return. That's what the joint return test means. Okay. So when we talk about withholdings on a W-2 form, things like that, we really haven't talked about that concept, but it will be discussed a little bit later when we talk about income items. So try to keep that in your mind when we talk about that in the income portion of our lecture today. Okay, R is what's called the relationship test. And let me see if I can share another document with you So hold on one part, guys. If you want to follow along with what I'm trying to do, go to our, let's see if I can do this. Oh, it's gonna be tough. Let's see. Go to our CTA forms folder, and within the CTA forms folder, look at what's called the relationship tests, the QRs and QCs. And let me see if I can share that document with you now. Let us do this, and let's try to share it. And guess what? I'm getting good at this. So hopefully you guys see this little Word document that is in your folder on CTA forms. And this is the relationship test. And if you can see on this Word document, the first half of this document, it says here, the dependency exemption requirements, the relationship test for a qualifying child. So in other words, if this person you want to claim as a qualifying child has this relationship to the taxpayer, then they've met the relationship test. So hopefully you guys can see that. I'm pretty sure that you can. Talks about the taxpayer's son or daughter, stepchild, eligible foster child. We talked about somebody being an adopted child, and a foster child, again, had to be in place in an agency in the taxpayer's home of residence. That's what we mean by an eligible foster child. A brother, sister, half brother, half sister, step brother, step sister, or a descendant of any of those individuals, be it a grandchild, a niece, or nephew. So again, for the relationship test, that's what we mean for a qualifying child. So let's stop sharing this, and let's go back to share this, and do this and this, and we're back hopefully at the outline of ours. And I think we're there, and hopefully you guys can see it. So that's what more or less the tests are of a qualifying child. The previous slide, they have to meet those tests, all of those tests, plus these additional tests that you see on slide 18 for a qualifying child. Next, talk about a qualifying relative test. And that is on slide 19. Let's get to slide 19. And there we are on slide 19. Okay. So as you can see, we have 1, 2, 3, 4, 5, 6 tests that have to be made for a qualifying relative. Some of the tests that we talked about for a qualifying child also have to be met for a qualifying relative. For example, C, the citizenship and residency test. Well, guess what? I'm not going to go through that sentence. We just talked about it. It is the same test that you see for a qualifying child, has to be met for a qualifying relative. We have a new test here that's called G, also known as the gross income test. So now you as a taxpayer want to take someone as a qualifying relative. That person, that individual had to have less than, it says here, $5,050 of gross income. And by gross income, we mean income subject to tax. So in other words, the person you're trying to claim as a qualifying relative in terms of the gross income test had to have less than that amount of income subject to tax. Okay. The joint return test, the J part, well, guess what? That is a repetition of what we saw. So I'm not going to repeat myself. It is the same test when we come to the joint return test. The R test is the member of the household of relationship test. That is the same test, but the definition of the relationship is a little bit different. So let's go back to that same Word document that I brought up before. Let's see if I can call that up again. And guess what? I think I have, and hopefully you see it there. So now when we talked about the relationship test for a qualifying child, for a qualifying relative, it's more or less what we've seen before, plus many other relatives. So if you look at towards the bottom of that same document, and hopefully you see it up here, it is the same relations that we saw on the top, but it includes these other relations to the taxpayer. It's now been expanded to include the taxpayer's father, mother, grandparent, other direct ancestor, stepfather, stepmother, uncle, aunt, etc. So look what it says here in terms of a qualifying relative. To be a qualifying relative, any of the relationships listed above need not live with the taxpayer. So if you saw the test for the qualifying child, we said in terms of a member of the household, the person had to live with the taxpayer at least half of the year. For these individuals, they do not. You do not have to live with the taxpayer. Big difference. Okay. In addition, when it comes to qualifying relatives, towards the bottom of that Word document, it says to be a qualifying relative, QR, the following relations must live with the taxpayer for the whole year. And that is a cousin and it is a girlfriend. Okay. And so that's what that is. So again, the relationship test for terms of qualifying relative is expanded to include all of those other individuals. All right. So let's stop sharing that. Let's go here. Whoops. And let's go here. And we're back at the outline. All right. A new test we have to think about is what's called support. And let me just make sure I talked about support here. Just want to make sure. Yeah, I'm sorry. So let's backtrack a second. I'm so sorry. Slide 18, we did not talk about the support test for terms of a qualifying child. What does it say here in terms of support? For a qualifying child, it says here, child cannot have provided more than half of his or her own support. So what that means is you, the taxpayer, want to take somebody as a qualifying child. That person, in terms of support, this test here, could not have provided more than one half of his own support. How could it be provided support? Well, maybe the person is receiving Social Security and SSD benefits, and it's received directly by the child, and it's in the child's name and is used for the child's support. So if that's the case, you need to determine whether or not that amount is in total one half of that person's total support. So you might have to do a number crunching exercise. And when it comes to support, for terms of test of the qualifying child, the person might have had a small part-time job, may have worked during the year, and may have earned a certain amount of income. If that person used that amount and used the Social Security for his support, you have to determine whether or not the total support of that person is at least 50% as provided by that person. That's what we mean by the support test for terms of the qualifying child. And I apologize for not getting into this point sooner, but it's important to talk about support because now we're talking about support for tests of a qualifying relative. And that test, the support test, is extremely different than it is for a qualifying child. I'm going to read this sentence to you. It says here, for the support test, for tests of a qualifying relative, the taxpayer must have provided more than one half of the person's support. Now, the taxpayer has to prove that he provided more than one half of the support. The previous test said, did the qualifying child provide more than one half of his own support? The taxpayer doesn't have to prove he or she provided more than one half. In this case, the taxpayer has to prove that he provided more than one half of that person's support. Okay. Once again, Social Security, also known as SSD, in the name of the person, in the name of the person you want to claim as a qualifying relative, is considered support provided that person. Okay. SSI, Social Security, supplemental payments, and public assistance is also considered provided by the government and not necessarily provided by you, the taxpayer. If it's used for this qualifying relative support, then it's considered support provided by other people, and that can affects the calculation of total support. Okay. What is it? It says here, once again, Social Security and SSD coming in the name of the taxpayer, the support provided by the taxpayer. And as you can see, the support test is entirely different than the support test for qualifying child. It might mean in some instances when it's really close number-wise that you have to do a number crunching exercise, get all the elements of support, be it food that is used to support a person, be it shelter used for that person's support, clothing, all the elements of support. And you might have to do a number crunching exercise. What is the total support? What amount is needed to support that person for the whole year? Of course, it varies based on the lifestyle of the taxpayer, where the person lives, things like that. You'd have to do a number crunching exercise. What is the total support that is needed to support this individual? How much have you, the taxpayer, provided? How much has the qualifying relative or third parties provided? So whatever the numbers show as a result of this number crunching exercise, that is what we mean by this support test. Okay. And then the last part is not a qualifying child test. So if you want to take an individual as a qualifying relative, that person cannot be a qualifying child of someone else. But in other words, no double dipping. That same individual cannot be a qualifying child of one taxpayer and a qualifying child of another taxpayer. Okay. And as you can see, and this is true of qualifying children and qualifying relatives, the person that you want to claim as a dependent must have a Social Security number by the due date of the return, SSN, Social Security number. Okay, so hopefully I've been fair and complete about all of these things. So there's a distinction about dependents and types of dependents. So the question is, why do we need to know this? What are the benefits of having a qualifying child or qualifying relative? Okay, well, they're tax benefits, and they're summarized here on slide 20. Now, once upon a time, before the 2017 Act, people who are dependents of a taxpayer, the taxpayer had certain dollar amounts that lowered his income subject to tax as a result of the, the job tax act and passed in 2017. There's no dollar benefit of having a dependent, but there are other tax benefits that you see right here. Okay, so it pays to have the taxpayer claim somebody as a QC or QR for these reasons. It can qualify the taxpayer for the head of household filing status, number one. Again, you need to qualify a qualifying relative, qualifying child, but again, there's an exception. And when we get to those various topics in today's lecture, you'll see the differences. Okay, certain tests have to be met, certain tests do not have to be met. When we talk about credits this afternoon, you can have what's called a credit for child and independent care expenses. You need a qualifying child, a qualifying relative, once again, an exception. No, and when we talk about exceptions, we mean exceptions to the general rules that I've given you in the previous slides, okay? Number three, the child tax credit or additional tax credit. Again, we'll talk about that in the credits section this afternoon. Again, it lowers income subject to tax, or it lowers the tax that's due. You have to have, in this case, a qualifying child, but again, with an exception to those general tests we talked about. A credit for other dependents. Again, QC and QR, an exception. And again, the earned income credit. Number five, the most important of all the tax credits we're going to be talking about today. It really makes a big difference in a taxpayer's bottom line. And again, Shelley will talk to you about that. The taxpayer must have had a qualifying child, but again, an exception to the general rules we talked about. Okay. But again, we have a couple of things in bold towards the bottom, the tiebreaker rules and what's called multiple support agreements. So let me try to get you what I'm talking about in terms of what's called the tiebreaker rules. So let me go here, and we have that, and we're going here. Whoops, go here, and let's share this. And here we go. This form, this Word document is in your CTA forms folder, and I have it here in front of you, and it's called the tiebreaker rules. And this is for tests of determining a qualifying child, really important. And I'm not going to go through this fully. It's there for you. You can read it now if you like, or a little bit later, or just review it after today's lecture. And what the tiebreakers rules is saying that, well, based on some of the rules I've talked about up to this point, when it comes to qualifying child, believe it or not, more than one taxpayer may determine that I can claim this qualifying child because I've met all the rules that Emil talked about in those other slides. Well, what if more than one taxpayer does meet those tests? It is possible, it is feasible. How do you determine whether or not one taxpayer can claim somebody as a QC and get all those great tax benefits we alluded to? Why one person or another? And if you look at the taxbreaker rules, you'll see why. How do you determine whether or not one person can take it as opposed to another? And it just talks about whether one parent can take it or one parent cannot. It talks about whether or not the person lives with the taxpayer, things like that. Just read this and you'll have an idea of what the taxpayer rules are. Taxbreaker rules are. Okay, so I'm going to get out of that. And I'm going to go back here, and I'm going to go back to our outline, and we talk about next of what's called the multiple support agreements. And multiple support agreements are really used in the cases, in this case, for qualifying relatives. I don't have the form with me at the moment. In other words, you won't see this form in your federal forms folder. I do have it. I got it after we set up all of these folders. I will share it with you during our lunch break or one of our breaks. I'll share it with you through the chat. And what the multiple support agreement says is, if you have more than one individual contributing at least 10% of somebody's support, how do you determine whether or not one individual or another individual can claim this person as a qualifying relative and get certain tax benefits? Well, they'll fill out what's called this multiple support agreement, which states that all of these individuals listed on that form, the 2120 form, have contributed at least 10% to this person's support. And the name of the individual, the qualifying relative, is also listed on this form as well. They've determined through this multiple support agreement that I want to take this person, me, Emil, and not the other people who may have contributed more than 10% of this person's total support. That's what that multiple support agreement states. So that could be, again, an exception to the general rule we talked about, whether more than one person may claim, in this case, a qualifying relative. How do you solve that issue? By filling out a multiple support agreement form 2120. Okay. One last exception to the rule I think that bears talking about is what's called Form A332, which is a form for divorced or separated parents or a parent who lived apart from a qualifying child in this case. And what that means is if you have divorced parents who, through the divorce agreement, are still supporting that child, how do you determine which parent or which parent who happen to be separated or parent who doesn't live with the child? How do you determine whether or not one parent or another can claim this child for a qualifying child? So they'll fill out this form, Form A332, which means that I, as the custodial parent, and again, it defaults to the custodial parent. So generally speaking, when it comes to a qualifying child, if the qualifying child lives with this parent and not with this ex-spouse or the parent who doesn't live with this qualifying child, generally speaking, the custodial parent can claim dependency exemption for this qualifying child. But if that custodial parent doesn't want to do that, they can fill out this form saying that I, custodial parent, cedes my right to claim this child to this individual, my ex-spouse, or the parent who doesn't live with me. But even filling out this form transfers certain tax benefits to this non-custodial parent, and the custodial parent still retains certain tax attributes. And that's what this slide is trying to tell you. Even though a Form A332 is being filed, the custodial parent still retains the right to claim head of household status, to claim the earned income credit, to claim the dependent care credit. But the non-custodial parent, through the filing of this Form A32, can claim the person as a dependent, can claim the person for the child tax credit or the credit for other dependents, can claim this person for education credit, and can claim this person for the premium tax credits. Certain tax benefits that can help this individual, but not all the tax benefits, as you can see at this slide. Okay, that more or less concludes my part of this lecture. We feel it's important that we gave you this part of the lecture early on because, as you can tell, these rules for qualifying children and relatives are going to be heard throughout this lecture, throughout the whole day when it affects other topics. So we want to give you the basics of it. If you look in your CTA forms folder, I'm not going to call it up right now. You're going to see in the CTA forms folder examples of the test determining a qualifying child or qualifying relative, an example of a multiple support agreement. So get a chance to read that and get an idea of what I'm talking about, a little bit of your homework. But hopefully I've done justice by this topic, and now we're going to transition to another topic. It's on filing status, and I'm going to hand off the computer mouse to another presenter named Shelley, and take it away, Shelley.
Thank you. Thank you, Emil. Good morning, and good morning, everyone. My name is Shelley Barish. I'm one of the founders of Community Tax Aid a long time ago. So I've been here for a very long time, and basically I've seen everything. And so what I'm going to be talking about is filing status. And in order to complete a tax return, we have to figure out what our taxpayers' filing status is, because the filing status determines a whole lot of things. It can determine what's income, what kind of deductions you can take, what kind of credits you might be eligible for. So it's important to determine the filing status of the taxpayer who's approaching you and asking you to do their tax return. Um, we're going to be going over a lot of rules. There are a lot of exceptions to the rules. So we're going to try to touch on them. And again, if you have questions, please put them in the Q&A, and we'll try to answer them as we go along. So I'm going to be talking about filing status. Now, it's important to recognize that filing status is not necessarily the same as marital status. Someone could be married and be considered single, or someone could be single and could be considered married. Lots of times, taxpayers come in and say, I am married, or I am a head of household. Well, that's not necessarily true. And what you need to do, and especially it's important to list whatever information you're getting from the taxpayer on the checklist so we can figure out how you came to determine what the proper filing status is. And if you can see from this filing status table, you can see the impact of filing status. Depending on filing status, the standard deduction might be different, the tax rate might be different, and the eligibility for credits might be different based on what your filing status is. So it's important to determine what the taxpayer's filing status is. Just a number of points before I get too technical. Um, Both the IRS and New York State recognize same sex marriage. So if you have a taxpayer who's in a same sex marriage, they must file as a married person if they have uh, gone through the ceremony and created themselves as same sex marriage. Most states do not recognize common law marriage, meaning people who just simply live together for a period of time and consider themselves married. For tax purposes, they are not. Um, One thing that's very important is how you ask the questions. Number one, these questions are very personal. So you don't want to be yelling in a whole room with a whole lot of people. Hey, you're not married. You're single. You're not. It's important to ask the question properly, respectfully, to determine what the taxpayer's marital status is, so we can figure out based on that what their filing status will be. So how you ask the question is very important. Also, when you ask the question is very important. For instance, you're going to be working at one of our storefronts probably in February, March, or April, and simply asking the taxpayer, "Are you married?" doesn't work, because the real question, and this is important, again, there are rules and exceptions to the rule. The important thing is, what is your marital status as of December 31st, 2014? Again, there are going to be exceptions to that, but that's the general rule. So if someone got married on New Year's Eve just before the ball went down, they're considered married for the entire year. You don't apportion any part of the year. So the important thing is how you ask the question, because if you ask the question in March, "Are you married?" the taxpayer might say yes. But if they got married last week in January or in February or March for 2024, they are not married. So it's important how and when you ask that question to determine what is their marital status as of December 31st, 2024. And as I said, someone might be consider themselves single, but they're really married. Someone might consider themselves married, but really single. So we're going to go through the rules and the exceptions to the rule. On the next slide, you see the various filing statuses. Single, married. The important thing is, as of December 31st, what is your marital status? Again, there are going to be some rules and there are going to be some exceptions to the rule. A major exception to the rule for someone who's married filing jointly, and we'll get to that. If a taxpayer's spouse died in the year 2024, and then didn't remarry, that taxpayer could be considered married filing jointly, even though as of December 31st, that person is probably single or head of household or something else. But even though the taxpayer is no longer married as of December 31st, they can be considered married filing jointly with their deceased spouse. And going through these rules, you may determine that a taxpayer may qualify under one or two or three different filing statuses. Our role is to make sure, number one, that they file correctly, and also to make sure that they are getting the best benefit. Sometimes the only way to figure out what the best filing status is to go through the calculation. Is it better to file single? Is it better to file head of household? Is it better to file married filing jointly or married filing separately? Sometimes the only way you can determine what's the best way and the legal way to file is to do the actual calculations and figure out what's the best benefit for the taxpayer. So now I want to go through each individual filing status and go through what the rules are and the exceptions to the rule.
Excuse me, Sally, you want me to change the slide?
Say that again? Yes, please.
Want me to move the slide to the next slide?
Yeah, go to 2024. Okay. So again, for the purposes of filing status, we're going to talk about single. Someone who's not married as of December 31st, 2024, sorry, never been married, may have been married during the year, but got divorced and are legally divorced or under a separation agreement as of December 31st, 2024, and didn't remarry. Now the question is, who is married? If a taxpayer is married as of December 31st, 2024, they're legally married, but they might be considered under another status depending on their living together and their separation. Again, couples who are in a same-sex marriage are considered married and must file jointly. They are considered married as the same as a heterosexual marital couple. Now, one of the important things about people who are married filing jointly, if a taxpayer wants to file married filing jointly, they must, number one, they must file with their spouse. The spouse must sign the tax return, and all the income of that other spouse must be included on the tax return. Now, you may have a couple who are legally married as of December 31st, 2024. They do not have to have lived together at all during the year. They actually may be physically separated, but if they're still legally married, they are considered married for the entire year. In a case like that, you might have taxpayers who want to file separately. There are a number of reasons for that. Oftentimes, taxpayers who are married do not want to file with their spouse for a number of reasons. Number one, they may not know what their spouse's income is, or they're not close enough together to get their information. But also, if they file a joint tax return, whatever refund comes back will come back in a check or a deposit in a bank account in their joint names. Oftentimes, the taxpayer does not want the other spouse, who we may not even see, or may not want the other spouse to be a part of that refund, and they don't want to share that refund with the spouse. But again, if they file a joint tax return with that spouse, that refund is going to be a joint refund. So that's something that has to be considered uh, in determining whether the taxpayer is married or whether they're going to file um, separately. Um, Filing separately is the worst possible way to file. Um, the income might be higher. For instance, uh, if a taxpayer has Social Security income, that Social Security income might be fully taxable, whereas if they were to file together with their spouse, a greater portion of their Social Security income might be considered not taxable. So it's important to determine the proper filing status. Okay. What I want to talk about now is head of household. And lots of times a taxpayer will come in and say, I am a head of household. Well, that may be true. The taxpayer may have a household, be paying all the rent and all the expenses of that apartment, but may not be considered a head of household. So let's take a look at the rules for what a head of household is. And this is on slide 26. All right. So in order to be a head of household, someone must be, and this is the general rule, and there are exceptions to the rule. Again, in order to claim a head of household, you must be you must be unmarried. If you're married, you cannot be a head of household, except for one of the exceptions. So if you're unmarried, you're providing more than half the cost of maintaining a household, which means you're paying the rent and all the expenses of that household for someone who for a relative who live with you. In that particular case, the spouse cannot be living with the taxpayer or a friend of the taxpayer, and a lot depends on who's paying the rent. If the rent is being paid by somebody else, like a third party agency, then the taxpayer is not providing more than half of the support of that household and may not be considered as head of household. So the question of who is head of household is very important. Now, there are two major exceptions to the head of household rule. For most part, in order to be claimed to claim as a head of household, there must be some relative living with you. It has to be a relative. Um, One of the exceptions is if you have a child who's away at school, then that child is considered to be living with the taxpayer, so that taxpayer can qualify as a head of household. Second exception, taxpayer provides more than half the cost of maintaining the household in which his or her parents live. That taxpayer can qualify as head of household, even though nobody else lives in the household with that taxpayer, as long as the taxpayer is providing more than half the cost of maintaining the household in which his or her parents live, then that taxpayer can be considered head of household. So for the most part, a head of household is someone who's providing more than half the cost of maintaining a household, meaning paying the expenses of that apartment or house, and a relative must be living with them. That relative can be a daughter, mother, father, sister, brother, um, aunt or uncle. It has to be some relative living with the taxpayer in order to qualify that taxpayer as a head of household. Let me give you a quick example of how that could work. Say you have a taxpayer who lives with his girlfriend and her son. He pays all of their expenses. He pays the rent. Can he be considered a head of household? The answer is no. He cannot be considered head of household in that example. Yes, he is paying more than half the cost of maintaining the household, but no relative lives with him. His girlfriend is not his relative. His girlfriend's son is not his relative. He does not qualify as a head of household. Let me change the facts a little bit. taxpayer lives in an apartment with his girlfriend and his son. He pays all the expenses of that apartment and all the expenses of himself, his girlfriend, and his son. Yes, he qualifies as a head of household because there is one relative living with him, his son. Even though the girlfriend does not qualify as his relative, his son does. So all you need is one qualifying relative to qualify as a head of household. Now we come up with a sort of a hybrid situation, and this is a major exception to the general rule. We have, if you say you have a taxpayer who's been separated from their spouse for at least the last 6 months of the year. They're physically separated from their spouse. They're no longer living together. That person, even though they're still legally married, they can be considered as a head of household. We call this the abandoned spouse rule. It's not written in the Internal Revenue Code, but that's our language for it. Because here we have a spouse who's been separated from their spouse for at least the last 6 months of the year and have a dependent child living with them. That person can be considered a head of household, even though they're still legally married. Now, the question of fault doesn't exist. So let me give you an example of how that can work. Say you have a couple. They are still legally married, but they're separated, and they're separated for the last 6 months of the year. The wife has one child, the husband has another child. They can both be considered head of household, assuming that they're providing more than half the cost of maintaining their household. They have a dependent child living with them. So the question of who abandoned who is not a question. The fact is they are still legally married, but they would both qualify as a head of household, even though they're still legally married. Now, that couple, they have a number of choices. They can file together, even though they're not living together. They can still file jointly, or they can file married. They each can file married filing separately. Each of those three categories would be technically correct, but the question would be which method gives them the better refund or lowers whatever tax they might have to pay. So what we have to do is figure out what's the best way to do it, even though the correct way may not give the taxpayer the best benefit. Now, I spoke about the taxpayer whose spouse died in the year 2024. And just as a reminder of that, if you have a taxpayer whose spouse died in 2024, that taxpayer can still file married filing jointly for the year 2024. But now I want to change the facts a little bit. We have a taxpayer whose spouse died in the year 2023 or 2022, which means a year ago or 2 years ago. As of December 31st, 2024, that taxpayer is single. But for tax purposes, that taxpayer can file as a qualifying widow or widower. In order to do that, and the advantage of that is that you get the benefit of married filing jointly, even though your spouse is no longer alive. So if someone's spouse died within the last 2 years, that taxpayer can file a tax return as a qualifying widow or widower and get far better tax benefits out of that. Now, it's important to get the filing status correct because there are a lot of benefits that might be available to the taxpayer by having the correct filing status, or on the other side, may be ineligible for lots of things if they do not have the correct filing status. So for instance, if the filing status is married filing separately, they might not be able to claim deductions for student loans or for education expenses. The earned income credit might be somewhat reduced. They might not be eligible for the child care credit. So it's important to spend some time with each taxpayer who you're confronted with or who you're working with to determine what the correct filing status is and the filing status that gives them the best benefit with the filing status that they might be eligible for. So that ends my presentation. Um, we're going to be taking a break. So if there are any questions out there about what we've discussed so far in terms of Emil's presentation about dependence and my presentation about filing status, please ask those questions and we'd be glad to answer them. Emil,
Yeah, I see something in the chat.
go ahead.
I'm gonna
What do you
look into
see?
that during the break.
What do you see?
Excuse me?
What question do you see?
Do you have access to the Q&A?
Yeah, go ahead. Go ahead. I'll find it.
Okay. So on the more, and then you
Got
hit
it.
more.
Okay, so the
Q&A
question,
is-
all right, the question is, in the example that I brought up, the girlfriend should be a qualifying relative, would be a qualifying relative, but not for head of household purposes, correct? Correct. Um, the girlfriend could be considered a dependent and qualify as a dependent on the taxpayer's tax return, but it does not qualify the taxpayer for head of household status because the girlfriend is not related to the taxpayer. So that's a good question, and that emphasizes that, and it brings up what I brought up in that example. In that again, in that example, the girlfriend is not related to the taxpayer. So the girlfriend herself does not qualify the taxpayer for head of household status. The fact that in one of the two examples, the fact that her son lives there doesn't change it. But if it's his son, then he has a relative there, and then he becomes head of household. Hopefully that answers your question. That clarifies that.
Okay, let's see. Anything else in the chat? Oh, something else.
If a couple live together, girlfriend has a son, and both have kids in common. Again, if the taxpayer has a relative, a child, that's his child, it doesn't matter that it's also the girlfriend's child because it is his child. And as long as there's one relative, meaning his child, living with him, he qualifies. It doesn't matter that the other people in the household are not his relatives. All he needs is one relative, and that's all. It doesn't matter that there are other people who are not relatives living in the household.
Okay, so I guess we're okay in
Hold on,
terms of answering the questions on the chat.
there's another question.
Okay.
What if the girlfriend was married to him, which means she's not his girlfriend, she's married, all right? And the child is still hers. Can the child be considered as a dependent? All right, that's a question of dependency, not head of household. So of course, that child would be considered a dependent.
Okay.
Okay.
So anyway, somebody asked about whether or not they don't see the questions in the chat. So hopefully it should be there in the chat. Well, or there's a separate part for Q&A. So somebody says, I don't see the questions.
All
Hopefully
right,
it should be
I'm
there.
gonna recite the question. What if the
Okay.
girlfriend was married to him and the child is still her? Can the child be considered as a dependent? Well, now the taxpayer is married. It's not his girlfriend, it's his wife. So they can file together. He wouldn't be head of household because now he's married, and of course the child would be considered a dependent.
Okay.
Okay.
And somebody's asking about that. Anyway, all right. When it comes to some of these questions on the chat, yeah, we'll respond this
Okay.
way. Some people are saying they don't see. Anyway, doing our best to answer these questions, guys. A lot of them early on, we're talking about the storefronts. There's one on Sunday, there's one on Saturday. A lot of people ask questions about the certificates. It's only based on tax preparation hours, things like that. So we're doing our best to answer your questions on the Q&A. Should have been in the chat, but I don't see it in the chat. Anyway, I thank you so much, Shelley. I think that's it in terms of questions up to this point. It is like 10:30. Let us take a 10-minute break. I have to say here 10:29. Let's reconvene at 10:40 and enjoy your break, and we'll be back.
Very convenient time. 10:40.
10:40, 10:40, 10:40. Yes. Remember that time, guys. Hi guys, can you hear me?
Yep,
Just
I
respond.
can hear you.
Okay, great. I think we have the issue of the chat settled. Uh, yeah, and seeing some people during the chat saying, yeah, you see us, and that's great. So I think going forward, any questions, submit in the chat. That way everybody has access to it. We apologize for that. But we have that issue settled, and that's pretty cool. And now let us go forward. And we're now on the next part of our lecture, which is gross income. And we have another presenter here. And take it away, Tomer.
Uh, hey everyone. Yeah, so uh we just went through filing status and the basics of how tax return operates in general. Now we're gonna actually get to how the income is calculated, taxable income, which is the basis by which tax is calculated for the taxpayer. So it first starts with gross income, which is defined by the Internal Revenue Code, which is the tax law, the federal tax law under Title 26 of the US Code. And the 16th Amendment to the Constitution as being derived from any source of, it could be derived from any source, doesn't have to be anything specific unless it's excluded explicitly in the code, which we'll discuss later, certain exceptions like municipal bond interest and some other stuff. But generally, anything by default can be taxable unless the code has excluded it. So we're going to discuss some of the more common types of gross income because that's a starting point in order to calculate adjusted gross income. I'll also discuss the adjustments afterwards in order to calculate AGI, which is important in determining a lot of things for credits and other calculations. And then after AGI, you either have a standard deduction or an itemized deduction, which Emil will discuss early this afternoon, in order to calculate the taxable income. So let's start with gross income. Uh, First is wages. Um, I would think that a lot of you, including myself, are employees for someone else. That you're not self-employed, which we'll discuss later. So for a lot of us, we receive what's called a Form W-2 once a year in January, which is a reporting of income that's been earned throughout the year, whether weekly, bi-weekly, monthly, and it shows a bunch of information. Wages are taxable with very limited exceptions. And they're actually one of the explicitly defined taxable income types in the code. In section 61, it's explicitly listed as taxable. So the way it works is that for every employer you work for, you receive a W-2, and the employer would be required to withhold what's called FICA taxes, which is Social Security and Medicare, for your half as an employee, as well as pay in the employer half of FICA, which totals about 15.3%, I believe. Doesn't really matter here, but just for your edification, the employee portion gets withheld from your gross wages. And so it's what they call a trust fund. And so, the employer, just like with sales taxes, is obligated to remit it as a collection agent. And so on the W-2, which is the informational form, there's a bunch of lines, well, boxes that we'll get to in a minute or two, but they all have important value for one reason or another. And you need to make sure that when you're given W-2s, that they're for not duplicates. Like if a client gives you an employee copy and an employer copy of a W-2, it's a duplicate. You don't want to input it twice because you don't want to claim the same income twice, and also the same withholdings. So that's one thing to be aware of. Another thing is to make sure that you mark whether it's a taxpayer or spouse, which has these wages, because the IRS does match wages. So if you say that a W-2 is for the spouse and not the taxpayer, they may eventually send something called a CP 2000 matching notice a year down the road saying, hey, you didn't pick up this W-2, and you say, hey, I did pick it up, and they'll say, no, you put it under the spouse, not the taxpayer. So you want to make sure you're listing it under the right party, because the IRS does match, that the appropriate income is being reported under the appropriate social security number, or ITIN, which is a individual tax identification number for people that are non-resident aliens or people that recently moved to the US and couldn't get an SSN. So that's something to consider. Another thing is that, as it says in part C of the slide, you should be writing each box number down in the appropriate section of the checklist, because as I'll describe in a minute or two, the various lines have significance and affect other places of the returns, even if it's not necessarily apparent from a glance. And as it says here, put in the information about Social Security and Medicare withholding. That's important because for two reasons. If there's a client that, had insufficient Social Security and Medicare withholding, or had excess withholdings, there could be situation where, they may owe extra, or they may have excess Social Security withholdings. Although CTA clients shouldn't have that situation with excess Social Security, because we're not taking clients that exceed the wage base, which is about $160,000, I believe. And that happens because if you have multiple jobs, the jobs don't talk to one another. So you have situations where someone works two jobs and they make $100,000 on each. So they end up withholding more than what's allowed to be withheld in the aggregate by Social Security. So they get a refundable credit for the excess withholding, but you're not going to see that at CTA because the income amount is way above our threshold. But just so you know, that's why you need to know, to make sure you input Social Security and Medicare correctly in general, because that can happen. In Medicare, there's issues there with calculating what they call the Medicare surtax, which is 0.9%. And that's also for higher income taxpayers. And, that's why you need the Medicare input, but that's not for our CTA clients, because it's higher income, about $250,000. Let's see, yeah, the taxes withheld for federal, state, and local purposes is very important, because that's one of the big refundable credits, is the withholdings done on the W-2. You need to make sure that you list the correct states and cities. That's important, in particular on the state returns. And it's also determinative, because if, for example, it's a client that lives in New York but works in New Jersey, or vice versa, you have a situation where you have to claim what's called a resident credit in the state that they reside in, and that gets somewhat complicated. We'll talk about it in the afternoon in the New York section, but there could be complexities there. It's straightforward if they live and work in New York or live and work in New Jersey or whatever. But if, you live in one state, working in another, it gets more complicated. And yeah, it also notes that you can have multiple states worth of withholdings and income sourcing. We don't really see it that often in CTA, but just be aware that there could be multiple lines filled in for New York State withholding, New Jersey withholding, Pennsylvania, whatever, wherever they work. So you got to be careful and input all of the states because it's all relevant in order to calculate the returns correctly at the state and local level. Talks about box 12 potential retirement contributions. That's important because as we'll talk about later, there's stuff like the savers credit and some other things that can benefit the taxpayers, lower income taxpayers. So you want to make sure you input the information from box 12. Box 12 also lists stuff like health insurance contributions, which used to be more relevant when the ACA, Obamacare, was being enforced for penalty purposes. It's not as relevant now. And also, some other information flows through in that box. So you gotta, write down the information to make sure you pick up everything. Box 14 is also informational, so you want to copy everything down. And yeah, in short, you want to copy everything off of the W-2 because ultimately almost all of it's going to end up being used somewhere on the return, even if it's not readily apparent. Emil, do you mind putting up the W-2 just so we could show the the audience
Okay, let
how
me
it
see if I can.
looks?
Okay, let me
Sorry.
see if I can get that going.
Thanks.
Where are we? Where are we? Well, I did send everybody through the chat.
Okay.
I sent the W-2 form, but get this, guys. When I did my research, I found a 2023 W-2. I did not find a 2024 W-2. What I've sent you guys is a 2025 W-2, but its format has not really changed. So tell me, they do
Yeah.
have it. They do have it. I sent
Okay.
it to you guys through the chat.
Yeah. So basically, if you look at the W-2, there's a bunch of boxes. And to summarize what's going on, box 1 is the total wages, tips, and other compensation. That's generally what's going to be the taxable wages on the 1040. Sometimes it could be modified, but typically it's box 1. That's the total taxable wages. Box 2 is the federal income tax withheld. So that's a refundable credit on the 1040 that you can claim to offset most, if not all, of the taxes with regards to the box 1 income. Box 3 is Social Security wages, which caps out, as I mentioned earlier, I forget it, $170,000. It's inflation adjusted every year. And box 4 is the Social Security tax withheld on those wages, which should be a flat 6.2%. Unless the employer messed up, which rarely happens, but it could. And then box 5 is Medicare wages, and Medicare wages, can vary from the box 1 wages and the box 3 wages because certain things that are not taxable in box 1, for example, retirement plan contributions could be taxable for Medicare purposes at 1.45%. So that's why you could see that box 5 may end up being bigger than box 1, but even though it's not taxable for income tax, it is for Medicare purposes. Because I don't allow deferral of Medicare taxes on the contributions usually. And box 6 is, the amount withheld on the box 5, which, as I said, would be typically 1.45%. If they were higher income earners, there could be a 0.9% surtax, but you're not going to see that happen with CTA clients because they're well below the Medicare surtax threshold, which is around $250,000 for single and half, I think, for couples married filing joint. Box 7 is Social Security tips, which is tip income, which actually there's a slide. The next slide actually discusses tip income. Tip income is like if you're a waiter or some sort of person in a service industry that you receive tips, and if the employer is actually funneling the tips to you through the W-2, they would report in box 7 the tip income. And then, the 7 and 8 is like the tip income and the allocated tips. Yeah, allocated tips is what got allocated. I believe 7 is for Social Security purposes what the tip income is. So those are additional income on top of the regular base wage, because if you're a waiter and you get whatever minimum wage, that would end up on box 1, whereas in box 7 and 8, the tip income is supplemental income on top of that. And, you would have to report it and pay tax on it. And even if it's not being reported in box 7 or 8, if let's say the restaurant says we don't want to get involved in allocating tips, that's up to you to pick up, then you would have to self-report the tip income and pay income tax and technically FICA tax on the unreported tip income. So that gets a bit more complicated, but I mean, it does ultimately resolve itself. Box 10, don't really think we see it at CTA. It's dependent care benefits. That's if an employer provides, a child care service, a pre-K service, whatever. It's taxable, but the thing is, to the extent that you incur expenses for child care elsewhere, you can shield most of that benefit. I think they cap it at 5,000, something like that, the benefits. So, so it would be like 5,000 reported in box 10. And then if you have enough expenses elsewhere, you can eliminate the tax on it. And although if you do that, you can't claim the credit, but if you got the benefit, you got the benefit. But we'll talk later about the child and dependent care credit and how that works in more detail. Box 11, you don't have to worry about. That's for what they call deferred compensation plans, non-qualified plans, which are plans that aren't covered by ERISA, which is the big retirement law that most plans are covered by. Those are plans, like 401ks, IRAs, whatever. Non-qualified plans are structures where the people that make the contributions are typically high earners, like the CEO of a Fortune 200 company or whatever, and they want to contribute a ton of money into a retirement plan. And there's complicated rules that they have to be at risk personally, that they can lose their contributions in a bankruptcy of the company, stuff like rabbi trusts, whatever. We're not going to discuss it because it's out of scope, but just know that it's not going to apply for CTA because all of our clients are not CEOs or CFOs or whatever, Fortune 200 companies, senior executives. Box 12, as we mentioned, it's an informational box. They have a code for, retirement plan contributions. I think it's code D, right, Emil?
I believe so, yes.
Yeah, and DD is for health insurance, contributions by employers. The contributions by employers are non-taxable, so you don't have to be concerned about it. It was more relevant a few years ago when we had the ACA, the penalty being assessed because there you could see, okay, they were covered by the employer. You still needed the 1095 to make sure they were covered the whole year, but at least you knew they were covered for a period based on that. And then you could follow up. And there's a bunch of other codes which I won't get into because there's various situations. Box 13 has 3 boxes that could apply. Statutory employee, that's an employee in certain industries, like certain sales people and whatever, have that box marked. And what it basically means is they get a W-2, but they're allowed to deduct on Schedule C, the self-employment schedule, certain trade or business expenses because they travel around, they do whatever, and the code allows them to deduct on Schedule C again, which effectively reduces their total income, as we'll discuss later. Some of the expenses, not all of them, but more so than your average employee who would have to do an unreimbursed employee expense, which is not deductible under the Tax Cuts and Jobs Act because it's a former 2% of AGI expense. It's an itemized deduction that's not allowable right now. Retirement plan, that box will be marked. You'll see it if there's in box 12 code D, or some other code for a different retirement plan. It's just an informational thing. Third-party sick pay is if you get paid sick pay, the box gets marked. Sometimes it is taxable sick pay, sometimes it's not. It'll show up, in box 1 if it's taxable. If not, it won't. It depends. Most cases it is taxable because it depends whether you paid the premiums or not. Usually it's employer covered, so you didn't pay the premium, so it's taxable to you. Just so you are aware. And then box 15 through 20. So box 15 is the state that certain wages are being taxed. It could be New York, it could be New Jersey, it could be Pennsylvania, Wisconsin, wherever. And you input it the way it shows in the box. Then the state ID number is a reference number that the state returns technically match to determine, that the employer withheld under that employer ID, which may or may not be the federal employer ID number, FEIN, the box B number, it could be the same. Box 16 is the total state taxable wages, which may or may not tie to box 1. And you should be careful about it because let's say the person lives in New York but works in New Jersey. New Jersey may show the box 1 amount. They may show more because of adjustments. They may show less. They may have only worked in New Jersey 5 days in the year and the rest of the time was in New York. So, the box 16 is important to read because it could differ. Also, some states like New York basically have a policy that says, list 100% of the wages as state source, and then fill in a what they call an allocation schedule, a day's allocation schedule. determine how much of the wages are taxable in New York or wherever, which we can talk about later on in the afternoon, in the New York session, possibly. And then there's local wages, which is taxable wages for a locality. For example, New York City, that's a residence or tax. You could also see Philadelphia in Pennsylvania or other places, so that would be filled in box 18. Box 19 is the withholding on the local tax, and box 20 is the locality code name like NYC, PHI, whatever. And that's more or less the W-2. Are there any questions that came up, Emil?
Let's see. I don't see any in the chat right now. Well,
Okay.
one question came up regarding substitute W-2 forms. If you'd like to talk about that, Tomer,
Okay,
how to
Yeah.
reconstruct wage information, and then there's one other
Yeah.
point maybe you can address too. Take that one first.
yeah, so I mean, if you're gonna, so with a substitute W-2, I mean, yeah, if you're gonna have to reconstruct it, like if the employer went out of business and, you can't get a W-2, and, the taxpayer can't go, and pull a transcript from the IRS, which I don't think they could anyway until May, so they would have to go on extension if they were gonna try to do that. Then, if you're gonna reconstruct it using a pay stub or something, typically the best policy is to get the last pay stub that, they had from the employer. So let's say they worked for a company until July and the company closed down, then the company didn't issue a W-2, you the best guess would be to use the July pay stub information, because you would see the year-to-date wages, the year-to-date withholdings. You could essentially back into a pro forma W-2, even if you don't have an actual one. Obviously it's not the best policy, but it's better than nothing. And if the IRS ever came and said, hey, you claimed $5,000 of withholding, what are you talking about? You would give them the last pay stub and say, here is the withholding. This is what the employer told me. I'm entitled to claim this withholding because it was segregated. I didn't get the money. So, even if they didn't turn the money over to you, if they failed to pay the trust fund tax, I'm still entitled to deduct this 5,000 as a credit. And so, I've had that situation come up in practice a few times and, got them resolved. The IRS gave credit to the employee eventually. It took some negotiation, but yeah, I mean, I've done situations with substitute W-2s, but yeah, obviously it's best to get the actual if available, and most of the time they will give you an actual W-2. Very rarely do they say, well, the company's out of business, they didn't issue me a W-2, they're not willing to give me one, whatever. Does that answer that question?
Yes, somebody said, well, it's hard to do, but we're doing the best we can under the circumstances. One other issue that came up is about what if the FICA that's withheld on a W-2 is incorrect or under withheld?
Yeah, well, I mean, if they were under withheld, then, that becomes an issue in the sense that, they may be subject to what's called 2210 underestimate penalty, which is that they didn't pay in enough through withholdings, and
Well,
presumably.
Excuse me, Tommy, it's the issue of FICA. The amount of FICA
FICA.
withheld was not sufficient or not accurate.
Okay. FICA. Okay. Yeah. So FICA, I mean, the thing there is, in that case, there is a separate calculation in the software, just like there is for excess social security withholdings. There's the calculation for under withheld FICA taxes for the employee portion. That's calculated and it's reported as a surtax in Schedule 2, I believe, of the 1040. There's whatever, some form. I mean, you don't usually see it because usually, the payroll companies just take the 6.2% and the 1.45%, and it's straightforward. So you don't really see under withholding. If anything, you usually see over withholding. But yeah, just be aware that technically that could happen. Any other questions before I move on
I think
from?
yeah, I think you can move on, Tomer.
Okay, so we talked about tips, so I'm not gonna go through that again. Interest income, so interest income, that's income from bank accounts, from certificate of deposits. It could be, anything, any sort of debt. It's the compensation for lending money to someone, whether it's to a bank, whether it's to a corporation. You get the money back. And it's a general proposition. It's taxable. It's reported on a Form 1099 INT or consolidated 1099 in the interest section. And typically it's taxable. It's fairly straightforward. The only time it's not going to be taxable is if it's what they call municipal bond interest, tax exempt interest, which is number 4. That's from state and local municipal bonds, issued by the governments, to construct roads, to do whatever with. And typically those are not going to be taxable, at least federally. On the state level, they can be taxable because, for example, New York is only going to exempt from taxation New York State municipal bonds and bonds of United States territories, Puerto Rico, Guam, American Samoa, what have you. And the reason that they exempt those is because they're under the supremacy clause. There's an exception under Title 4 that states are not allowed to tax instruments issued by U.S. Government, the U.S. territories. So the governments are preempted from taxing those bonds, whether it's New York, New Jersey, whatever. They can't tax Puerto Rican bonds, whatever. So those are fully exempt, just like United States bond interest is exempt at the state level. I don't know if the slides mention U.S. bond interest, but those are bonds issued by the U.S. government. The way those work, just to mention quickly, is that federally they are taxable, but at the state and local level, they're exempt from taxation. They're a subtraction, which we'll get to in the afternoon. It's an adjustment and they aren't allowed to tax it, so they have to back it out under Title 4 once again, because the United States instrumentalities are not taxable, as I mentioned. So, it gets a little confusing because it can decouple, but we'll get to that in the afternoon. Dividend income, those are stocks, mutual funds, REITs, which is real estate investment trusts, and some other vehicles. Those are distributions from those entities which are taxed as C corporations for income tax purposes. And, they could be qualified dividends or non-qualified. Qualified basically means either U.S. issuers, so like a U.S. incorporated corporation, or certain foreign ones that are on publicly traded markets like NASDAQ, NYSE, whatever. And, the qualified gets taxed at a more favorable long-term capital gains rate of up to 20%, whereas non-qualified are taxed as at ordinary income tax rates, but all of them are ordinary dividends, regardless of whether they're qualified or non-qualified. So that's, if you look at page 1, you'll see that there are two boxes. One says ordinary dividends, one says qualified. And, qualified is a subset of ordinary because those are at a more favorable rate than the rest of them. And I forgot to mention about the foreign bank accounts earlier, but once in a while we have a client that has a foreign bank account in wherever, China, what have you. And for those clients, you need to get more information because they may have a filing obligation in addition to having to report on a worldwide basis the income. So if you are a US citizen or a resident alien, you pay tax on a worldwide basis, less, what they call a foreign tax credit or a foreign earned income exclusion. We'll talk about the foreign tax credit later on. I don't think we talk about the earned income exclusion because those are for expatriates living abroad. But the long and short of it is you get taxed on a worldwide basis. So, they may have income generated abroad. They have to pay tax on it. They also have to disclose these foreign bank accounts and certain foreign assets on an FBAR, which is a foreign bank account report for foreign bank accounts that they own or signatories for. And if it exceeds more than $10,000 during the year in the aggregate, and then they may have to file a FATCA form in 8938, which is a similar form, but it expands it, not just bank accounts, but certain stocks, bonds, partnership interests, they have to disclose as well. But that's a higher threshold. That's like 50,000 as opposed to 10,000. So, there's more slack there, but just so you know that there are foreign reporting requirements to be aware of. State tax refunds. Well, state tax refunds is like, let's say you filed your 23 tax return in April of last year, and you claim $1,000 refund from New York State. Now, the thing there is it depends whether or not you took itemized deductions as opposed to standard deduction. If you took a standard deduction, none of that refund is potentially taxable. If you itemized, part of it could be taxable because of the tax benefit rule, which basically says, well, if you took an itemized deduction on the 23 return and for the W-2 withholdings that you claimed at the state and local level for state and city taxes, and now you get a refund of part of it. Part of it is recaptured as income potentially, and there's a very convoluted calculation on whether it's taxable or not that the software will do. But the long and short of it is it could be taxable if you itemize. If you take a standard deduction in the prior year, then it's not going to be taxable because standard deduction means that you didn't itemize the state and local income taxes. So it depends. And, that's just something to be aware of. But the software, especially if they are a prior year client, should be able to figure that out because it should roll forward, whether they itemized or not, what the refunds were, and recapture the appropriate amount of taxable refund. If it's the first year, it gets trickier, and then you may want to have a manager help you to figure out if any of it's taxable or not. I think that's it for that page. Is there any questions?
I don't see anything in the chat at this moment.
Okay. Okay, so then, um, you're showing something or,
You have the outline?
um,
You have the
the
outline on?
outline? Well, oh, you're showing the code? Okay.
Anyhow, yeah, I'm just showing the code. Guys, for those who are needs CPE credits, please take down this letter. We're gonna have 4 of them throughout the entire training session.
Yep. Okay, all right, so yeah, we're back. So the next income type is alimony received, and that's for taxpayers, for clients that had divorces that were effective before 1/1/19, I believe. Because under the old rules regarding alimony, if a spouse pays an ex-spouse pays the other ex-spouse alimony, under the old rules, the spouse that was paying got a adjustment to income, which we'll talk about in a bit, to reduce their income, because if they paid, let's say, 30,000 in alimony, why should they pay income tax on the alimony they paid? So the old rule was that it was income to the recipient spouse, and it was a deduction for the paying spouse. So this is what it refers to as, it says, if after 12/31/18, it's not taxable. The reason that's the case is under the TCJA, they said any divorce decree effective after starting 1/1/19, the payer gets no deduction and the recipient gets no income. Now, what a lot of people said then was, okay, we're gonna put provisions in our thing saying we're gonna pay you less because we're gonna pay you post-tax dollars, because now I'm paying tax on something that was previously deductible. It's not really relevant for purposes of CTA, just as a general legal thing that a lot of divorce attorneys and whatever, now put provisions saying that instead of paying you 30,000, I'm gonna pay you post-tax what the 30 is. So if it's a 30% tax rate, I'm gonna pay you 21,000 in alimony because that's post-tax dollars, since I no longer get a deduction for it, and you end up in the same place, which makes sense because it was taxable to the recipient under the old rule, so would have been the similar situation. So yeah, that's alimony. Self-employment income is income where you're not an employee of someone else, you work for yourself, and if, let's say, I open up a CPA practice for myself, I would have to report it on a Schedule C, which is an informational form on the 1040 of the gross receipts and allowable deductions, and you calculate a net income. And there's a lot of rules about it, cash versus accrual basis. There, did they receive 1099 NECs or miscellaneous or 1099K with income amounts? A 1099 NEC is a non-employee compensation form. So that's like if you're providing services. 1099 miscellaneous has some other income amounts. 1099K is receipts from a credit card processor. So, you'd need to get details about it, their income, their deductions, allowable deductions, which may require you to talk with a manager to figure out if certain deductions are deductible or not. You also need to see if they've been paying estimates, because with self-employment income, you know, unlike a W-2, you don't get withholdings every week, 2 weeks, month, whatever. So you're not paying in against the income being generated. So you'd have to pay in estimates to cover both the income tax and your own FICA taxes, the 15.3% I mentioned earlier, the Social Security and Medicare, less a deduction for 7.65% of that, which is an adjustment later on, but that adjustment doesn't really reduce the FICA taxes, the 15.3 reduces the income subject to income tax, so it's reducing there, but you're still paying 15.3% ultimately on the net income. And both wages and self-employment income are what they call earned income, as opposed to interest, dividends, capital gains, which I'll talk about in a second, etc., which is unearned income, investment income, passive income. There's a lot of synonyms there. One other thing about the self-employment income is section 199A deduction, which is the qualified business income deduction, QBI deduction. And that's a deduction from, well, I mean, for our CTA clients, all of them will presumably qualify for a 199A deduction. There's complicated rules about it, which I won't get into, but the long and short is there's two buckets. One is what they call a qualified trade or business, and one is what they call a specified service trade or business. And then SSTB is stuff like being an accountant or an attorney, or most medical practitioners, some other buckets where they say, if you're in one of these buckets and your income, your AGI, or yeah, I think the AGI maybe is exceeding, $150,000 or $300,000, you get no QBI deduction, you're phased out. And whereas a qualified business doesn't have that phase out, what happens instead is if it gets to higher amounts, you have to take the greater of 2.5% of the basis in the assets of the business, or 50% of the wages paid. There's a convoluted calculation and a bunch of limitations, but the long and short of it is that for our clients, since they're low income, regardless of it's an SSTB or a qualified business, they're going to get the full 20% deduction, because they're not going to be phased out under either calculation. So that's not a problem. And then capital gains. So capital gains is basically the sale of any asset other than specific assets listed in the Internal Revenue Code, like the sale of inventory in a trade or business, and certain like intellectual property, etc., etc. So almost everything that you buy and sell is going to be a capital gain under the revenue code. And it could either be short-term gain, which is less than a year, or or long-term, which is a year or more under the code. And the way it works is you net losses and gains. First, you net short-term gains and losses against one another, and long-term gains and losses against one another. Then you net the net short-term and net long-term gains and losses to figure out what the total is. And once you do that, if it's a gain, it gets taxed, depending on whether it's a net short-term gain or net long-term gain. Short-term gains are taxed at ordinary rates of up to 37%. And long-term is taxed at rates of up to 20% like qualified dividends. Plus, if they earned enough income, they'd be subject to something called the net investment income tax at 3.8%, but none of our clients will be subject to it because it's like 200,000 or whatever is the threshold. So it's well above the community tax aid threshold for clients. There, none of our clients will be subject to NIIT, but just to flesh it out. And capital gains are reported on a schedule 1099-B or a consolidated 1099. If it's from a brokerage, it would have a 1099 interest section, a 1099 div section, a 1099-B section, and you pull the information from all of those sections. So I think that's it for that. Any questions come in, Emil, or?
I don't see anything in the chat.
Okay, so I guess we go to the next. Retirement pension annuities. So with pensions and retirement plans and what have you, they issue them on a form 1099-R. It's and people eventually retire and they start claiming the retirement savings that they put aside. Like if I've been contributing for 30 years to a 401k or an investment retirement account, an IRA or what have you, eventually I'm gonna want to start taking out, or even if I don't want to, eventually I'll be forced to take out once I hit what they call the RMD age, which is the required minimum distribution age, which depends on what your current age is. So right now, a lot of people are taking out at 73, 74. And it keeps increasing the RMD age based on the Secure Act. And the long and short of it is it's distributions from retirement plans. So what happens is if on the 1099-R, I guess we could pull up a 1099-R to show people. Just so that, sorry. Huh?
Let's see if I can do that. So,
Okay.
that's not it. Where are we? Where are we? Hold on, Tomer, just 1 second.
No problem.
Um, Almost there. Gonna do this. Gonna do this. Whoops. Let's do this. Go here. We did that. Where are we here? Whoop. And we're gonna do this. Do you have it there? I guess Tom
Yep,
has it there
yep.
for me.
Yep, there we go. All right, so yeah. So the way it works is basically box one is the gross distribution. So if you took out $10,000 last year from pension account 123, box one would show 10,000. Box 2A may or may not show the correct taxable amount. And the reason that I point this out is because sometimes they fill in and they say, well, it was a 10,000 distribution, 5,000 is the taxable amount, but then they mark a box in 2B saying taxable amount not determined. And that the reason they say that is if, let's say you rolled over a 401k into this brokerage, into Vanguard from Fidelity years ago, they may say, well, we don't know, if you had basis in any of the contributions he did years ago. Like if you had non-deductible IRA contributions, that was post-tax dollars. That's basis. So the return of those funds are not taxable. So, they'll mark the box taxable amount not determined. So sometimes, what happens is you have to figure it out yourself. But a lot of the time, if they do actually put an amount in 2A, it probably is correct, because otherwise, they really shouldn't be putting something in 2A if they don't actually know whether it's taxable or not at all. It gets kind of confusing. Total distribution is if, person takes out the remaining funds from the pension, then that box gets marked. Capital gain, I don't really see even in practice. Federal income tax withheld is important because obviously if you take out a distribution for federal purposes, it's going to be taxable. For New York purposes, it may or may not be taxable for two reasons, which we'll get to in the afternoon, because there's an exclusion on federal, New York State, and New York City pensions, distributions from those plans, regardless of the age of distribution, even if it's before the 59 and a half, because there's a 10% penalty tax if you generally distribute before 59 and a half, other than certain circumstances, which we'll discuss in a bit, like disability and this and that. Or if you're over 59 and a half, or you inherit a pension or an IRA or something, your portion of the $20,000 pension exclusion. So for New York purposes, it may or may not be taxable, but for federally, it definitely is going to be taxable income, because there is no exclusion at all on the federal level. So that's why you would definitely see federal withholding, but you may not see New York state withholding on these 1099-Rs usually. Unless it's a very small pension, then they may not withhold federally. If it's like a $200 distribution, they may just pass on it because it's too low. Box 5 is what I've been talking about, like post-tax contributions, stuff like that would get reported there. Employee contributions. Box 7 is important because that would determine, based on the code, whether it gets treated as a regular distribution, that you're 59 and a half or over and take out a distribution you're entitled to take, or if it's below but there's a known exception, or below but there is no known exception. And based on the way it's coded, that would determine how you have to work on it, because if there is an exception that does apply but they don't know about it, you have to code it the right way. So you have to make sure that it gets filled in correctly, and you talk with the manager. There's also a box for IRA, SEP, and simple plans. I wouldn't be concerned about SEP and simple plans. Those are sole proprietor plans, which are fairly common. I mean, SEP is a lot more common than simple from my experience, but you don't need to be concerned about it. It's informational. That box for the most part, because they just want to know about the nature of the plan itself. Because in an IRA, a SEP, a simple plan, there could be basis, and that's a big reason. I mean, 401k also could be, depending on the circumstances, it could be partially post-tax Roth. But that there's very complicated rules there. For state taxes, just like with the W-2, there's state and local tax amounts and withholding amounts, and you have to fill in properly to flow it through to the return. And then, yeah, I mean, I think that's more or less it with the 1099-R, right, Emil?
Yes, I think so, Tomer. We can talk about a couple of nuances a little bit later. Uh, so Tom, if you can stop sharing the screen, I'll put back the share screen on the outline. Is that okay?
Yep.
Okay. So hopefully you see the outline, guys.
Yep. Yep.
Okay,
We're
go
back.
ahead, Tomer.
Yeah. So the next thing is rental income. You don't really see many of them in CTA. Rental income is like, let's say you know, own two apartments or two homes, one you live in, one, you know, you rent out to someone else. So rental income, basically it works like a Schedule C, except instead of, you know, being on a Schedule C, it's on a Schedule E, page 1. And it's, you know, the receipts you get from your tenant less the allowable expenses. So the thing is with rental income, unlike your personal purposes, you could deduct things like, let's say, condo expenses, condo maintenance fees, because they're ordinary and necessary expenses to generate the receipts, whereas you can't deduct it personally. Stuff like that, you know, like the Schedule C. If you're not experienced, you should go to a manager to discuss it and how to, you know, how to fill it in. Um, but yeah, I mean, that's all I'm gonna mention about that because there's no point in belaboring it. Uh, Unemployment compensation is reported on a Form 1099-G. You know, if someone gets let go from a job and not for cause, then they're able to claim unemployment compensation. Uh, you know, and you would report the income on the return federally and also the state that issued the unemployment, New York, New Jersey, wherever. Uh, state. Um, yeah, and so, you know, you have to be careful to see what state it's coming from, if it's New York, New Jersey, Pennsylvania, or wherever, because just because they worked in, you know, live in New York doesn't mean they didn't work elsewhere. And there's complicated rules of where unemployment could be paid from. But yeah, I mean, typically most of our clients live and work in New York, so it's fairly straightforward. But yeah, make sure that you pick up the withholdings on the 1099-G because obviously in most cases, part or all of it's going to be covered by withholdings unless they decided not to do withholdings, which would be not great because they'll probably owe taxes at that point unless they have big credits elsewhere, which we'll discuss later. Social Security benefits and Social Security disability, SSB and SSDI. So you know, they're both reported on a 1099 SSA. Um, you know, the way it works with Social Security is that either 0% of it's taxable, 50% of it's taxable, or 85% of it's taxable, depending on your modified adjusted gross income, which the software will calculate. It's basically your taxable income plus some non-taxable income. You know, it has some adjustments and the software will calculate how much of the Social Security is taxable. And, you know, most of our clients, I don't see withholding for taxes because most of them are in the 0% and some in, you know, the 50%. So for the most part, they don't do it, but you occasionally see federal income tax withholding on the 1099 SSA. And you should also note there's a box, I forget if it's 4 or whatever, that gives the description and it'll say like Medicare Part B premiums paid, Medicare Part D premiums paid. And that's part of the box 1 total income, and you do have to include it. But you do get to potentially deduct the premiums as a Schedule A itemized deduction, which Emil will discuss later on. You know, so that's why you have to pay attention to the Part B and D. And yeah, SSI is different from, SSB and SSDI. That's like people that are in particularly low income levels, that they basically get supplemental income. It's not actually taxable. It's 0% taxable, and they don't get it reported on the 1099 SSA like SSDI and SSB. SSB is normal retirement. SSDI is if you qualify for disability from the government, which is incredibly difficult. It's a very long and painful process. SSI is incredibly low income level, and none of it is taxable, but it does impact the real property tax credit, which I'll discuss in the afternoon in the New York section. So, just be aware that there's three types of, Social Security type benefits, and the third one, SSI, isn't reported on a tax form, so just be on the lookout. I think that's it for that, right? Okay, so other income, there's things like gambling winnings, which would be on is it also a 1099-G, I think, for gambling?
I believe that's it, yes.
Yeah, yeah. So with gambling, you gotta be aware that the winnings are reported on a 1099-G. Now, the thing is that the winnings does not factor in, the cost that it was to invest into your winnings. So like if you spend $100 in gambling and you end up winning $200, the net winning is $100 because, 100 of it is a recovery of basis and $100 is the actual winnings that's being reported on the 1099. You also have to factor in that certain expenses and also losses are deductible as an itemized deduction. So you should ask about gambling losses and related expenses. Scholarships for room and board as opposed to qualified tuition is taxable, as we'll discuss later in the education section, the education credits. There's very limited scope what is allowable educational expenses. So, if it's qualified tuition and certain like materials, you can exclude it and possibly claim credits against it. If you're paying out of pocket, if it's a scholarship, that means that the school or some third party is paying it on your behalf, and you only get to exclude it if it's for qualified expenses. So room and board would not qualify. So you got to be aware of that could be taxable. You have to ask the clients what they used it for. Yeah, and the next part they say income non-taxable generally, tax refunds, as I said, if they take the standard deduction in the prior year, then it wouldn't be taxable. If they itemized last year, it may be taxable, so it depends. Public assistance, food stamps, Section 8, etc., are non-taxable. Some of that may get factored in the calculation for the real property tax credit, but it's not taxable. It just is considered for the credits. SSI, we discussed a few minutes ago, child support and gifts and inheritances are not taxable. These are all exclusively excluded in the Internal Revenue Code. Reimbursed medical expenses from an insurer are not taxable unless you deducted in a prior year those expenses. Like if you paid it in year one and you get reimbursed in the subsequent year, then the reimbursement would be taxable, but that's only if you actually itemized and took a medical expense deduction for it. So, typically it's not taxable. Scholarships, as I mentioned, typically are not taxable if it's for qualified tuition and, books and other expenses. Disability usually isn't, workers' comp usually isn't, life insurance usually isn't. I don't know how often you'll see any of those, maybe some disabilities and workers' comp. Life insurance is not super common with CTA clients, but, I think that's it for the gross income, right, Emil?
Yeah, we can, I have a couple of bullet points to flesh out things, but we can talk about that a little bit later in terms of some of the income items and some of the things that I've seen in my travels on CTA. But there is one question in the chat here. It's on the it's a lot of information. Okay. So yeah, it's a lot of information that somebody's mentioning. But it's important for you guys to know. I know it's a big topic. And we're giving you really a broad introduction to it. Tomer has done his best to really consolidate a lot of the income items, but it's important for you guys to know it. It's very important to determine what's taxable and what's not. In order to do that, you're going to run into a lot of forms. You have to ask them a lot of questions. Some of it is based on your judgment, based on what you're seeing here. So just a matter of looking at these materials. Once you're in the field, ask questions, and we'll get through this together. So thank you, Tomer, for the gross income topic. We're going to move over to the next one, and Tomer will take you through that too.
Yep, the next topic is, as I mentioned, starting point is gross income on the federal tax return. Then you make certain adjustments to get down to the adjusted gross income. And so now I'm going to talk fairly quickly about the adjustments because they're fairly straightforward for the most part. The key ones to be noted about are educator expenses. There's a deduction of up to $300 per year for certain out-of-pocket expenses for teachers, instructors, principals, aides, counselors, coaches, and it's only limited to kindergarten through 12th grade, so primary school, and secondary school too, I guess. Yeah, post-secondary is university. So if you're a professor in a university, you don't get the benefit of this $300 deduction. Why they decided to limit it is up for discussion, but that's how the statute was passed. So, there's a 900-hour test for the work, sort of like the materially participating test for a business. But in any case, you should just be aware if they're a teacher to see if they had out-of-pocket expenses, because they may be deductible to reduce the gross income. Certain performing artists, reservists, and some other groups can deduct business expenses on a 3903, which is an unreimbursed expense schedule. You used to also be able to do it if you were an employee, but that was reported on Schedule A as a 2% itemized deduction, and that's been suspended under the TCJA. It may or may not expire at the end of the year, but just be aware that if you're in certain categories like a reservist or a performing artist or a few other categories, you may get an adjustment. An allowable adjustment for certain expenses, sort of like statutory employees, except it's an adjustment instead of Schedule C. Medical savings account. I mean, I don't really see many Archer accounts, Medicare Advantage accounts, so forth with our clients. Those are those are plans where you're basically paying for medical expenses through certain accounts, and like Medicare Advantage is like a alternative plan for Medicare. Some people do for to fund bigger expenses, but I don't think our clients really use these sort of accounts. Most of them are covered by regular Medicare or Medicaid, so I don't think they use MSAs. Health savings accounts, you may see some people that fund HSAs. Those are like high deductible plans through the employer where, they gotta fund a lot of it themselves. Are allowed to dump the money pre-tax into an HSA account. And yeah, I mean, the gist of it is that they can fund, um, you know, up to 38.50 for single contributors, 77.50 for families, $1,000 extra in either bucket, depending on the circumstances, if they're over 55 years old. So, you should just be aware that that exists, that, HSAs are a thing. Moving expenses, most of moving expenses got limited under the TCJA. Pretty much it's limited to military taxpayers. If you move it more than a certain distance and you switch jobs, then you can potentially deduct it. But as I mentioned, it's limited to military taxpayers under the TCJA, so it's kind of a limited scope. As I also mentioned before, half of the self-employment tax, 7.65% of it is deductible as an adjustment to income. So, you know, um, that's a reduction in the adjusted gross income. So be aware of that. And the last major thing I think is the self-employed health insurance deduction. So that's if you're a Schedule C person, you're allowed to deduct as an ordinary and necessary expense the healthcare premiums that you pay, not the doctor's appointments and whatever the premiums, the insurance premiums is deductible to the extent that you have net income. So like if you have, I don't know, $1,000 in net income before the health insurance deduction and after the self-employment tax deduction, then you could only deduct the first 1,000 as a adjustment to income, and then the excess would flow through to Schedule A as a medical expense subject to a 7.5% AGI floor in the software. So there is a limitation, but if it's well below the income that's being generated, you'd be able to deduct it, fully. So, there's a calculation and the software will do the calculation for you. So, that's basically all I had to say about that, I think.
Okay, so if you don't mind, Tomer, something came up in the chat regarding health savings accounts, contributions. This person wrote can be contributed by the employer and the employee. So if you can determine what the employee's portion of contributions, if any, make sure you note that.
Yeah.
I look at
Yeah.
medical savings accounts and health savings accounts together. The difference between the two is the issue of what's called portability. In other words, I believe it's with health savings accounts that it must be used. It's a use it or lose it plan. So if you don't use it, it's gone. With health savings accounts, my experience in CTA is I don't see a lot of people who say they make contributions. I see people who say that they make distributions. They receive a distribution from their health savings accounts. They'll receive a form, I believe it's called 1099 SA. And the question you have to ask, and it usually happens when I ask them is, did you use this distribution to pay for medical expenses? And the answer is yes. If it is not used for medical expenses, then there's a penalty on it. So keep that in mind, guys, when you see somebody who says, I have a health savings account, I received a distribution, here's this 1099 SSA. That's a question you should ask for these taxpayers. Okay, so let's move on to the next slide. That's okay, Tomer?
Yeah. Okay, so yeah, there's a few more adjustments to discuss quickly. The next one is self-employed retirement plans, certain plans like KEO plans, qualified, certain qualified plans and SEPs, are deductible, just like the health insurance deduction and, the half of the SE tax deduction. So be aware that, those can be deducted, assuming they have income. If there wasn't income, they couldn't make the contributions anyway, which is a different problem, because then technically they would have to withdraw the erroneous contributions. But, that's that line. The IRA deduction, so, there's an allowable deduction for taxpayers of up to 6,500 if they're below 50 when they make the contribution, or 7,500 if they're 50 plus. And the contribution, the deduction rather, is for traditional IRAs, which are pre-tax contributions, as opposed to Roth contributions, which are not deductible because they're post-tax dollars. And I don't think we have to be concerned about non-deductible traditional contributions, because if you earn more than a certain amount of money, you're phased out from making pre-tax contributions. You can make post-tax and then you have basis, but I think it's out of scope of CTA's clients. None of them are going to be in the phase out range. The penalty on early withdrawal of savings, that's if, let's say you contribute, you put in, I don't know, $10,000 into a certificate of deposit and you earn $1,000, but you have to keep it in there for a year to earn the $1,000. If you take it out, 8 months in, they're going to hit you with a penalty for taking it out 4 months early. So that penalty is a subtraction, because you pick up the income in full in the interest section, but they took away part of it as a penalty for the early withdrawal, so it gets netted out. So if it was like $1,000 you earn less the 400 they held back as a penalty, you really earned $600. So this is a subtraction to get you to the $600. That's what that is. The alimony paid, we discussed already. The student loan interest deduction, you're allowed to, subject to income phase out, which is, I think, at 100,000 or thereabouts of AGI, you're allowed to deduct interest related to student loans of up to $2,500. It had to pay qualified higher education expenses, which is the case with educational things in general. And that's basically it with the interest. It's a deduction of up to 2,500. The jury duty pay, the way it works is, typically when you get jury duty income, like you go to serve in state or federal district court or whatever, and you get your, few $100 for the service, typically you pick it up as income. In some cases, employers say, we're not going to make you use PTO, personal time off, but we're going to take that money, the few $100. If they do, since you didn't actually keep the money, you get a subtraction for that income. So if you had, let's say, $500 of jury pay, but you had to give it all over to the employer, you get a subtraction of 500. If they took half of it, you subtract half of it, et cetera, et cetera. So to the extent you gave it to the employer, then, you get a subtraction, because obviously that's not income to you ultimately, because you had to hand it over to the employer. So just for you to note. I think that's it for this page.
Okay, Tomer, I know that that's the end of your presentation on these two very important topics. I thank you so much. Before we
Yeah.
go to have our lunch break, guys, I just want to bring up a couple points. Let's see, just looking at the QA. Okay, we'll talk about that then a little bit later, Dan. Somebody brought up on the QA the issue of the IRA, and for example, what if you had a and just as a background, just as an FYI kind of thing, or some people may know this, if you make a contribution to a traditional IRA, you get this adjustment to income. If you have a Roth IRA, you do not get this deduction. It will be deferred. When you make when you receive the money from a Roth, it's not taxable. When you eventually get distributions from a regular IRA, it will be taxed when you receive it. But this person brought up the issue of what if you want to make an IRA contribution, but you also have a pension plan from your job? Well, based on the number of crunching exercise, you might have to limit or even not get the tax benefit of a contribution to a regular IRA. That's something to keep in mind too, whether or not somebody has more than one pension plans, be it through a
Yeah.
regular IRA, and somebody might also have a pension plan through their employer. So
Yeah,
keep that in mind too. It's not necessarily the full amounts that you see on slide 37. Let's go
well,
back.
that's it.
Let's go
Yeah,
back a little bit in terms of the gross
Oh.
income, and just want to give you some war stories of some of the things I've seen here at my travels on CTA, and something I think you should be aware of. I'm on slide 33 right now, guys, and we're talking about the issue of people who are self-employed and might receive the certain forms that you see there. For example, 1099K. A 1099K form is people, and this is happening more and more frequently because we're dealing with the new form of economy where people pay by credit cards. They don't give you cash, they give you credit cards. And what am I talking about when I talk about self-employed individuals who receive money via credit cards? Well, I'm really focusing on Uber drivers and people like that, or people have their own business and receive payments via credit cards. They're supposed to receive this form 1099K, representing the amount of credit card transactions they've received. I did a little bit of research. I think I'm correct in quoting this number for you. Uber drivers in particular and people like that are supposed to get a 1099K if they have at least 2,000 credit card transactions throughout the year. That's good. Yeah. So in other words, if they receive payments from 2,000 separate transactions, most likely they will get a 1099K from the credit card company. Now, that's a lot. And especially for people who started businesses within the year or even towards the end of the year, they might not have received 2,000 credit card transactions. So they might not have received a 1099 NEC. The question is, well, if there's no really report on this, do they pick up income? Well, of course, the answer is yes. And somehow you have to come up with a report notating the amount of credit card transactions they receive. Now, you do can get this, you have access to this. The credit card company or the Uber people can issue a form saying, these are the transactions attributed to you, Uber driver, during the year. It might not necessarily total 2,000 separate transactions. So you could use that as a basis of reporting income that self-employed people in this manner will receive. 1099E NEC, that form there, the limit on receiving that form is $600. So I deal with some clients here at my storefront, and maybe some of our other managers deal with clients at their storefronts or virtually. If somebody's an artist and earned $400 by selling artwork, will they have gotten a 1099 NEC based on what I just said? Most likely no. So, but once again, does that mean they do not report this income? Well, no, they have to. So somehow you have to reconstruct that income figure, ask them whether or not they keep a journal of these transactions, or maybe they've put it in a separate bank account to keep record these transactions. But the point is, there's always a plan B with these things. If you don't see these particular forms, ask them, well, if you did receive credit card transactions, show me some sort of report to do that. Okay, let us go quickly to slide 34. And I want to hone in on something that I've seen here again in my travels on CTA, and that has to do with retirement pension plans 1099A form. Tomer really discussed thoroughly the layout of that form and what some information means on certain boxes. The most important box I believe you should really concentrate on is box 7 of a 1099-R form. What does that mean? It means it describes fully what this distribution is about, and in some cases, it might be subject to a penalty based on the code numbers you will see in box 7. Okay. One thing about box 7 that I want to highlight right now for you is, what if you see a code number 3 in this box 7? I've seen this a lot. I've seen it recently within the last couple of months. A client of mine had this. If somebody receives a 1099-R or pension distribution has a box 3, that person is receiving a distribution pension. That means that person retired because he was disabled. And here's a special rule on disabled plans that I think you guys should be aware of, and you should write it somewhere. If this person received this distribution and it is before the person's retirement age in this retirement plan, you are supposed to pick up this distribution as earned income, as in effect wages, right? A different type of income, not necessarily as retirement income, as wages. Well, you could say, well, Emil, doesn't that hurt the taxpayer? Well, in a way, yes, but in a way, no. It could be to the taxpayer's benefit, especially about what we're going to talk about this afternoon with the earned income credit. So if somebody is on a disability pension, receives a box 3 on this form, that amount is considered earned income, but guess what? That amount is also considered earned income for purposes of the earned income credit. We talked about the earned income credit being a refundable credit, means money in their pocket. So please be aware that if you see a box 3, those little bells should go off. But there's one important point when it comes to that. You need to know, and it's not necessarily easy to get, you need to know what is the retirement age, the full retirement age of the pension plan that taxpayer is in. It varies based on the pension plan. You have to ask the taxpayer, do you know the retirement age of your pension plan of which you receive this distribution? That person might not know. You might have to do some homework, some digging. Reach out to the retirement plan, reach out to the company that puts out this retirement plan, try to get some documentation of what is the full retirement age. I do have some clients in CTA that are still subject to this rule, and it is to their benefit to consider these amounts as being wages for what I said about the earned income credit. So keep that in mind. And then there's something else in terms of scholarships and fellowships, but I'll talk about that this afternoon when we talk about all these credits, both refundable and non-refundable. According to my clock, it is 12:15. Let us take a 45-minute lunch break until 1 o'clock. We will resume then. And enjoy your lunch, guys. And I'll see you virtually later. Bye.
This is the second code for CPE credit. If you could jog that down, I will take this down within about another minute or so.
So once again, everybody, thank you so much for being part of our day. And now we're going to start our afternoon session. And we have some people on the chat here. And yes, you're back. Yes, welcome back, everybody. Somebody had a question in the Q&A. That question will be answered a little bit later. So let's summarize what we've done today, guys. So we talked again about deductions and the tax benefits of having deductions and certain, dependents. And we talked about the benefits of having certain types of dependents, and it affects you tax-wise. And we're going to talk about that in depth today, this afternoon when we talk about certain topics. Talked about filing status, a government-granted definition of what a taxpayer is. And based on their filing status, they can avail themselves of certain benefits, certain deductions that Shelley mentioned in his lecture. We talked about income, very comprehensive presentation by Tomer in terms of the types of income you guys are going to encounter. and some that are taxable in nature, some are non-taxable in nature. We need to know all of it because it affects, say, support items for dependency. It needs to be included in terms of whether or not we have to include it on the return itself. And how, and especially true of Social Security, that's a tricky number where part of it, all of it, or some of it might have to be included, or even none of it. Okay. But then we talked about adjustments to income. So in other words, once you've had a gross income amount, we're starting to see amounts that are granted by the government to chip away at the gross income number to come up to with a taxable income amount. So let us again, when we talked about adjustments to income, that gives us a number that's called adjusted gross income. And if you guys remember that from my lecture this morning about the math behind the return, we're more or less at that point in the tax preparation process where we have an adjusted gross income. Now we're going to take it even further and talk about other deductions that can reduce that AGI number to more or less a number that's an income number subject to tax. So this part of the lecture is going to talk about deductions, standard versus itemized. So as you can see, there's two types of deductions. We're on slide 38. Hopefully you guys can see this. Two types of deductions, standard or itemized, right? And you select the benefits, the method that's most beneficial to the taxpayer. How do you know what the tax standard deduction amount is? Well, Shelley had it in his section on filing status. You can go back to that slide. It's summarized there. And again, it's based on a person's filing status. And it varies, of course, as you saw there. Another way of finding this standard deduction amount is to look at our quick reference, which we really haven't dealt with yet. But we will, I promise, when we have a review of our CTA forms, what's in the CTA forms folder. Okay, and the standard deduction amount, and we'll see this in the quick reference more so, can vary, can increase whether or not the taxpayer is filing together with his spouse and whether or not the taxpayer is blind, or taxpayer and his spouse or his spouse is age 65 or blind. So you'll get an increased standard deduction amount, an increased subtraction to come up with taxable income based on whether or not the taxpayer is over 65 and whether or not the person's blind. Okay. There are certain instances where I'll say this way. There was an analysis, I believe it was based on the 2019 tax returns, but done by the government. They said of all the returns that were filed, about 77% of those returns used standard deduction amounts. So why even bother talking about this topic itemized? Because as you heard before this morning, there's always an exception to that rule. There could be a taxpayer with a tremendous amount of deductions, which we'll talk about in a minute. And then in addition, you are required to itemize based on certain things that happen to the taxpayer. There's certain things that are out there. I'm just going to mention one that's really germane to CTA taxpayers. And that is the issue of people who are considered married filing separately. And it's mentioned more or less in the middle of slide number 38. If you're preparing a return for somebody whose filing status is married filing separate, and that person still might be in contact with his or her ex-spouse, and that person knows for a fact that his or her ex-spouse is itemizing, then when we prepare this return for this other spouse, we have to itemize deductions for that person, no matter what that number is. If the number is less than the standard deduction amount, we have to use that number. If it is more than that person's standard deduction amount, we'll use the standard deduction amount. It's capped that way. So that more or less is an exception to that rule about whether or not you have to itemize or use a standard deduction. Okay. Anyway, let's talk about these itemized deductions, the ones that are really prevalent for CTA taxpayers. The first one is listed here is mortgage interest paid in 2024. And is reported on a form called 1098. And I believe I downloaded the 1098 form. You should see that in your federal forms folder. And it's based on this. It's based on the loan balance of the mortgage being $750,000. So if the mortgage is over that amount, somehow we have to allocate the amount of the mortgage interest to the extent of $750,000 of the loan balance. And that loan had to have been used to buy or substantially improve the taxpayer's principal residence, okay? And also it varies based on when the mortgage was taken out. And as you can see there, those are the limits depending on the date that the mortgage was taken out. Next, the SALT deduction. SALT is an acronym that means state and local taxes. And what that means is before the 2017 Act, taxpayers can take an unlimited amount of state and withholding taxes, estimated state and local tax payments, amount of property taxes they happen to pay on their home. That amount could have exceeded $10,000. With the 2017 Tax Act, the SALT deduction caps some of those amounts at $10,000. Okay, and that means that more or less is to the detriment of people in high income states like New York, like California, like Illinois, where the standard of living is different than other parts of the country, and they might have tremendous amount of mortgage interest and pay a lot of mortgage interest on their mortgages, or work at a job and have a tremendous amount of withholding payments. Unfortunately, the SALT deduction is capped at $10,000. Contributions to charity, it's limited to 100% of AGI. So in effect, somebody can make contributions to the extent of their AGI. Do we see that here in CTA? No, but that's a rule. If the contribution happens to be greater than $250, there should be documentation that you should see from the taxpayer. And generally speaking, you'll see this of taxpayers who give tithes to their church. You should see a letter from the church saying this person has given X amount of dollars during the year in contributions. That's also true, say, of non-cash contributions. Somebody donated a car, a painting, a work of art. Generally speaking, do you see that a lot in CTA? No, but that's a rule. Medical expenses. Here's where the calculation of AGI that we previously calculated is important, because medical bills, as you can see, is subject to a percentage of AGI. You have to take all of the person's medical bills. You have to take 7.5% of adjusted gross income, and the excess above this threshold amount can be used as a potential itemized deduction. Okay, when we talk about itemized deduction, all of these bullet points you're seeing in total, all of these separate bullet points in total, if it exceeds the standard deduction amount, by all means, itemize. It means that you have a greater deduction to get your income subject to tax even lower. That's the beauty of itemizing. But think about all of these things added together. Okay, what are we talking about in terms of medical bills? More or less, doctor prescribed charges for medical bills that have not been reimbursed by insurance companies, health insurance premiums paid by the taxpayer, prescription drugs, again, the excess, co-pays that are paid by the taxpayer, and once again, is not reimbursed by anybody. Even Medicare premiums paid by taxpayers as shown on the 1099 SSA form. Even say, if somebody were taking physical therapy, and this is the key, if it was prescribed by a doctor that I think as part of your physical therapy, in order to get you better, I'm going to tell you to enroll in a gym, and that person enrolls in a gym based on that little scenario I created for you guys. The payments to the gym as part of his physical therapy, that would be considered a medical expense. If some of you out there, like myself, I happen to belong to a gym. Nobody told me that I need it for my physical therapy. I just needed it for myself. I wanted to do it for myself. But nobody told me, it wasn't mandated that I take this. So in that case, the amounts I pay to my gym is not considered a medical expense. Okay. Losses from deaths and accidents from federally declared disasters. This is a recent change, more or less, as a result of the 2017 Act. If the person, excuse me, suffered a loss as a result of what's called a federally declared disaster, we'll get into that in a minute. Whatever that person lost after 100% deductible amount, as you see there, and after any insurance reimbursement that you see there, well, that's not listed there, but maybe it should be listed there. So maybe you can write a little note to yourself. So again, you take a federally declared disaster, you take $100 floor, so anything excess above that $100 floor, and then you also deduct any insurance received by the person in order to compensate him for his loss. Whatever that resulting amount is, it is also, as you can see, subject to a 10% of AGI limitation. So it's the excess above 10% of AGI. What is a federally declared disaster? Well, you go on the website, believe it or not, and I don't know it off the top of my head, but if you go to Google and you type in federally declared disasters, you will get a list of federally declared disasters that the government has deemed to be a disaster in 2024. So if that person says, I suffered hurricane damage based on what happened here, and you happen to see it's a federally declared disaster, maybe you can ask them, well, how much did you lose? Was it reimbursed by insurance, etc.? Last bullet point talks about gambling losses and what's called related expenses to the extent of winnings. Tomer alluded to this morning about someone who receives gambling winnings. He won the lotto, or let's focus on somebody who went to, say, a poker tournament in Atlantic City and paid for a hotel to stay at this tournament in Atlantic City, and maybe paid a fee to join this tournament. And oh, by the way, he won as a result of this tournament. He won whatever it is, this World Series of Poker, whatever it is. He won something as a result of this tournament. That is a gambling winnings as he pick up. But in terms of all of these expenses, the losses that he might have incurred, maybe once he stayed in Atlantic City after the tournament, and the related expenses, in this case, would be the travel expenses to get to Atlantic City to participate in this tournament, or the transportation costs to take a bus or a car or something like that to Atlantic City for this tournament. That's called a related expense, but it's not a dollar for dollar deduction. It's considered an itemized deduction, and it's only to the extent of winnings in terms of these related expenses. That is more or less what I want to say about deductions. I will say this when it comes to this last bullet point. I think I've seen it once in my travels at CTA. We have someone who considered himself a professional gambler. In other words, he was in the business of living by gambling. You know, he had a lot of scratch-offs. He played the horses. He won tournaments down in Atlantic City. If he's considered self-employed by gambling, then some of those related expenses that I just mentioned can be considered Schedule C items. But like I said, I think I've seen it once in my travels in CTA. But full disclosure, you never know when it's going to happen. Anyway, that is all I wanted to vote on this topic. And let's just check the chat. Anything in the chat that we should know about? If Tom or somebody else, I'm looking at it quickly too. And I see that, and we'll talk about that later. Okay, let us move along into our next topic, which is called refundable and non-refundable credits. So again, as you can see, we're getting closer and closer to calculating a tax. And more or less, you've calculated tax, not you per se, it's our handy dandy tax program, which we'll talk about next week. So we're at a point now where we've calculated taxable income, talked about everything up to this point. Now that you have a tax, what can we do to lower that person's tax bill? Well, here's one of the ways to do it, and that is the issue of credits. And we're going to talk about, in terms of slide 39 and the next couple of slides, refundable and non-refundable federal tax credits. And as you can see on this slide, there are two types of credits, non-refundable and refundable. And they're pretty self-explanatory, but let's go through it anyway. A non-refundable credit lowers your amount of tax due. And if it lowers or eliminates the tax itself to zero, then if you had any more non-refundable credits, it won't help you. There's no benefit. But you have refundable credits, and those are great. They reduce the amounts tax due, and any excess, instead of not being used, can be used. How? As money in a taxpayer's pocket. Refundable credits are kind of more advantageous than non-refundable, but they serve the same purpose. They lower the tax bill. Okay. Let's go to slide 40. And here's the summary of all the tax credits we're going to talk about here. And I've broken it down to non-refundable and refundable portions. We have a lot to talk about. Some of them are based on how prevalent it is in CTA. I'll just give a quick mention. Some of them we're going to delve into a little bit more thoroughly. So as you can see, a lot of the credits that we're going to talk about are refundable in nature, and some are non-refundable in nature. And then we have an unusual one called the Education Credit American Opportunity. It has yes, and it has an asterisk. A little bit of a mystery. We'll solve that mystery in a couple of minutes. slide 38. The foreign tax credit, I think Toma mentioned it quickly. You'll usually see this for taxpayers who have investments in brokerage accounts, and they happen to invest in foreign securities. If you take a look at a 1099 B form that summarizes the transactions in this brokerage account, you may see the person have foreign source dividend income, of which a foreign tax may have been paid. Okay. Generally speaking, when we have large dollar worth income taxpayers, they may have to file a form that's called 1116, reporting all of these foreign taxes that are withheld on their investments. And they have the option of taking these foreign taxes that were paid on foreign source income from these investments as either a deduction, an itemized deduction, or a credit. Because of the numbers we're dealing with here at CTA, I opt to have these amounts treated as a foreign credit, and it caps at $300. I've never seen a foreign tax withheld or foreign taxes paid in excess of $300 at all in my travels at CTA. So it seems easier and seems more tax beneficial to treat the foreign taxes paid as a foreign tax credit. Retirement savings contributions credit. Toma again mentioned this. It's for people who have a retirement plan through their job or even separately. They make contributions to the plans that you see there, a 401k plan, a deductible, conventional IRA, a 403b plan, which is more or less a not-for-profits version of a 401k plan. So look very carefully at a W-2 that a person is going to bring with you. They might have set up a 401k plan through their job or 403 plan through their job, or I believe even what's called a 457 plan, which is a retirement plan for government workers. So take a look very carefully at the codings of these amounts. I believe they're going to be shown on box 12. So look at that very carefully. And there's a limit on the amount of contributions as you see there. And also there's AGI phase outs. But for some of our CTA clients, they do qualify for this. Residential energy credits, it's really for homeowners who make heat savings or improvements to the house, be it through storm windows or solar panels. I see it perhaps once a year when I've done some work for some of our Queens taxpayers. There's some of our homeowners out there, and they do that. That's all I want to say about that. Credit for the elderly or disabled. We used to see this a long time ago. Very common during the earlier years of CTA. You'd have to fill out what's called Schedule R to the Form 1040. And that's generally speaking for people who are on disability, but also receive Social Security benefits. And the reason why we don't see this a lot lately is because the amounts, the limits, some of the credits we're talking about are really indexed for inflation. You'll see dollar for dollar limit changes over the years. We have it when we've seen to the credits for the elderly or disabled. I've mentioned it here because you never know when you're going to see it again. Have I seen it lately? The answer is no. But again, full disclosure. Education credits, let's just make sure we're on the right slide. Yes, we're on slide 42. Education credits. What you'll see again is another tax form that's called 1098T, which is tuition statement. It is in your folder, I believe, in federal folder, so I'm not going to call it up. But I do want to say this. Sometimes those forms, the way they're prepared by the educational institution, are not exactly correct. They might not consider late year tax payments that a person may have paid for their education. Look at the 1098 form. Ask the taxpayer, oh, by the way, it says here you paid X amount of dollars towards your tuition. And the person might have bursars, receipts to verify that amount. Barring that information, if that person more or less states that the amount on the 1098T is correct, use those amounts. You will also see on the 1098T amounts that the person may have received as a result of scholarships or loans that he scholarships or grants that he received, be it Pell grants or things like that. So, excuse me, the amount of education credits that were used based on tuition now. If it was paid through a scholarship or paid as a result of grant, that amount reduces the amount of this potential credit. So in other words, in essence, if, for example, the person's tuition was $10,000 and the scholarship covered $8,000 of that, and the grant covered $1,000 of that. So in essence, what he picked up was $1,000 in tuition credits. That's more or less a general rule, and that's more or less what we see in CTA. But full disclosure, an election could be made by the taxpayer to have the amounts that were paid through the scholarship for tuition and expenses being considered income. Why would you do that? Because it might increase the amount of this credit. Do we do that in CTA? No. Is it practical? I say no. Have I done it here in CTA? The answer is no. I think for simplicity purposes, I think for our CTA clientele, I don't think you should suggest to that taxpayer to make that election, but it is out there. So what I'm trying to say is take the amount of tuition paid, what I said before, offset the amount of scholarships and grants. And in essence, that difference is what was paid by the taxpayer. And that's important because as we see here, there are two types of education credits. One is the American Opportunity Credit, and one is the Lifetime Learning Credit. And as you can see, it's based on different amounts of amounts paid for tuition. First one, American Opportunity, is limited to $2,500 per eligible student. How do you calculate that amount? You take the first 100% of the $2,000 of tuition expense and 25% of the next $2,000. It's available, as you can see, for the first 4 years of post-secondary education. In other words, for undergraduate work, and it can't be claimed for more than tax years. And oh, by the way, 40% of this credit, so 40% of $2,500 or $1,000 may be refundable. And as you can see, we put it in bold, may be refundable. So that is the answer to that little mystery of ours a couple of slides ago. I put yes and an asterisk. So why do we say it's refundable? Well, it's not exactly all refundable. Part of it, the extent of 40% of it, 40% that may not have been used to offset taxes, could be refundable. It's very good to know, very important to know, okay? The second type of tuition credit, education credit, is what's called the Lifetime Learning Credit. And as you can see here, it's a little bit different in terms of how you calculate that. It is $2,000 limit, and it's based on 20% of the first $10,000 in expenses. And as you can see here, it's based for years other than post-secondary education and for courses to acquire or improve job skills. And it's a non-refundable credit. Big difference than the American Opportunity Credit. Okay, so if somebody is say a programmer, a computer programmer is taking education courses to improve his skills in his chosen field, a case can be made that those amounts he paid is subject to what's called this lifetime learning credits. Okay, for either one of these credits, you have to get what's called the EIN number, in essence, a social security number of this educational institution, and the taxpayer, the student, had to have a social security number. If you happen to be preparing a return for a student who is being claimed as a dependent by his or her parents, the parents can claim this credit, not the student. If the student is not being claimed by his or her parents, the student is entitled to these credits that we're talking about. When we talk about the American Opportunity Credit, you'll see it's on the form itself, 8863, and also in our checklist. Other questions have to be met, have to be answered in order for the taxpayer to qualify for this credit. We'll talk about that a little bit later when we review the forms, our forms, that is. Next, slide 42, 43, which is the dependent and child care credit. You'll see the information about this on page 6 of our checklist and form 2441. Okay, it says here, taxpayer has to have a qualifying person. Okay, so more or less that's alluding to the dependent we mentioned earlier, but of course there's going to be exceptions to the rule, and we talked about that before, and we'll get into what I mean by a qualifying person in the next slide, I believe. Okay, so the child care expenses had to have been paid by a taxpayer to allow him or her to work or to look for work. That taxpayer is living at home and happens to be not working or not even looking for work and pay somebody to take care of the children. These expenses, based on what I just said, don't qualify for this credit. Okay. If the person is engaging somebody, excuse me, a company to take care of a child, then you need that information that's listed, an EIN number or an ITIN. In some cases, the person might have his neighbor take care of the child, and in theory, that neighbor has to pick up this income, this amount that he's being paid as income on the other side. So if that's the case, then you need the social security number of that person doing that. Okay. You might have taxpayers who are married and the spouse is not working or is a student. For purposes of calculating this credit, you assume an amount for the lower earning spouse of $250 amount for one qualifying person, qualifying child, or $500 amount of two or more qualifying children. So again, you have a two couple home, taxpayer and spouse. One person is working, the other person is not working. It is assumed, it is imputed that the person who's not working is receiving that amount of money for purposes of calculating the limits of the credit. And as you can see, it's limited to $3,000 for a qualifying person and at least $6,000 for two or more people. Okay, we talked about the credit itself. It's capped and it's on a sliding scale, 35%, and then it goes down to about 20%. And then the credit itself varies based on this $43,000 figure, which includes the imputed amount. Okay. Next, what else do we have to know? Oh yeah, what is a qualifying person? Again, the exception to one of my pet topic from this morning. What do we mean by a qualifying person? Well, guess what? That term qualifying child is rearing its head again. Okay, so it's the same test in terms of qualifying person, and again, it's either test A, test B, or test C. Test A is saying use the same test as a qualifying child, and I think we're all expert on that by now. I hope you will be, of course. However, when it comes to the age test, the person had to have been under the age of 13. So if you remember the age test, there were three parts of the age test, but when it comes to the qualifying person, it's a qualifying child with this exception when it comes to age. Okay. Part B is the taxpayer's spouse. In other words, qualifying person could be the taxpayer's spouse who was not physically or mentally able to take care of himself or herself and live with the taxpayer for more than half of the year. So again, the person is taking care of his spouse, and this person can be a qualifying person for purposes of this child and dependent care credit based on test B. And test C is any other person, as you can see, who is not physically or mentally able to take care of himself or herself and live with the taxpayer for more than half of the year and can or could be claimed as a taxpayer's dependent, except the disabled person had gross income of $5,050 or more. So that's the exception to the gross income test that we saw for the qualifying relative test. So in other words, if this person is physically or mentally not capable of taking care of himself and had income subject to tax of more than an amount, not the person's qualifying relative, but potentially that person can qualify the taxpayer as a qualifying purposes for purposes of this credit. Okay. Person is filing a joint return, and a person can be claimed as a dependent on someone else's return. So all of those things have to be met. Slide 45. All right, let's talk about another credit. The next three we're talking about is called the child tax credit, CTC, the additional child tax credit, ACTC, and dependent for other, credit for the other dependents, ODC. Okay. And as you can see, the second one is a refundable credit. The other two are not. Let's go through them anyway. Guess what? You need a qualifying child. And in this case, in terms of age, get another exception to the general rule we saw this morning. The qualifying child had to have been under age 17 at the end of the year. and must be a U.S. resident, live with the taxpayer over the year in the U.S. or is a bona fide resident of Puerto Rico. So again, a slight exception to the residency rule we saw in the beginning. This mentions here Puerto Rico, and it also mentioned, we saw this morning, residents of Canada and Mexico. We don't see that here. So if you had a person who's a resident of Canada and Mexico, just happen to live with the taxpayer, for purposes of the CTC, it's not going to happen. Okay. And what I just said is mentioned on the next sentence. Okay. The child must have a social security number. If the person doesn't have a social security number, then that person potentially qualifies for the third credit that were listed below. Okay. And it's limited to $2,000 per qualifying child. There are phase outs, which I don't believe are going to be hit by CTA taxpayers. The second one, which is refundable, is called the Additional Child Tax Credit, ACTC. And as you can see, the taxpayer who wants to claim someone for the ACTC must have more than $2,500 of earned taxable income, okay, for at least one qualified child. And taxpayers with 3 or more can claim that as well, regardless of their income. It's limited to 1,700. And there's the age limit again, has to be less than 17 years old. Again, exception to the general rule we saw this morning. And again, if this person doesn't have a social security number, very important, as you can see for the first two, if you do not have a social security number for credit number 1, for credit number 2, guess what? You go to credit number 3, right? And what is credit number 3? It is a non-refundable credit called the credit for other dependents, right? So who qualifies? Generally speaking, anybody who doesn't fit the criteria in the first 2 that we saw above, okay? Person just has what's called an ITIN. Now, let's take a step back in terms of ITIN. An ITIN is a temporary social security number, more or less a number that's needed in order to prepare a return. Now, in certain instances, some taxpayers may file what's called an SS7 to get a social security number for this person. There is an outside chance during the tax season that this person will be granted a social security number on or before April 15th, the due date of the return. If that's the case, and you believe, and the taxpayer believes, that they're going to get a social security number for this person who at the moment doesn't have it, then we would suggest holding off filing that return. All right, because you're going to miss out on these credits, in particular, the second one, which is refundable. Okay. So anyway, getting back to this. What's it say? Don't have an ITIN, and again, there's that age limit test, and it expands to qualifying relatives who have what's called a familiar, hopefully I'm saying that right, familiar relationship to the taxpayer. So that's again an exception to the relationship test that we saw this morning regarding qualifying relatives. We talked about the definition of qualifying relative for the relationship test, expanding that includes girlfriends and things like that. Well, it's not going to happen for the taxpayer's girlfriend for this type of credit, right? And it is limited, as you can see, to $500, but it helps, as you can see. But this one helps even more, number 2. All right, moving right along. Premium tax credit. This is a residue of the Obama healthcare credit that happened during Obama's time in office. People were allowed health insurance, and they were required to have health insurance. And if they didn't, they were subject to a penalty. That's more or less been phased away, but this remains what's called the premium tax credit. What is the premium tax credit? Well, some people who have health insurance and are low income and can't afford health insurance through traditional means, through negotiating directly with a health insurance company, or may have worked for somebody who doesn't offer a health insurance plan and yet needs health insurance. I think we all do, right? So the person who may have fit this required or this criteria of having low income may have negotiated, may have obtained health insurance through what's called the exchange. They're still in existence. People can still get their health insurance through the exchange. We have this in New York State. We have most states throughout the country have it. Some states do not have it. They don't recognize this. They don't offer it to residents of that state, but we do for New Yorkers. So let's focus our conversation there. So people who have health insurance and negotiated their health insurance through what's called an exchange, a state agency that helped them get health insurance at reasonable rates, and may have advanced these people what's called a premium tax credit, a credit that allowed them to buy health insurance. Okay, so when they negotiated their health insurance, they could have estimated what they thought their income should be. In other words, I believe I'm healthy, I'm low income, and I fit certain income guidelines. It's more or less, I believe it's 400% of the poverty level. And I believe I need help in order to have my health insurance paid. Can you help me? Well, someone at this health exchange said yes. And in some cases, they could have been advanced the premium tax credit. It could have been advanced monies to help them pay for health insurance. Okay. So they estimated during the year what they think their income is going to be. Well, at the end of the year, we know what their income is because we're following their return. We know what the exact numbers are. Okay. So in that case, we have to calculate whether or not the person was paid too much in this premium tax credit, in which case the person had to remit the excess. In some cases, maybe, excuse me, maybe he wasn't advanced enough of a premium tax credit. And this is refundable if he is entitled to more of a premium tax credit than he initially received. In some cases, believe it or not, some people received health insurance through the exchange and never got a premium tax credit. And I've seen that, believe it or not, at CTA. They'll be entitled to all of the premium tax credit based on the number crunching exercise. How do we know if somebody received a premium tax credit? Well, of course, they'll tell us, but they also should get what's called this form called 1095A, which is the health insurance marketplace statement. Okay, so it is very important when we prepare returns for these individuals that if you know, and again, for people who were with CTA in prior years, it should be noted in our files. But if you know, based on the interview you're conducting with this person, that when it comes to health insurance, they receive their insurance through the marketplace, through the help of the marketplace. They should have, excuse me, they should have this form 1095A. There's a lot of information on that form that has to be inputted into the tax layer program, and it will calculate based on the actual numbers and based on the premiums that that they're entitled to. In other words, the premium tax credit will be used to pay this estimated amount of health insurance premiums. And believe it or not, that's varies based on where they live in New York State. It varies based on the county that they live in. So based on all of those numbers, we'll crunch a number and we'll find out whether or not the person is entitled to an excess premium tax credit, or he'll have to remit premium tax credit that he wasn't allowed to receive. If you know that this person has insurance from the exchange and does not have form 1095A, that form with them at the time you're preparing the return, you cannot complete this person's return. It is very important that we get this form, okay? Some cases he can access it through his account on the website, and maybe you can use your computer to help him access it. But if he doesn't have it that week, make sure he comes back next week with that form. It is so important for us to have that form. Okay. That is, believe it or not, my presentation on this topic. Hopefully I've done it justice, and hopefully as Shelly's back online helping us out, and he's going to take us the next step of the way with a very important credits that he's going to tell you about. Shelly?
Good afternoon, everyone. Good to see you again. So I'm going to be talking about what's called the Earned Income Credit. Based on sort of advertising, this is a very big advertising point for the commercial tax preparers because it can generate a huge refund, and it makes it sound really good for them that they can create this huge refund, and you can walk out of, say, H&R Block with a huge check of $4,000 or $5,000, which may be true, and it's a great selling point. So it's important that we figure out who's eligible for it, how to calculate it, and what's necessary to claim it. So it's called the Earned Income Credit. initially, if you look at slide 47, these are the amounts of the credit that you might be able to get based on the number of children in your household, your filing status, and other pieces of information, and whether the child qualifies as your dependent and their age. Um, so these are huge credits. It's also important because it's a refundable credit, and what that means is that even if you owe no tax, even though you've paid no money in withholding or estimated tax, you can get this huge credit. And not only can you get this credit on on your federal return, but you can also get part of it or a percentage of it on your New York State return. So it's really important for our clients who are all low income to figure out whether they'd be eligible for it and whether they can get it. Now, the earned income credit is based on earned income, which means income you earn from salary or self employment. What doesn't count for this purpose is stuff like interest, dividends, and capital gains. And even if your income from those other sources is over $11,600, you actually can't get the credit at all. So we have to look at all of those criteria to determine if someone might be eligible for the earned income credit. Now, there are two different earned income credits. I'm going to go through um, uh, each one individually. Now, there's an earned income credit for taxpayers who have children, either one, two, or three children. Um, Hold on a second. One, two, or three children. And so the amount of the credit will vary based on the number of kids that you have. Okay. And if you see on this slide, you see how much you might be. Those are the maximum amounts that you might be able to get. It's sort of a sliding scale. It goes up to a certain point and then it declines to with a maximum of earned income. So these are the maximum amounts of the credits that you might be able to get. Not everybody gets them, but those are the incredible amounts that people might be eligible for. So it's important that we figure out how to do it to make sure our clients get it. So the first one is for taxpayers who have children, either one, two, or three kids. And for that purpose, we look at a number of criteria. Number one, we look at the age of the children. The kids have to be um, under 19 or under 25 or permanently and totally disabled of any age. So we have to prove all of those things. The taxpayer um, has to be married filing jointly or head of household to get the full amount of the credit. If someone's married filing separately, they can get this credit, but only the credit that they'd be eligible for if they had no kids, which I'll go through after this. So it's important that we figure out who's eligible for the earned income credit and calculate it properly. You're going to be working on the tax layer program, so you will never see the form that goes with the actual tax return to qualify for the credit. The form is called Form 1040 EIC. Do you have that form available anywhere, Emil?
Let's see if we can call it up.
If you-
Tom, can you help me out too? If you can find it, it should be in the forms folder, I believe.
Yeah, see if you can find that Form EIC.
Okay.
I'm going to start working with it. I have mine with me, so I can explain it, and if we see it, even better. So again, you're not going to see the form, but the tax layer program will calculate whether someone's eligible for the credit based on a number of criteria. So of course, tax layer will there it is. Tax layer will do the
Yep.
computation, but the important thing is the information that's input that will go on the form that will make someone eligible for the earned income credit. And the form itself is very, very important because if this form is submitted to the Internal Revenue Service and it's incorrect, the IRS will simply disallow the earned income credit, and fixing it is very difficult. So it's important when you're inputting the information and also getting the information from the taxpayer, this information must be correct. And I'm going to go through it and go over what can go wrong, which is a lot. Now, first of all, we need the names of the children. Each one of the children who are either under 19 or under 25, who you're claiming eligibility for. Easy, the client's name. Not so easy. Lots of times, clients, taxpayers come into our office, and it appears that the first guess would be the kid's name is the same as the parent. That's not always true. Sometimes kids have different names, last names that are different from the taxpayer's last name. So it's important to verify the child's actual name. The best way would be to look at the child's social security card, and hopefully the taxpayer brought with them either a list written down, which a lot of our taxpayers do because they basically know what we do already, a list of what each of their kids' social security numbers are, or their actual social security cards. So it's important when you input that information, you get the correct information, not only with their name, but their social security number. Each one of those children has to have a social security number. The year of birth. It's important that we get the year of birth correct because in order to qualify, the kids have to be of a certain age, and we need to disclose on this form what the kids' birth dates are. And hopefully the taxpayer brings that with them, so that we can put that on the form, either some form of identification for the child, or a list that they may have, or even if they bring the prior year tax return where this was claimed, that would be very helpful. So we need the year of birth. We need to disclose whether the child is under age 20, under 18 or under 24 and a student full-time for the year. By full-time, we mean a student for at least 5 months of the year. Also, qualifying for the earned income credit, the child could be permanently and totally disabled. And it doesn't matter what their age is. So it's important to determine, hopefully, if you have some kind of a letter from a health professional determining that the child is permanently and totally disabled. That would make you eligible for the earned income credit. The child's relationship to you, it has to be a child. It can't be your aunt or uncle. It can't be your mother or father. It has to be a child. So what has to go in there is the word child, and then the number of months lived in the United States during 2024. Now, the child has to have lived with you for at least 6 months of the year. There's one exception: if the child was born during the year or died during the year. For instance, if the child was born in November, obviously the child could not have lived with you with the taxpayer for 6 months, but that would qualify. And if that's the case, I would put in the number 12 for that person. For another example, unfortunately, if a child died during the year, that child is considered to be living for the entire year for the purposes of the earned income credit. So it's important. The earned income credit is especially important for people with kids, again, because it's a refundable credit and people get huge refunds based on the earned income credit. So it's really important that we calculate it right and that we put in the right information so that we can make sure that our taxpayer is eligible for the earned income credit. There's also a second earned income credit for taxpayers who have no qualifying children. For that purpose, you don't need the form. The numbers are the same, but the only difference is It's for a person who has no kids. For that,
Excuse me, Shelley, would you want me to move some of the slides over?
Sure. I think it's 48, 40, 49 or 50. Right?
That one, right? You see it there? 50?
Right. Okay. So again, going back to the first one, we looked at the ages of the children. For this purpose, the second earned income credit, we look at the age of the taxpayer. The taxpayer must be over 25 or under 65. If you have a couple married filing together, only one of them needs to qualify for the earned income credit. Again, the numbers are the same. Uh, the incomes are fairly the income limit is much lower. The income limit is around $19,000 for someone who has no kids and is qualifying for the earned income credit. Yeah. So we look at the ages of the taxpayers to determine whether they're eligible for the earned income credit. And so they would qualify even though they have no kids. The amount is far smaller. The maximum amount for the earned income credit, I think, is around $800. For those with children, it's much higher than that. Anyway, so that's the earned income credit. So it's important that you find out from the taxpayer if they're eligible for the earned income credit, getting better information about their children because the amount involved is very high. And again, it's a refundable credit. It doesn't matter whether they've paid any money in. It doesn't matter whether they have any tax liability. They can get this credit not only on their federal return, but on their state and New York City returns based on all the information that you're providing. So that's what we have for the earned income credit. Amo?
Yeah, thank you, Shelley. Just to summarize some of Shelley's points, slides 47 talks about the maximum amount of the earned income credit, and look for 3 or more qualifying children. That is a substantial number. Calculating the income credit is kind of like a bell curve. It
Yes.
peaks at certain amounts and then it goes away. It's limited. Slide 48 talks about the income limits that you'll see. So somebody has an income married filing jointly as high as $66,819. Believe it or not, we've seen some taxpayers with that amount of income. That's the maximum amount in terms of
Right.
earned income credit for 3 or more qualifying children. More or less a bell curve. Think about it that way. And then slide 49 summarizes the test about qualifying children, which again relate to my pet topic on qualifying children and qualifying relatives and all that good stuff. Okay, thank you so much, Shelley.
Okay. Are there any questions out there about the earned income credit?
Let's see. I see something in the chat here. Let's check Q&A first.
Yes, there is.
Yes. Yeah, I'm sorry, go ahead.
The question is, can you reiterate if the qualifying child passes away in 2024 regarding the earned income credit? Yes. For the purposes of the earned income credit, the child has to have lived with the taxpayer for at least 6 months. The exceptions are if a child is born during the year or if a child passes away during 2024. So assuming that the child passed away, say in February, that child did not live with the taxpayer for more than 12 months, but that child qualifies the taxpayer for the earned income credit. And what you would do on that form is you would say that the child lives with the taxpayer for 12 months, which is not true. But if the child passed away, it would qualify the taxpayer for the earned income credit, even though that child only lived with the taxpayer for 2 months, but died during the year. So if the child died during the year, that child is considered to be living with the taxpayer for the full 12 months.
Okay, thank you, Shelley. And then one other thing that came up on the chat was
Mhm.
about determining ages, and that, of course, is as of 12/31.
Yeah, everything as of 12/31/24.
Okay,
So again, asking the questions in March, you have to be very careful. how old are you? Well, in March, their age might be different. So it's important to get the age as of December 31st, 2024.
Okay. Thank you again, Shelley. We're
Thank
doing
you.
well on time. We're a little bit ahead of the game. That's good. We might end the day a little bit earlier.
That's always good.
Yeah, depending on how things go. It's like a couple minutes to 2 o'clock. Let's take a break until 10 minutes after 2. So 2:10. Let's take a break until 2:10, guys. Okay. We'll monitor the chat if you have any questions during that time. Thanks.
Yeah, Tom, can you hear me?
Yeah, I hear you.
Oh, Tom.
No, Tom, oh, sorry.
Yeah,
Hi,
Tom,
Emil.
some people have asked about the recording. When is this recording going to be available?
Probably maybe Monday, the earliest.
And that's going to be on YouTube, correct?
Yes.
And all they have to do is go on YouTube and it should be there, or do they need a special permission?
I think Dan is going to send out that link later on when
Okay.
I have it. It's probably the earliest is going to be Monday.
Okay. Yeah, so some people who have asked about this, and if you're still online, that is the answer to that question. Okay. So I have your handout up, Tomer. Hi, everybody. My clock says it's 2:10, and hopefully you're back from our little break. Just a couple things that came up during the break. Number one, somebody asked about when is a recording of this training going to be available? And Tom is our tech person. And Tom, would you like to answer that, please?
Most likely it will be on Monday. Dan will send out the email with the link, and then you should be able to play it on the YouTube on our YouTube channel.
Yeah, another tech question about CTA email addresses. Is it too early to ask about it, or what?
You would actually probably see an email from coming from me, and that would probably be Monday or Tuesday.
Okay, so once again, guys, based on what was said this morning, once our season is up and running, please communicate amongst ourselves with the CTA email address. Again, it's for privacy issues and things like that. One last thing that came up had to do with laptops. Please bring your laptops here when we talk about the computer program that we're going to use next week. We'll tell you how to access that. Okay. So let me just check the chat one more time before we turn it over to Tomer. And I think everything's okay there. So we're at a point, ladies and gentlemen, where we've talked about just about most federal issues. You have an idea of how to prepare a federal return and where the numbers are coming from and what the bottom line is and how we can make the bottom line better in a lot of cases for taxpayers. Now we're going to shift our focus to New York State, our state, and the tax issues regarding New York State taxpayers. And Tomer's going to take you there. Tomer?
Yeah, sorry about that. Yeah. Hey, everyone. Yeah, so as Emil mentioned, we just wrapped up the federal side of the tax compliance process, which is the starting point for New York State. So it was important to go through it in order to get an idea of how the New York State return works. So we'll start talking about New York State's return And now we could go to the next slide. I guess I'm not sure who's controlling. Yep. Yeah, so the way that New York State works, as does many of the states with an income tax, there's about 41 states in the country with their own state income tax, is that you start with the federal adjusted gross income, and then you make certain adjustments to the income to get to the state equivalent income. New York does the same thing. You know, there's some additions, some subtractions to get to the New York adjusted gross income. Then you take a New York standard or itemized deduction. And just because you take a standard deduction for federal purposes doesn't mean you can't itemize in New York, because they decoupled from the from most of the Tax Cuts and Jobs Act of 2017, as well as some other acts like the CARES Act. So because of that, they allow decoupling. It used to be that if you itemized on one, you had to itemize on the other, but now you can have different treatments. But anyway, once you subtract out your deduction, you get your New York taxable income, and then you calculate the New York State and, if applicable, New York City taxes based on the New York taxable income. Then we go to the next slide. So the next slide talks about, you know, different sorts of taxes. There's New York State taxes, New York City taxes, which primarily are for residents. The tax that we discussed, there is a, you know, non-resident tax for New York City, but that's for businesses, which we don't prepare for unincorporated businesses and general corporations, so that's outside of the scope. But yeah, the New York City taxes we're talking about are for New York City residents, per year or full year. And you know, you also have in Yonkers, they impose their own tax for residents similar to New York City. Yonkers is a like a city in Westchester, not far from New York City. It's, you know, in the vicinity of like White Plains and whatever in Westchester, not that far from the city in that general area. So once you calculate the applicable New York State and New York City or Yonkers surtaxes, you take out withholding taxes similar to federal withholdings. It's a refundable credit. You back out, you know, any estimates that were made by the taxpayer, if any, if, you know, they have investment income or self-employment income that requires to pay in estimates. Then you subtract also the New York State credits, refundable and non-refundable. And you know, similar to the federal, if the total of the you know, payments and credits exceeds the taxes due, then you would have a refund situation. If the payments and credits are less than the tax due, then you'd have a balance due situation. So that's similar to the IRS, the federal, so should be fairly straightforward. We go to the next slide. And in the New York State, they have a filing requirement, just like the IRS does. New York's requirement is that you need to file a IT 201, which is a resident return, or an IT 203, which is a non-resident or per year resident return, if the following are applicable. And that's if the federal AGI plus New York additions exceeds $4,000, you need to file. or, you know, if you're a dependent single taxpayer, then it's after $3,100. Or you know, the third option is if a federal return is required for some reason, like let's say they don't have any taxable income federally, but you know, they have to file an 8938 for informational purposes. Technically, you're supposed to file for New York. The thing is, even if you don't have any balance due or refund coming, you know, it's usually a good idea to file a protective return to start the assessment statute, because otherwise IRS or New York or whomever can come back 20 years, 40 years later and say, hey, why didn't you file? We think you owe tax, interest, and penalties because you never started the assessment statute. So as a general proposition, it's a good idea to file a return, even if it's a $0 return, just because there's no harm to doing so. You know, so as I mentioned, well, I forgot to mention that the 199A deduction, the QBI deduction that we talked about in the morning, is not applicable in New York. They decoupled, which means that they broke off from the federal treatment of QBI. They didn't want to give a deduction, so New York doesn't include in the federal AGI the QBI deduction in calculating the federal AGI. So there's a line that says like recomputed federal AGI when you look at the IT 203 or 201. And that's what they mean is they adjust for certain things, they decouple like the 199A. As I also mentioned, full year residents, you know, of New York State, New York City, and Yonkers file IT 201. The residency rules are very, they're not very complicated, but they're very involved. Basically, there are two tests for residency. You know, you're either domiciled in New York, which means that based on the facts and circumstances, and there are 5 criteria factors that they heavily weigh, like time in New York versus elsewhere, and business involvement and whatever. You know, based on the weighting of the factors, that you are domiciled in New York or you're domiciled elsewhere, and you must be domiciled somewhere. You know, you have to have an intention to live somewhere. That's basically the gist of that test. And the other test, which is the one listed on the slide, is what they call the statutory residency test, which is basically you maintain the permanent place of abode in New York for substantially all the year, which is more than 10 months, and that you were in New York for more than 183 days. They would say, well, even if you didn't intend to domicile here, you know, you're a resident because you were here for most of the year, and you know, and therefore we have the right to tax you on your worldwide income as a resident. And if you happen to be a New Jersey domiciliary, congrats, you get to pay tax in both states. So it's not a good situation if that happens, but I don't think that really happens with our clients. I see it often enough during my day job, so you know, that's not a good situation. But yeah, then the IT 203 is a par year non-resident return. So, you know, if someone moves in partway through the year and they move into the city, you know, they would either end up having to file an IT 201 if they were in the city or in the state for more than half of the year, or you know, or it's possible they'd be there for less. So let's say they moved in, you know, 60 days before the end of the year, they'd only pick up income tax for the last 2 months. as a full, as a part of your resident plus whatever they earned before they became a resident. So, you'd have to do an analysis, but that's something you will work with the site manager on because that's a more complicated issue since you have to allocate income during the resident and non-resident period. Let's see. Oh yeah. I had mentioned earlier in the federal section about the credit for taxes paid to other jurisdictions. And basically, that's a credit that when you're a resident of a state like New York or New Jersey or wherever with an income tax, because of the fact that they get to tax you on a worldwide basis, they can tax income you earned in in other states. So if you're a New York resident, they could tax the income you earned in New Jersey and Wisconsin, wherever. The thing is, because there would be double taxation and the other state has right to tax that income, they are obligated in general to provide you with a credit similar to the foreign tax credit to mitigate double taxation. So, the credit for taxes paid is a state version of the foreign tax credit, basically, and that's how you mitigate double taxation. Of course, New York's a high tax state compared to most other states other than California and maybe another state or two. So for most cases, you're gonna end up paying more tax probably in New York than you would in the other states. So, you may get the full credit, but you'll still owe additional tax in New York in a lot of cases, but that's neither here nor there. We go to the next slide. So the school district codes, those codes get put at the top of the IT 203 or IT 201. And they're just like a reference to tell New York State that, here's your resident district. There's a code for non-resident. I forget the code. I forget if it's like 000 or 099, something like that. And then for residents, you have various counties and the localities. So these are the 5 for New York City. Manhattan is 369, Bronx 068, etc. And that's not something you have to remember per se, but it has to be inputted correctly based on where the client resides. Yeah, for filing status, it's the same filing status as federal. New York recognizes same-sex marriage, so New York doesn't recognize common law marriage, unlike Pennsylvania and a few other states. Most states tend not to recognize common law marriage because it creates a lot of complexities when it's not formally filed with a courthouse or what have you, as a county clerk, whatever. So most states don't like dealing with common law, but someone, it gets kind of dicey. If someone was common law married in, let's say, Pennsylvania and moved to New York, it may require reciprocation, but I mean, that's a question for Shelley. But I wouldn't be concerned about common law issues that much because I don't recall ever seeing one at CTA. Emil may have seen one or two.
I have not told me, there are states out there that accept common law marriages. New York doesn't, and
Yeah, PA is the closest one that I know of that has common law on the books, but which is fairly close. But I mean, I don't think it happens that commonly because if you're in a relationship long enough, probably you're gonna file with the courthouse anyway and make it a civil marriage. But who knows? Who knows? So then the last comment is the starting point for is federal AGI, which we saw in the first slide, and then there are adjustments made So we can go to the next slide and discuss these adjustments. For the additions on New York, they increased the income tax base because they either say things that were not taxable federally are taxable here, or, or things that were deductible federally aren't deductible here or whatever. They're basically saying we don't respect certain things that are federal and we're gonna make you add it back. Subtractions is saying even though the IRS taxes it, we're not gonna tax it for whatever reason, which we'll see a few examples of shortly. Here are some of the examples. So New York State and New York City requires that government employees of New York State, New York City, and other localities add back 414H contributions. Those contributions are for government pension plans. The theory is that they say when you take out the distributions later, you're not going to be taxed on it because it's a New York State, New York City government pension. We exclude all of it. So because we don't tax you 20 years down the road on it, we're going to tax you on the contributions. You don't get to avoid taxation. It's not like a 401k or whatever, which would be limited to the 20,000 exclusion. So that's why they add it back. And similarly with New York City's employees, they add back cafeteria plan contributions, IRC 125 contributions, which are listed on the W-2. Both of them are listed, usually I think box 14, right? Not 12. Yeah, they're box 14, I'm pretty certain, because they have special codes written and it'll say like 414H, 125, cafeteria, what have you. And then, so the next thing is, as I mentioned, if you're over 59 and a half, and you get a distribution from a pension plan, a 401k, whatever, you can exclude up to 20,000 each for the taxpayer and spouse, although you can't combine it. So let's say one taxpayer, has a $10,000 pension and they use it, the extra 10,000 can't be given to the spouse to shield their 25,000. They are still limited to 20. It's use it or lose it. So, the exclusion there is limited. And as I had mentioned before, I believe that there's also a rule that you can get, depending when the decedent died, you may be able to exclude part or all of a pension up to 20,000, from a death benefit. So if you inherited an IRA of 7,500 and you're the only beneficiary and whatnot, you may be able to exclude the 7,500. If there were two beneficiaries, each of you could exclude up to 10,000, 20,000 divided by two, etc. So, it would depend on, how the death benefits are being split between beneficiaries, but you may be able to exclude it even if you yourself aren't 59 and a half, because you inherited from someone that was 59 and a half or older. And then pensions from the federal government, New York State and New York City and other municipalities in New York are fully excludable, 100% excludable from taxable income, regardless of the age you start taking. So let's say you retire from, New York City Department of Finance at 55 and you start taking out. Federally, they would say, well, that's an early withdrawal. Here's a 10% surtax penalty thing. And New York State would exclude all of it, so you could have a different treatment, because in New York, they won't tax it regardless of the age of distribution. The IRS would say you still have to hit 59 and a half. That's, the key age to avoid early withdrawal issues for federal purposes. In pretty much all cases, there could be disability and a few other situations they exempted, but it's not a huge scope. As I mentioned this morning, interest income on US government bonds is a subtraction. As I mentioned, US government interest is federally taxable, but non-taxable by New York or any state, because like US territory bonds, it's exempt under, I believe, Title 4 of the US Code from taxation by any state or locality. And that's that. And then it says here, interest income on non-New York State, city, and other New York local bonds. It should also say US territories, because that's, Puerto Rico, Guam, whatever is also exempt, but you'll pretty much, if any, see Puerto Rico bonds. You don't see as much US Virgin Island or Guam or whatever bonds, but they technically are exempt too for New York purposes. So they wouldn't be added back. But if, let's say, it's a Wisconsin bond, it would be added back because it's not protected by federal law. The supremacy clause doesn't protect those bonds from being taxed. Let's see. The next thing is that New York, like a lot of states, fully excludes Social Security benefits in full. So if we have a client that has, let's say, a 50% taxable Social Security benefit for federal purposes, the remaining 50% that was taxable on the federal return gets subtracted on the New York return, so none of it's taxable. Or if it was 85% federal, the 85 is subtracted on the New York. 0%, obviously no adjustment is needed. So New York doesn't tax it, so it's a subtraction to remove Social Security in full. State refunds are not taxable on the state level. The reason the New York State and other states don't tax the refunds is because they don't allow a deduction in the itemized deductions for state and local income taxes. So therefore, they don't recapture it as income because you didn't get a tax benefit on the state level. You didn't reduce the New York State income tax due by deducting, New York State income taxes paid. They won't let you do it to reduce the tax base, basically, to create a timing situation. And then contributions to a 529 savings plan. So with a 529 savings plan, it's not a retirement plan, it's an educational plan. You set up the plan, most states have it. Basically, it's to save up for college tuition. And people like setting it up for two reasons. One, because they want to put aside cash to accrue for the kids going to college eventually. And second, there is a tax benefit, which is that you're allowed to deduct up to $5,000 if you're single, or $10,000 if you're married filing jointly, on the IT 201 or 203 to reduce the taxable income. So, people like doing it. And you can only claim it. It's on a cash basis, so you can't say, well, I'm accruing, 5 years of contributions this year, so I'm going to deduct, based on that. You have to actually pay it. So there's actually a gift tax rule federally since New York doesn't have a gift tax, a federal gift tax rule where you can spread out a gift over 5 years and prepay it in the first year. So in that case, like, let's say federally, it's an $18,000 exclusion. So that'd be a $90,000 gift. If you make a $90,000 gift, you're only getting, the $5,000 or $10,000 deduction the first year. You don't get the 5 or 10 for all 5 years. That's the downside of prepaying the gift, but there are people that want to prepay it so it can accrue more value. So that's the trade-off, is not getting the state tax benefit in the subsequent years. And the deduction, can't be carried forward. It's a deduction. It's not a credit. It's not a refundable credit or a non-refundable credit. It's a deduction. And, the taxpayer has to be the owner of the account. So, if, I have a niece, so if I contribute into her 529 plan, I don't get the deduction because it's under my brother and sister-in-law's, or my brother's name or whatever. So, I would effectively, the best way to deal with that is to give the money to the brother or whomever the account holder of record is, and then have them make the contributions because they can get the tax benefit. You can't. And then distributions from 529 plans, it works similar to other distributions like HSAs and whatever. If you use it for the qualified purpose, then it won't be taxable. If you use it for a non-qualified purpose, like you take the money out and buy a Ferrari with it, it's going to be taxable because it was used for non-qualified purposes. And so it becomes an addition to income. That's what the note at the bottom of slide number 6 is talking about. And that's how that works. Does anyone have any questions about what I discussed the first 5, 6 slides, or should I continue?
Nothing in the chat, Torrin.
Okay, so yeah, I'm gonna keep going. So the next slide talks about the different types of standard deductions depending on the filing status. And that's you can read the amounts. It's less than the federal, but it's not insubstantial, but yeah, it's lower than the federal. And as it says, you can alternatively itemize under IT 196, which we'll talk about shortly, about itemized deductions. But yeah, the next slide talks about exemptions. So federally, there used to be exemptions until the TCJA. They got rid of it and increased the standard deduction. New York never allowed the taxpayer and their spouse of filing joint to claim an exemption, but the dependents can be claimed $1,000 apiece, which reduces the taxable income on top of the standard or itemized deduction. And that's something that's been around forever. Sales and use tax, rather use tax. So with use tax, basically everyone knows what sales tax is. It's a consumption tax. You go to, Shake Shack, you buy a burger and fries and the drink, for whatever, $10. And it's more than that, obviously, but $10. And they charge you 8.875% sales tax for New York State and City. So that's whatever, 88 cents, rounded up, of sales tax on the purchase. Now, the flip side of sales tax is if you make a purchase and they don't charge tax, the vendor, when they should have charged tax, then you owe compensating use tax. And what that basically means is, let's say you buy off of the internet from company that's not Amazon or a big retailer that says, we don't make enough sales into New York to have to register to collect tax. We're selling you a book, and the book is a taxable item in New York, for $100, we're not charging you tax. So, if you live in New York City, it got delivered to New York City, you would owe on the purchase, $8.88 rounded up. And, you don't need to file a separate sales tax return to, self-assess and pay the use tax. You simply add it on to the tax due on the IT 201. This is for residents, because for non-residents in New York, they would be subject to their own state sales tax regime, since it's dependent on what they call physical nexus, physical presence, and bless you. And yeah, I mean, the long and short of it is that, in most cases, clients are going to say, well, I bought it off Amazon, or I bought it in a local store and they charge sales tax. And you'll say, okay, then it's zero. But, technically, if there was a material purchase, you need to report it. Of course, New York is very aggressive. I have high now wealth clients, they've bought whatever, $100,000 paintings, and they get the shipping manifests in New York State because they get it as part of the Port Authority when it gets shipped in by plane or boat or whatever. And they say, hey, you didn't report this use tax on the 100,000. We think you owe us, you owe us like $8,900 in interest and penalties. What do you think, buddy? And then, you have to have a nice conversation with them. So, if it was a material thing, that'd be one thing, but most of our clients are not going to make big dollar purchases like that where it becomes a problem. So yeah, I think that's it for that slide. So we could go to the next slide. The next slide talks about some of the credits, and it's talking about refundable and non-refundable. Non-refundable, as lowers but doesn't go beyond eliminating the income tax due. So you have $100 of tax, and you have, and $200 in non-refundable credits. You use up the 100, and the remaining 100 generally goes into the ether, unless it's a foreign tax credit federally or some other credits that you can carry forward for X amount of years, 10 years for the foreign tax credit. But yeah, in this case, with New York, the household credit is just a credit based on income levels. Software automatically calculates it if you're entitled to a household credit, and can't be claimed as a dependent, which is the case with pretty much every credit that I can think of. Is you can't be claimed as a dependent, since that kind of precludes claiming credits. And if you're filing separate, you're supposed to allocate based on the income of the other spouse, the proportionate, like if you have $100 of income and they have 50, 2/3 may go to you and a third to them. That gets kind of confusing, but that also is kind of the case with the real property tax credit that we'll discuss in a bit. The resident credit I spoke about, so I'm not going to belabor the point. Then there's some other refundable credits, the volunteer firefighters and ambulance workers credit. Honestly, I've never seen it in practice. I think Emil may have seen it 2 or 3 times. He can, chip in, add his thoughts, but it's very rare. I haven't really seen it. because you have to be a volunteer firefighter or ambulance worker to claim the credit. So I don't know,
And live in the city too.
and live in the city, so, you know, so you're probably not gonna see it, but who knows? If you see it, I guess you could get the manager involved to read the instructions for the IT 245 and fill it out. There's, the Empire State Child Tax Credit, which is the state equivalent to the federal child tax credit. And there's some requirements, full year resident in New York, you claim the federal child tax credit and the qualifying child. The child was under 17 as of December 31st, and the credit's a greater of $100 times the number of qualifying children, or 1/3 of the federal child tax credit and additional child tax credit. So, it's a smaller version of the federal child tax credit. And similarly, the earned income tax credit is similar. It's 30% of the federal earned income tax credit generally. And, non-custodial parents may be able to claim the credit if certain requirements are met, which is on the next slide. And the next slide, lists it out. You have to be a full year resident and at least 18 years of age. You have to have less than $49,084 of income, earned income in the year. You have to have a minor child that doesn't reside with you, but you need to have an order for at least 1/2 of the tax year, requiring the taxpayer to make child support payments through New York State support collections. So, you have to be supporting them, legally through child support payments, an enforceable child support agreement with the courts. And you have to, have paid in 2024 at least equal to the amount of required child support. So you can't be a deadbeat not paying, the child support and what have you. It's an incentive that you do the right thing. It's basically incentivizing people not to stiff on child support payments. So that's the last criteria. And we could go to the next slide. The child and dependent care credit is 20% of the federal credit. And it lists out there how much in expenses you can claim based on the qualifying persons. I won't list them out. The New York State, the New York City school tax credit isn't actually a like school related. It's basically a credit for New York City residents for the fact that you resided in New York for at least a certain part of the year in New York City. And so it's up to 6,250 individuals, which get rounded up to $63 or $125 for a married filing joint. And it gets prorated based on how long you lived in the city. And yeah, and there's a requirement also that you can't potentially be claimed as a dependent, because if you can be claimed as a dependent, you're not entitled to the credit, basically. So even if you don't get claimed, if your parent says, you know what, I'm not gonna claim my kid, they'll say, we're disallowing it because you could have been claimed, but you weren't, and they just basically did it to give you some free money, but you're not entitled to it. You have to be free and clear. And it says at the bottom, if inputs done correctly, TaxSlayer will generate all credits, which is correct, because it'll flow through from the federal information for stuff like the EITC and the child and dependent care credit and what have you. And school tax credit will be automatically calculated based on full year or per year allocation as applicable. And the next slide is,
Yeah. May I say something, Tomer?
Yep,
Quickly
Yep.
going back to the child independent care credit, it's not really listed in this slide, but I think it's important to know. It says 20% of federal credit. You should write the word allowable federal
Yep.
credit, because in some cases, the federal tax credit is not used in full, but whatever is generated, whatever that credit is, then 20% is New York's portion. So it's a slight distinction that I think you guys should be aware of.
yeah, that's fair. Yeah, so I guess the next thing is the college tuition credit or itemized deduction. The college tuition credit is, the state version of the education credits. At the federal level. It's, primarily it's linked with the American Opportunity Credit. Since it deals with rules about, qualified tuition expenses paid for undergrad at an institution of higher education during the tax year. It's up to 10,000 of tuition expenses. Credit is refundable, 4% of the tuition expenses, so that would be, $400 if you pay at least 10,000 of tuition expense at maximum. The alternative is you can claim, an itemized deduction for the tuition expense, additional itemized deduction, which may provide more of a tax benefit because itemized deduction would reduce the, the taxable income dollar for dollar, whereas, 4% refundable credit is up to $400 refundable credit. So it would depend if, you'd have to optimize it. I don't know if the tax software actually does an optimization, if it runs it both ways, or you gotta flip one or the other. Emil, do you know?
What's the question again?
Like, does TaxSlayer optimize the itemized deduction or the credit
No, we have
claim?
to calculate it both
You
ways.
have to manually calculate.
You have to
Okay.
calculate it both ways, yes.
Yeah, because I mean, like the professional software I use does the optimization itself, but obviously TaxSlayer, it's not a pro software, the version we're using, so that's probably why we have to run the numbers both ways to see which is more beneficial. But yeah, I mean, the if the tuition is under 5,000, the credit is lesser of 200 or tuition expense. The expenses, could be paid, by cash, check, card, or with borrowed funds. Yeah, I guess I'm not sure. They're saying if you gave like a ring that it wouldn't qualify. I mean, I don't think schools would accept, for the most part, non-cash items or cash equivalent, but who knows? I mean, if you donated a building, I guess, but then that would probably be a charitable contribution anyway. Eligible student doesn't need to be enrolled in a degree program, or to attend full-time to qualify. So yeah, you could have, part-time students and still claim the credit. And if student is claimed as a dependent, the payments that they make are treated as paid by the parent, by the taxpayer claiming them. And you have to put the identification number of the student and institution, which I think is the case federally too, or else they'll disallow it. So I think it's the same rule. Yeah, so I think that's it for all the credits other than the real property tax
Yeah.
credit. Are there any questions or comments? before
Nothing in
we
the
go
chat,
on?
but I'd like to say something, Tomer. I want to focus on the bullet point. The next to last bullet point says the eligible student doesn't need to be enrolled in a degree program or attend full-time for the expenses qualify. Now, this wasn't really stated in my presentation on the refundable and non-refundable credits because I was going to wait until a little bit later when I review the CTA forms with you. When it comes to the American Opportunity Credit,
one of the criteria states that
Yeah.
the student had to have been enrolled at least full time in order to claim the American Opportunity credits. It's a little bit different here in New York. The student could have taken only one class, but it had to be for undergraduate purposes. So even though
Yeah.
the student was not considered even part-time for purposes of federal credit, the fact that he attended one class at an undergraduate school during the year means he can potentially qualify for the New York State version of this tuition credit. So you might see some instances where the person will not get the federal education credit, but might get the New York State education credit. So keep that in mind.
Well, the thing there is, I mean, that situation, maybe they qualify for lifetime learning, which is non-refundable federally, but they would still qualify for the refundable college tuition, because that criteria basically implies that it would allow for some lifetime learning cases, right?
It could happen, yes. So just the point is to think of the interplay between these refundable federal credits and the New York State refundable credit, and the rules are slightly different.
Yeah, they're not the same. They're similar, but not the same. Some parts overlap. So yeah, and pretty much the bulk of the rest of the slides is on this, which is the real property tax credit, which is a refundable credit, for both renters and homeowners who pay property taxes. There used to be both a New York State and a New York City real property tax credit, but the New York City one expired, I guess 4 years ago or 5 years ago at this point. The New York City one, more people qualified than the New York State. It had higher income thresholds and so on. It wasn't as generous if you qualified, but you could get like $5, $10, whatever. And the New York State one, it gives more generous payouts, but the income limit is a lot lower. So, not as many people qualify for it comparatively, but those that do tend to get better, refundable credits. Anyway, the credit can be as high as 375. It depends on the, combination of factors, primarily the income, the modified income, which we'll talk about, as well as, filing status and some other things about the residents and what have you. So we'll go through the next slides and explain how it works. So the criteria, as I mentioned, it's tested based on gross income, but unlike the actual income tax return, it's on what they call a gross household gross income, which means it's not just you, it's everyone in your household, and we'll define shortly what a household means, but you will have to factor in everyone's income in the household to determine if you qualify for the credit for where you reside. And then there's a question about where the taxpayer paid the rent to. That's relevant because depending where it was paid to, if it was excluded from New York State, New York City property taxes, it would not qualify for the credit. So that's pretty much NYCHA housing and maybe a few other building, arrangements. Primarily it's NYCHA. People think that Section 8 housing is also exempt, but it's not, because that's a federal program. New York State and city doesn't exempt it. It may encourage people to do Section 8 housing, but they're not giving them abatements, exemptions from property taxes. They get other benefits, so they still qualify for the real property tax credit. Is a taxpayer dependent of another? As we've been saying, pretty much every credit, if you could be claimed as a dependent, typically that disqualifies you even if you didn't get actually claimed. Where did the taxpayer live? There's two questions about that. and whether you owned or rented the property, you have to either be owning it or renting it. And either way, as long as you're making the payments, or at least part of the payments and whatever, you can claim at least a partial credit. So let's go to the next slide.
Well, excuse me, Tom, before we do, you'll see next to some of these bullet points, Q1 and Q8, for example, Q2, et cetera. That refers to questions on our checklist. So if
Yeah.
you want to, open up the CTA forms folder and look for the checklist and look at page 5 of the checklist. And these references are to the questions on that page 5 of the checklist. I was going to go through this a little bit later when we review all of the CTA forms and materials. So that's what that means, guys.
Yep. Yeah, so there's a few more questions on the checklist. For homeowners, what is the value of the taxpayer's property? There's a relatively low threshold that they have, that it has to be, the maximum. So especially with price inflation, most places don't really qualify for it nowadays. So you're more likely to see a renter qualify than a homeowner, other than maybe somewhere upstate or wherever, lower property value area. Did the taxpayer or spouse pay property taxes? Obviously, if they're a homeowner, they should be paying property taxes. If they're a renter, did they pay rent? Reasonable test. What that basically means is that, if someone is saying, I earned whatever, $1,000 this year, and the rent alone is like 5,000 a year, how are they living? Are they living off savings? Do they get gifts from friends and family? It's a smell test, that it's not a fishy situation, that they're not trying to like maximize the credit like some people try to do with the earned income credit, trying to optimize, the refunds by claiming that this is the situation. So as long as it passes the smell test, then the reasonableness test more or less is passed. And then there's an average monthly rent calculation that needs to be done, which is the 12th question, which we'll get to in a bit. But you have to basically annualize the rent to figure out whether the rent paid and the income on the table, where you end up if you get qualified for any credit, and if so, how much. So we'll get to that in a bit, but we go to the next slide. Yeah, so the household gross income, you start with the federal AGI, and you add the adjustments, the additions, and you also add non-taxable income. As I had mentioned this morning in the gross income, SSI is includable for the real property tax credit, even though it's not federally taxable. The Social Security benefits is added, even though it's not taxable on the New York return. They don't tax it at all. Public assistance, child support, and non-taxable pensions, federal New York State and New York City employee pensions are also not. And then you don't include food stamps. Food stamps, SNAP is exempt from this calculation, but pretty much all of the other benefits are includable. So, the other public assistance benefits are includable. So, then this calculation is not just done for you, the taxpayer. I think we go to the next slide. It's not just you, the taxpayer, but also everyone else in the household. And the way that the statute defines a household is where one or more persons live together and share the same entrance, kitchen, living room, and other facilities. So, if you live in a, how do I put it, a boarding house where there's like a, I don't know, a common, living room and kitchen and whatever, and there's 4 mini apartments around it, that's the 4 of you are probably a household, whereas if you live in a normal condo or co-op where, yeah, there's a, common area here and there, that's a different situation, because then every apartment is its own household, because you have your own kitchen, you have your own bathroom, whatever, it's its own habitable space. It's not that the habitable space is including shared areas. You have your own living space. So it would depend on facts and circumstances, whether a household is 1 person, is 4 people, is whatever. You'd need to gather the information about the household, the nature of it, and you know, uh, and as I had mentioned before, it's a very low income threshold. The household's gross income cannot exceed $18,000, which basically is not inflation adjusted. I mean, $18,000 today. I mean, even most Social Security beneficiaries are probably getting, let's say 10 to 15,000. If they have a bit of income elsewhere, like a small pension or whatever, it probably pushes them over the edge. As I said, New York State's credit is not as generous as the city one was, but that's unfortunate, but that's the rules, that's statute and regulations. We could go to the next slide. So as I had mentioned already, someone in the household must have paid rent. That's obviously required, because you either pay rent if you're a renter, or you pay property taxes if you're the taxpayer, in order to claim the credit. Otherwise, you wouldn't be able to claim the credit because you didn't make the payment. Sorry. And then, as I had mentioned, where you paid it to is just as important. NYCHA, certain nursing homes, etc., are exempt property. There's a website, I forget if it's a DOF website or whatever, that tells you the taxable status of the underlying building, so you can look up to see if it's exempt from property taxes. For whatever reason. Emil, you know the website I'm talking about, right?
Yes, I do. And the way to access that website and to navigate through that website is in the Ready reference. We're going to go over that a little bit later. I believe it's page 6 of the Ready reference. It'll give you the steps involved in looking up the taxability of a building, whether or not a building is paying property taxes.
Yep. Okay, so yeah, so that's for that slide, and then you go, let's go to the next slide. So when you're talking about rent, you want to know how the rent was paid, because there are situations where, the question becomes, did, let's say the federal Section 8 program, did they give a check to the tenant and then the tenant gave a check to the landlord, or did Section 8 give it directly? Because strictly speaking, the taxpayer themselves are the one that are supposed to be furnishing it, not the public assistance or the Section 8. So if it's being paid directly by the government agencies, then, they're probably not going to be considered having paid the rent themselves. Whereas if they get the funds from the agency and they turn around and use the funds to pay the landlord, then it would be viewed as them paying the rent. I guess the next slide we could go to. If, the question here is the taxpayer dependent of another? That's been the case with every credit we've talked about. If you're a dependent, or in most cases, if you could be claimed, even if you weren't, you're not going to be able to claim the credit, because you have to be independent to be claiming pretty much every credit. where did the taxpayer live? You know, you have to have lived in New York for the entire year and must have lived in the same address in New York for at least 6 months. So there's two components, you know, you have to be a full year resident and also have lived in the same place for at least 6 months. So if you move every 3 months, you're not gonna qualify, but you know, people generally don't voluntarily move, you know, that frequently. You know, it does happen, but you know, that they're basically saying you gotta be in a given place because effectively we're giving you a credit as though you paid the underlying property taxes and we're refunding you part of it. So if you move every 2 minutes, then you didn't, you're not really living there long enough to say that you're entitled to a portion of the underlying property tax being refunded. The taxpayer owner rent, as we had mentioned, you know, you qualify either way. For homeowners, the property value has to be 85,000 or less, which is why I was saying for most homeowners, they're not qualifying for the credit in New York, because other than maybe some places upstate in less populated areas, you're probably not finding a whole ton of $85,000 houses or apartments in New York, especially not in the city area in Long Island and what have you, Westchester. You know, for renters, we could go to the next slide. For renters, did the taxpayer or any other household member pay the rent? Yeah, so you know, the thing here is that let's say I file an IT 201 and I have a household with two other people. I don't need to pay the rent. Someone else in the household can. But you know, the thing there then is that you would have to make an agreement with the other parties on how to split the credit that's calculated. Is it, especially if you didn't pay it, technically the one that paid it may say, you know what, I'm claiming the credit because I paid it, you know, but you know, you can negotiate amongst yourselves to split the credit, but you know, you have to negotiate. You can't double and triple dip on the same credit. That's basically what this is talking about. And then yeah, that's what this is explaining, is that you can split the credit, but you know, if you're not paying, then it's not a great situation. Because then you got to get their consent. We can go to the next slide. A reasonable test, you know, I had mentioned before, it's a smell test. Does it make sense? Do the numbers jive? Is there something really weird here? Which is really something we should be doing in general. We think someone's trying to optimize the earned income credit, you know, it's a similar situation. If it looks very convenient, you know, it should raise flags, you know. You know, can you get the maximum earned income credit? Yeah. Can you get the maximum real property tax credit? Yes. Is it likely? Probably not, but never say never. But, you know, you have to see if it makes sense, if everything pieces together in a reasonable manner, if it seems like it was just optimized artificially, you know, to file a false return basically and claim the maximum refund. So, you know, that's what this question is talking about. And we could go to the next slide. So for renters, this is how you calculate the average monthly rent, which is used in the calculation of the credit. You know, you're on a cash basis of accounting. As a general principle, individuals are on a cash basis. That's where when you pay something, you know, that's when you get to deduct something. When you receive something, that's when you've earned the income, as opposed to accrual, where, you know, you either earn the income before you get paid, or, you know, someone did the work for you and you get a deduction before you pay because now it's a liability, etc. I mean, that's a timing issue, but is a general proposition, individuals, you know, are on a cash basis, you know, they could be on accrual for their Schedule C for their self-employment, but that's a different discussion than the credit here. So taxpayers are on a cash basis. And so it's dependent on when the taxpayer pays rent. It could be for more than 12 months, for less than 12 months. And the way it works is you simply you add whatever rent was paid. So if, let's say, 5 months, you paid $100, which is $500, you don't pay for 3 months, and then you pay the last 4 months, you know, 150, that's $1,100 over 12 months. So then you divide that by 12 to get the average monthly. And if you happen to actually pay more than 12 months, then you would still divide it by 12. It would increase the amount of rent paid because you'd be including more rent per month in the calculation, but that's how it works. It could go either way. And then, yeah, the next question, it says, you know, did the taxpayer or spouse pay the taxes? You know, one or the other must have paid the taxes, which is also the case when you're deducting real property taxes on the federal level or state level as an itemized deduction. You actually have to pay the taxes, pay the mortgage interest, in order to deduct the in order to deduct the actual you know, itemized deduction, or here to potentially claim a credit, you actually have to pay it. You know, that's always a requirement for these sort of things, so it's relatively explanatory. I think that's it for the real property tax credit. Any questions or additional comments that you want to make, Emil, about it, the RPTC? Emil? You there? Oh, all right, well. Okay, I guess I'll keep talking. There's some miscellaneous things on the last slide or two. You know, what else you should know, you know, on the New York State returns for the last decade or so, they've been requiring you to input certain information over from your driver's license or state non-driver's license ID in order to e-file it, or you have to mark that there is no driver's license or whatever. You know, if they don't have it, technically they were gonna eventually start matching it to a database, a DMV or whatever database, but they never did because there was litigation threats and whatever, but they still kept in the input and require you to either put in the ID information or or the you know, no ID or whatever to make it e-fileable. So that's what the comment at the top is. You know, and then it says, you know, W-2s don't need to be attached to the return anymore. Instead, you populate the IT2, which should be done when you fill in the W-2 section. It should flow through a copy on the IT2, and that's how New York will accept the W-2 equivalent on, you know, the IT 201 or 203. And similarly, you know, the 1099-R for pensions and unemployment, well, 1099-R for pensions, unemployment's 1099-G, etc., will also have similar generation of forms and whatever. They don't need you to staple copies of them anymore in order to generate it. So it should be generated by the software. You used to have to attach the copies of the W-2 and the 1099-R and whatever. And yeah, there are state equivalent forms the software will make, assuming you fill in the input correctly. So it shouldn't be an issue. If you're gonna paper file, you know, you may need to sign multiple forms and schedules. The mailing address, you know, the IRS and the New York State are two different taxing jurisdictions. One is federal government, one is state. And you know, they have different mailing addresses. And you know, IRS mailing addresses are all around the country. It could be Kansas City or Ogden, Utah, or Austin. You know, I don't know. I don't recall ever seeing a mailing address for a 1040 for the IRS in New York. I know they have Brookhaven and whatever, but that's to do like offers and compromise or other issues, not processing returns, as far as I'm aware. New York, you know, is got Binghamton PO boxes and whatever for mailing addresses. So normally, if you see a mailing address that's in New York, it's probably a Department of Taxation and Finance address, not a IRS. But you know, you have to also see who it's addressed to, either, you know, Department of Treasury, Internal Revenue Service, or New York State Department of Taxation and Finance. And then, yeah, I guess that's it. Anything to add, Emil?
No, I don't, Tomer. I thank you so much for guiding us through these topics. Very important. We're coming towards the end of our day, ladies and gentlemen. I think at this point, if we can take just a quick 5-minute break, just have to do a little bit of preparation for the last part of the lecture. So let's reconvene at 3:30. I have 3:24 right now. Let's make it 3:30, okay? Tom, can you hear me?
Yeah, I can.
Yes, so I'm gonna stop this share. So if you can get back to this federal outline, and then I'm gonna need to call up something, but from this point on, you're gonna be responsible for calling up most of these things and sharing most of these things. Are you okay with that?
Okay.
All right, thank you.
Emil, which slide are we up to on the federal return?
Yeah, so go to slide 51.
Okay.
And then after that, just need you to share some of the various forms in the folders. So after that, we're going to review all our CTA forms and stuff. Okay.
Okay.
Okay, guys, we're back. It is now 3:30 and we're at the tail end of our day, and maybe there's a good chance we can stop and complete our work a little bit before 5 o'clock. Hi, guys. We've been talking about a lot of tax rules. We refer to various forms. But now this part of the lecture, and it's going to take a minute or two, we're highlighting a form. We think a very important form on the federal side. We're back now on the federal outline, and we're on slide 51. And the reason why we're taking a minute or two to highlight this is for what's going to happen next week when we do our computer class. We enter a lot of numbers in the computer program. It calculates certain credits, and it makes certain determinations based on our input. For example, the earned income credit, American Opportunity Tax Credit, et cetera, the things you see on this slide. Tax layer program will automatically calculate these things, but it's based on evidence that we're providing through this form 8867. And maybe it's just a shortcoming of the program is this program will calculate these credits that the person is entitled to, the taxpayer is entitled to, but this form serves as the backup to those calculations. It's what's called the due diligence checklist form. So in some cases, the tax lien program is calculating the amounts, but this form has to be prepared to be filled out in order for those credits to be acceptable by the government. If you were not to fill out this form and submit the return, you could, but the government would not accept our results, and might reject the return or might not give the person credits that he might be entitled to. So I want to make sure that you're aware of this form and make sure you fill out the questions that are on there. And I'll show you how to access this form next week when we do our computer class. But Tom, that form itself is in the federal forms folder. If you want to show it a little bit quickly for everybody, that'll be great. 8867. It's somewhere there. Yeah, so this is the form itself, guys. But again, you access this through the tax layer program. And again, all of these questions have to be answered in order for the taxpayer to qualify for those credits that most likely he's entitled to. And again, I'll show you how to input that next week when we do our computer class. So please be aware of this and make sure you do this for all the taxpayers who qualify for those various credits you see on slide 51. Okay, Tom, thank you for that. All right, we're at a point now, ladies and gentlemen, where I promised you that we would go over all of the things that are in our folders. We're going to do this right now. So on the very first slide in the federal outline, we talked about the various folders that we have with all the information. So let's go through that very quickly. We don't have to, yeah, if we can go there, Tom, the very first slide, if you want, on the outlines, 24 outlines. Yeah. So, of course, you see the outlines that are in the outlines folder. The only two you should see there is the federal and state, and we've done that. Now let's go to the next, the federal forms folder, federal forms and publications. Okay. So again, we've downloaded all the federal forms that we think is important for you to look at. A lot of them were mentioned by Tomer in his income section. We talked about the 1040 form being the summary of all of our calculations. We don't expect you to memorize these forms, but if you want to review various forms in terms of some things you might see in your travels with CTA this season, by all means, review this folder. I think in particular, if you were to go through this folder, I would pay particular attention to the 1099-R form. That is very important. You will see that a lot for people who are retired. We talked about the importance of looking at certain code numbers and certain boxes. So we've given you the 1099-R form and the instructions to it. Another very important publication that's in this folder that is there, it's called Publication 17. It is an excellent, I want to emphasize the word excellent. It's there somewhere, Tom. There it is. It is an excellent reference guide to answer your questions regarding a federal return. In other words, it's taking what we've had in our outlines and it more or less fleshes out some of the points that you might have questions on. So I would recommend you really looking at that reference guide, Pub 17. It is very, very good. A while ago, at least 10 years ago, there was like a hard copy version of it. They no longer make hard copies of this publication, which is a shame because it should be right next to you every time you prepare a return. Okay, that's more or less what I wanted to highlight in this folder. Let's go next to the New York State Forms and Publication folder, Tom. And in here, again, we've downloaded certain New York State forms that we think are important for you to see. Some of them Tomer mentioned in his New York State lecture. I don't expect you to look at every one and memorize everything. One thing I want to highlight is a publication that talks about retired people, elderly people, and how you treat certain tax issues related to elderly people. For example, it fleshes out the rules on pension distributions and the 20,000 exclusion. It's there somewhere, Tom. I believe I downloaded it. It's somewhere down there. Let's go down. That's it. The last one, publication 36. So that's really important, I think, you guys to look at. Again, it's really focuses on retired people or elderly people or people who receive pensions. And if you can tell by going back in that folder, some of the forms that are there are still in the draft stage. In particular, NYC 210, as of now, even today, there's not a final version out of it. And we talked about NYC 210 being a form that you can prepare manually by hand, depending on tax circumstances, depending on how much time you have available, depending on the taxpayer itself. So If and when we get final versions of these forms, we'll try to let you guys know about it. Okay. Next, let us go now next time to the folder. It's called the checklist. Well, yeah, there it is. It's under the CTA forms folder. And we talked about each and every return, no matter how complex, no matter how simple. Every return that you prepare for us in CTA this year, guys, has to have this as backup. It's called our checklist. It is evidence that you've prepared a complete and accurate return. And this checklist is 6 pages long. We try to develop this checklist to more or less conform to the presentation of the 1040 form. If you remember this morning, we talked about the name of the taxpayer on the top of the form. We talked about the filing status, income items, etc. More or less, we tried to mimic the presentation of those items on the 1040 here on our checklist. For example, you see towards the top of page 1, name of the taxpayer and social security number, dates of birth we need. The storefront or top right there, we need to know what storefront you're working at, be it the Fountain House location or some of the others. We need to know the address, left-hand side there, current mailing address, and if the taxpayer moved during the year, what is the mailing address they want to use, or, okay, that's a difference there. Towards the middle there, we need to ask about dependents. You list all the names of the dependents there. Information about their numbers, social security numbers, dates of birth, et cetera, et cetera. And then towards the right of that, that little section there, you see those little boxes. You know, again, that's for my pet topic of whether or not the person listed here is a qualifying relative of the taxpayer or qualifying child of the taxpayer. In some cases, it could be neither. It could just be a household member. A little bit down, you'll see filing status. And again, it's your decision based on the interview with the taxpayer of what you think this person's filing status is. We do know during our filing status lecture that filing status is based on marital status. So what is this person's marital status as of the end of the year? Indicate that by those check marks, the boxes towards the left of that amount. It says, as of December 31st, 24, the taxpayer is so-and-so, okay? Towards the bottom of page 1 of the checklist, we're asking certain questions that are important to us. Those first 2 questions on the top there talk about the digital currency question and whether or not the person has foreign bank accounts. So make sure you answer those questions. Again, when it comes to foreign currency, the stance of community tax aid is we will not prepare a return of somebody who has foreign currency. We want to know whether or not the person was with us last year, and if not, how did they hear about us in terms of our outreach, in terms of how they heard about us. We need to know how effective our outreach is. So we need to know that. Did they prepare a return the prior year? You might have to prepare a prior year return. Did they get any letters from our good friends in the government? What's the language they speak at home? And maybe English is not their first language. We need to know their email address and their phone numbers. That way, it'll be easier for us to reach out to them during the tax year or even next year. Is this person a dependent of someone else? Question 4 there towards the bottom, Tom. You see it there? So again, oh, no, a little bit up. There you go. So again, if this person is a dependent of another one, we know that person can't claim other people as a dependent. It affects his standard deduction amount and things like that. Identity theft victims, very important. Some people who are identity theft victims, especially on the federal side, will get a special PIN number that's supposed to protect their identity when they file a federal return. So if someone has been identified as an identity theft victim, they should have gotten a PIN from the IRS. And we need that PIN in order to electronically file a return. If the person is an identity theft victim and doesn't have that identity theft PIN number, we can only prepare a paper return on this person, not an electronic return, okay? And
sorry, I was gonna mention that technically the clients can set up an ID me account on irs.gov to get their IP PIN letter online, but then they have to go through the process of setting up the account, but there is a way to get it, from the IRS, that method that I'm aware of.
Yeah, that's right. Tomer is correct. And in some cases, the person might already have an electronic IRS account. But I'm going to say something that I consider really sad. Um, the issue of identity theft is becoming apparently more prevalent. And what happened in the early days of this issue is the government, once someone has been identified as an identity theft victim, they will start this process of giving a PIN number to protect their identity when they file federal returns. It's gotten to the point now where the IRS will say to somebody, would you like an identity theft PIN number to protect yourself? In other words, even before the fact, even before somebody's been identified as an identity theft victim, the IRS is saying, would you like a PIN to protect yourself? And I think that's very sad. Anyway, income limits. Next question, are they meeting our income limits? In certain cases, we'll prepare a return of somebody who's exceeded the income limits and you need a manager sign off. Whether or not the returns are going to be e-filed. In some cases, some returns can't be e-filed, but you tick off yes or no. If it's going to be e-filed, we talked about identity and information from the ID cards in New York State. We need that information to really to protect them in terms of identity theft on the state level. We can still electronically prepare a return if we don't have that, but it's supposed to add that layer of protection. If somebody wants their refund directly deposited into a bank account, towards the bottom of page 1 on the left, excuse me, right, we're asking information about the bank account, its routing number, its account number, what bank it is, and what type of account it is. In some cases, they want their refund sent to them the old-fashioned way through a check. Page 2 of our 6-page checklist, towards the top there, this, excuse me, page 2 more or less is devoted to all income items, whether or not it's taxable. Towards the top there, as you can see, we're entering information on a very common form of income you're probably going to see at CTA, wages. So you're entering information per the W-2 forms. And as you can see, it's broken down between whether or not it's from the taxpayer, TP, or spouse, SP, if you're filing a married joint return. And we're giving reference numbers to certain boxes that are on the W-2. So it's essentially a copy job of some of the things you're seeing on the W-2, you're entering it here. And of course, we have more than one space to allow for people who have more than one job. Towards the right of the wage line, we're going to see wages of other states. So in other words, the person may have worked in Jersey but live in New York and vice versa. So withholdings of other states, we need to know that when we prepare the state return. And make sure, of course, I believe Thomas said this during his income lecture, make sure you're entering information from a W-2 for the 2024 tax year. Somebody might hand you a stack of W-2s. Make sure you're using 2024 W-2s. Person might want you to prepare a prior year return prior to 2024, making sure you have the right year. If the person has more than one W-2, or even to sum up what's listed on the top, you would transfer that information to the line that says total wages from above. You're entering the amount of wages and the withholdings, as you can see towards the top there. And then you're entering other types of income, tips, taxable interest, saving bonds, et cetera, et cetera, et cetera. So there's lines to enter that information on the boxes of page 2. And we've given you the source of a lot of these documents. For example, the IRA distributions from a 1099-R. So you're going to get that information from those sources. Make sure you're asking the taxpayer for everything on this checklist. For example, did this person have a bank account? For example, you're saying, do you have any taxable interest? They said, well, no, I don't have a bank account. And that makes sense. That's acceptable. If that's the case, tick off the box that says none. Okay. And that's true of other income sources. If you're asking the taxpayer that question and that person doesn't have it, tick off the box that says none. Why do we want that done? Because someone like me as a manager, if I review your work and you're not ticking off that box, that indicates to me that perhaps you didn't ask that person that question. So when I review your work, I might have to go back to the taxpayer and says, oh, by the way, I just want to clarify, did you have a bank account? Did you have unemployment compensation? Why am I asking that? Because it wasn't ticked off on your work. So you can avoid this double work by making sure you're asking this person for each and every income item that you see there. More or less towards the middle and bottom of the form, we're totaling up the income items and we're totaling up the withholding items. And the reason why we do that is it serves as a check between what you have on a checklist and what's going to be reported on return up to that point. Okay. Towards the bottom of page 2, we talk about other income sources that may be taxable. For example, the Social Security benefits. And Tomer talked about the Social Security rules. Part of it may be taxable to the extent of 50% or perhaps 85%, assuming certain thresholds are met. And so what we just need to know at this point is the total amount of Social Security received by the taxpayer. And we tell you the reference lines where you can find it. The 414H retirement contributions is really for New York. That's an add back and addition that Tomer talked about. Other taxable sources of income. We need to know this, even though it might not be put on a return, because as you can see, it's used for support, for determining dependency. You know, my pet topic. It's also used to determine household gross income for purposes of the real property tax credit. Okay. One thing, a couple of things I want to highlight towards the bottom. It says federal tax refunds and state or local tax refunds. If the person, if we prepared this person's tax return last year at CTA and that person has a return, we're going to ask them, oh, by the way, we prepared your return? Yes. Could you tell us what the refunds are? We would put that information on the return and we would ask the taxpayer, did you receive the amounts we calculated? Hopefully the answer is yes. In some cases, the answer is no. Because we prepared their return and because there might be a difference, we want to know why. Why didn't they give the refund we calculated? In some cases, it might be lower. In some cases, it might be higher. We still want to know why. Maybe it's because the person didn't tell us about income sources or things like that. It's worth investigating on our part if we prepared the return last year and if our bottom line numbers do not agree. Okay, page 3. Page 3, towards the top there, again, is worksheet, what's called worksheet A. And it more or less serves as a proof to what we're including on page 1 in terms of dependents. If you remember on page 1 of the checklist, we talked about dependents and whether or not they're QCs and QRs. Once again, my pet topic. We want to indicate on the top of this, these tests, the tests we talked about this morning about qualified children, qualifying residents. Do they meet all the tests we've talked about? So you put in the person's name. There's not really much of a space for a name, but somehow put it there and then ask whether or not, and tick off the boxes of whether or not they meet all the tests. This is your backup to your determination of whether or not certain people who live with the taxpayer are their dependents and whether or not they're QCs and QRs. Okay. Towards the middle and bottom of page 3, we talked about federal adjustments to income. Tomer talked about that. So whether or not the person's self-employed, whether or not the person has an early withdrawal penalty from the bank, whether or not the person made an IRA contribution, things like that for traditional IRA. On the right-hand side, it talks about withholdings from a W-2 for these pension contributions. We talked about the 401k plan that may have been administered from somebody's job or the 403 plan, et cetera. In some cases, that serves as a backup to the entries on the form for the retirement savers credit that's on the federal side. That information is put here. If you input it properly on tax layer program, it should calculate the right retirement savings contribution credit, assuming they're within the income, they're below the income phase out lines. Standard deduction towards the bottom there. Again, everybody has a standard deduction. It varies based on filing status. I will show you in a minute where you can get the standard deduction amounts. And again, it's one of the slides of the federal handout that Shelley showed you this morning. I'll show you another place to get it. What's being said here in this little calculation is you're comparing the standard deduction amount to the potential itemized deductions that are listed below. So we want you to go through this exercise. List the standard deduction based on what you believe this person's filing status is. Compare it to the itemized deductions you're entering below. And I talked to you about the various itemized deductions and just enter it there. One thing I want to highlight, it says when it comes to taxes, state and city withholdings, okay, where are you getting that number? Well, you're getting it from the W-2s themselves. Withholdings on the state and city side per the W-2s is a possible Schedule A item, a possible itemized deduction, subject to the SOL cap. We talked about the SOL cap being $10,000. That information on the withholdings you're getting from the sum of page 2 on the city and state withholding numbers. So don't neglect that. Don't neglect to put that information from page 2 of the total of the city and state withholdings here, okay? We talked about real estate taxes, interest, et cetera, et cetera. We do see some people, not a lot, itemize the deductions on the return. It happens. For example, last year, somebody was in the hospital and had a tremendous amount of medical bills. A lot of it, unfortunately, was not reimbursed through insurance. The person had a big doctor's bill, and it was for that reason that that person had to itemize. And we do know that if somebody itemizes, in other words, if their itemized deductions is more than the standard, then it helps them tax-wise. Okay, page 4. Page 4 is devoted solely to the topic of the earned income credit. And this whole page talks about that. The first part towards the top of page 4 talks about questions that are germane to all taxpayers. And as you can see, we have shaded boxes and we have boxes that are not shaded. So if you just read that, it says they're all shaded boxes below must be checked in order to continue. So in other words, they're meeting the criteria based on the responses to the questions there. And if all the shaded boxes are checked, then you go down to the bottom of page 4. And the bottom of page 4 talks about the earned income credit for people, Schedule C, who have qualifying children, and Worksheet D, who don't have qualifying children. So again, we know that single individuals may get the earned income credit. So concentrate your responses on Worksheet D for those types of taxpayers. If the people have, or taxpayers have qualifying children, answer the questions on Worksheet C. A special rule that you need to know, if you're preparing a 2021 return. Now, when it comes to prior year returns at CTA, we can go back 4 years. We can do a 2024 return, 23, 22, and 21. What I'm about to say right now pertains to the 2021 tax year. And that was one of the COVID years. And there was a special rule back in 2021 when it came to calculating the earned income credit. It said that in order to calculate the earned income credit back then, you can use the earned income credit from the 2019 tax year. So, excuse me, you can use the earned income from that year. Why is that important? Because during COVID, a lot of people lost their jobs, or they're part-timers, or they had problems getting work. And more or less 2019 was the last year before COVID really took effect. So the government granted those people a tax break in the form of using the 2019 earned income numbers to calculate the 2021 earned income credit. In some cases, they got an earned income credit, or they got a larger earned income credit as a result. So if you happen to be calculated a 2021 return, and you can do that, it is possible this year. Ask that person if that person has a 2019 return, whether or not the person worked in 2019. It might be advantageous for that person to bring in that return to help us and to help him or her. Okay, page 5. Page 5 is, for the most part, is devoted solely to the issue of the real property tax credit. And Tomer went over that. And if you remember some of the criteria we talked about and some of the question references, the question references are right here. Number 1, 2, and 3, etc., can be found on the slides in the New York outline. And for example, we've kind of structured this form in such a way that you don't have to go through the whole form. For example, the first question says, are you able to determine the total household gross income, which is taxable or non-taxable, of all members of the household, as well as the total rent paid? So for example, during the course of your interview with a taxpayer, the person says, oh, I live with my cousin. Says, oh, by the way, do you know what your cousin earned? What was his or her income? Person says, I don't know what it is, and that person probably won't tell me. Based on what I just said, then you'd have to answer question number 1 is no, you cannot determine household gross income. So look what it says there, where it says, please note, right next to question 1, it says, if no, stop here. Taxpayer is not eligible for the New York State real property tax credit. So I think that's a time saver. So if you hit no to that, there's no need for you to go to the rest of this part of the checklist. Another question here I want to highlight is question number 8. It says there, was the total household gross income, taxable or non-taxable, of all members of the household more than $18,000? Well, you can be preparing a tax return just for this one taxpayer, and that person's income is more than $18,000. If that's the case, then box 8, question 8 can be answered no. Yes, person had more than $18,000 of income. Tick off that box and you don't have to do anything else. That's a person. The way I review your returns is if I see that and you've done it that way, I accept what your determination, and then I can always prove that and check that when I review your work. That's a personal decision. If you deal with another manager, CTA, they may have another opinion about how to handle that. Okay, anyway, towards the bottom of that, it talks about how to enter rent and the number of rents that taxpayer paid. Okay, anyway, towards the bottom, on page 5, we talk about questions that are germane to state returns. We talked about the volunteer credits and whether or not the person worked in more than one state. And that question about the NYC 210, is that person being claimed or can, operative word being can, claimed as a dependent on someone else's return. The first question there says for New York State returns, we're talking about the issue of sales tax collected. And again, this was a big issue in the past when the internet was all the rage and people started buying goods through the internet. And in the early stages of these internet sales, the internet companies were not aware of their responsibilities of collecting sales taxes. They are now. So even though we have to answer the question, I think more and more companies are doing this. In other words, collect sales tax on these purchases that are subject to sales tax. So whether or not somebody still has to pay sales taxes on undeclared purchases or purchases that were sales tax was not collected, I don't think it's going to happen, but we still have to ask that question. Okay, page 6, the last page of the checklist. Towards the top there, we talked about the child care credits. In the middle there, we talked about the education credits. I talked to you about other criteria that has to be met for certain education credits. It is listed here. So we talked about the student being at least half-time for purposes of the American Opportunity Credit. We really didn't list it on the outline. It is listed here in the checklist. Believe it or not, for the American Opportunity Credit, we have to ask this question. And it says here, I believe it's question 5. Does the student have a felony drug conviction? We have to ask that question, believe it or not, guys. Okay, so take a look at the rest of that checklist there. If we're doing a return other than the current year, we're asking about the stimulus payments. It's particularly true of the 2021 tax year. There's still a chance, even now, 3 years after the fact, that some people have not gotten their stimulus payments and maybe they're entitled to them. We're going to try to fight and see if we can get it for them. So you'd only answer that part of the checklist if you're preparing a 2021 return. And then also the advance payments of the child tax credit that could happen again for 2021 return if you happen to be preparing that. Towards the bottom left, any return that you prepare and you have this checklist here, we want to see your name. We want to see who prepared this. And that way, when I review my work, and especially people who are doing work virtually, we need to know who to reach out to if we have questions on your work. You could be preparing the return and interviewing the return, but you don't not necessarily or inputting the information into our computer input system. So the person who performed the work, prepared this checklist, and the person who computer inputted the information may be different people. That's especially true of people who are working virtually. The right-hand side, we need to know about health insurance, and we talked about the issue of people getting health insurance through the exchange. That's how we use our checklist, and that can be found in the CTA forms folder. If we can go back to the CTA forms, Tom. So we don't have to call up the information per se. We talked about the relationship test for my pet topic. Summary sheets. I think it's important to open up the English version, Tom. Summary sheet English. So for every return, there it is. So every return we prepare, we give taxpayers this. It's a summary sheet of what we've done. It tells them what return we prepared and whether or not the person is getting a refund or whether or not they have to pay. And if that's the case, and we're filing paper returns, we've given you the addresses of where these returns are going to be mailed to. We have slots for federal, New York State, some Jersey returns, and other states other than Jersey or New York. We can prepare any state return, any state that has an income tax, and we have in the past. Towards the bottom there of that return, I just want to highlight the box that says storefront location. So storefront location is more or less a 2 or 3 letter designation on where the return was prepared. For example, I'm the Fountain House manager here, so I would see FH as Fountain House in terms of storefront location. Why is that important? Because if the taxpayer were to ever come back to us after the fact and says, I need help with my return, can you review it with me? Well, we need to know where the return was prepared. If we get this storefront location code from this person saying, oh, good, we'll look at the Fountain House returns and we can find it that way. So make sure you're entering the storefront location. I think virtual will probably have the letter V in it, okay? We have English and Spanish versions of this summary sheet for you. And it's, as you can see, it's in the CTA forms folder. What else is in here? Okay, let's look at quick reference. Okay, quick reference is a handy dandy guide to answering any questions you might have preparing your work. So for example, if you had a question about something, you can go to the training materials you've gotten today through our outlines. Or you can go to the notes that you've hopefully been writing throughout the day in terms of certain topics. Or you can go to your co-volunteer that you happen to be working with. Or you can go to the manager like myself and you can ask me your questions. Or you can go to what's called a quick reference. Quick reference, as you can see, is 10 pages long. We'll go over each page quickly. In the middle there, it talks about the standard deduction amount. And that's very important because you might get this question when you're preparing a return. Somebody might say, do I even have to file a return? And you can quickly answer the question by looking at this person's standard deduction amount. So for example, if the person's 65, under 65 and single, and he had taxable income of $14,600, he had more than an amount, he is required to file a return. He has less than that amount, he is not required to file a return. But you would still might be filing a return anyway, right? Because they might have some withholdings on a W-2 that he can get back. Or in some cases, we see it a lot here at Fountain House. Some people, even though they're not required to file a return, want a return filed. Why? Because they need it for housing purposes, because they're in low income housing and they need proof to the housing authorities that this is my income for this return, okay? As you can see, it varies based on filing status, but there's an exception to this rule, and you've heard that word exception, and here's an exception. What if you found out that you have somebody who's married filing separate in terms of the filing status? And that person says, do I have to file a return? Well, you wouldn't look at that person's standard deduction amount. You would say this, believe it or not, this is the rule. And I looked it up. If this married filing separate taxpayer has at least $5 in income, $5, that person is required to file a return. So, but married filing separates, that's their standard deduction. But again, do they have to file a return? Yes, if they have at least $5 in income. Okay, and what's going on here in terms of the standard deduction? It varies based on whether or not the person's over 65 and or blind. And as you can see, those amounts vary based on what I just said. Dependency exemptions, again, for the 2024 tax year, on the federal side, there's no dollar value of dependents. It doesn't offset the amounts, but again, we know the need to have dependents. On New York State, any dependent, in other words, someone other than the taxpayer, gets $1,000 dependent. It reduces New York State income to the extent of $1,000 per dependent. That's page 1 of the ready reference. Page 2, please, Tom. It's just a summary of interview tips to determine filing status. So it's Shelley's topic. In other words, these are some of the questions you need to know, or some of the rules that help you determine somebody's filing status. So take a look at that when you get a chance. Let's scroll down a little bit, Tom. Okay, I think it's self-explanatory. Next. Quick references, we're talking about whether or not, again, we're summarizing the test of head of household because again, it's not really clear cut. It's not really black or white. It could be based on whether or not the person's unmarried for tax purposes and whether or not the person has a qualifying child or qualifying relative. And we more or less summarize the rules for that. So if you have any questions about determining filing status, especially this gray area about head of household, review page 3 of our quick reference. Okay, Tom, let's keep going. Page 4, test for claimant a dependent, qualifying child, or qualifying relative. Again, my pet topic, we more or less summarize the rules there. And let's keep going. Okay. Page 5. Again, a very big topic we talked about this afternoon, the earned income credits. If you're not sure of the criteria for the earned income credit, we've summarized it here for you. Rules that apply to everybody. Rules if you have at least one qualifying child, if you don't have a qualifying child, and income limitations. Okay. I think that's okay on that, Tom. Let's keep going. 6, when it comes to the real property tax credit, we talked about whether or not the person lived in exempt housing. What do we mean by exempt housing? So in other words, the real property tax credit is based on property taxes paid. So when somebody is a renter and lives in a building, in theory, part of the rent that's being paid by a taxpayer goes to the landlord, and then the landlord pays part of that amount to the taxing authorities in the form of property taxes. But in theory, the renters, in effect, pay property taxes. So you are entitled to the real property tax credit. But what if you live in a building that is exempt from property taxes? You wouldn't get the real property tax credit. That is true, again, what Tomer said about NYCHA buildings, and we talked about nursing homes. Well, what if you're not sure of the status of the building you live in? What if you're not sure whether or not your building is exempt? Well, we've done what's called the address locator. We more or less reviewed the website that New York City has. And if you follow the steps here, you can more or less determine whether or not the building that taxpayer lives in is exempt from property taxes. It varies each year. It's kind of tricky sometimes, this website. I did my little research. I came up with these steps and it worked at the time I used it, but they're always updating this website. So I'd say it's homework. If you wanted to do it for the building you live in, see what happens. So that's your homework if you want to do this. Open the computer, go through those steps and see whether or not your building is an exempt property, if you want to do that. Anyway, page 7, please. Okay, page 7 talks about the education credits. More or less, page 7 summarizes the questions that you see on page 6 of our checklist. But again, it's here a little bit more in depth in terms of the criteria for the American Opportunity, lifetime learning. It's more or less summarized on this page. We had it on our outline. We had it on page 6 of the checklist, and it's more or less summarized here. So you can look at that. Okay, Tom. Towards the bottom of page 7, we talked about the New York State version of these credits, whether or not you can take it as a credit or an itemized deduction. So just take a look at that, right? Page 8 and 9 talks about interviewing tips. We really haven't talked about it, but we're going to talk about it now. We've given you, and we did the best we can, we believe, to give you everything you need to know about taxes, about tax rules, numbers you need to know, how to prepare a return. What we really haven't talked about until now is how to interview somebody. Because in the next week or two, you're going to be meeting people, strangers, probably for the first time, and you're going to be asking questions of really, frankly, a personal nature. Where do they live? What is their marital status? Can you file a return with your spouse? What children do you have? Where do your children live? What are your income numbers? Some things that perhaps they won't even talk about with other family members. But we're not being nosy. We need to do this in order to prepare a complete and accurate return. So what we have on pages 8 and 9 are steps in interviewing taxpayer. Just take a look at that. That'll help you, guide you through the process of interviewing somebody and entering information on our checklist. So take a look at that. And then page 10 talks about the issue of identity theft. Unfortunately, I mentioned this before. Excuse me. Identity theft is a growing issue. And if somebody believes they're an identity theft victim, we talked about the steps involved in order to help them. And this page really is for that. If somebody believes they're an identity theft victim and that believes that it's going to affect them financially, we can give them some information that's listed on this form, excuse me, this page that can help them. In other words, they can monitor their credits reports by looking at certain credit reporting bureaus, following the steps that are listed there, and they can get free information about themselves if they believe they're an identity theft victim. We talked about the issue of personal identification numbers, PINs. So if somebody has been an identity theft victim, and if we're doing a return from the prior year, hopefully there's a notation in our folder about this. We talked about the sad issue about somebody opting to get a PIN number voluntarily. So you can review this page and give advice in terms of how to handle this issue. Okay, so that is the quick reference. And again, we have all of these tools we've given you in this CTA toolbox of ours. Hopefully it will help you in terms of fleshing out some of the things we've been talking about all day, and it'll help you once you're in the storefronts or once you help us virtually. Okay, so we're really more or less towards the end, but there's one or two more things we do have to talk about. And Tom, you have to stop sharing because what I'm about to show them I have and you don't have. And let me see if I can get that. So if you can stop your share and I have to share something on my side. Let's see if I can get this. Where are we? Here we are. Okay, here we go. So somebody asked this question about well, first of all, in terms of VITA, we are not a VITA site. We don't do things the way VITA does it. Again, the objective of groups such as ours and groups such as the VITA program is we prepare returns for taxpayers. That's what we're doing. We do it our way, VITA does it their way. So when it comes to tests, somebody said, are we going to have a test? So let's see if I call up something for you to answer that person's question. Where is it? Where is it? Hold on one second. We're gonna go here. Let's see if we can do this. Where is it? Hold on one second. I'm gonna try to find something to help you out. And we're going to do this. And we're gonna do that. And we're gonna see if I can pull it up right now for you guys. And going to here, and yes. So guess what, guys? We wouldn't want you to get away without taking our pop quiz. So we've developed this quiz based on everything that's been taught to you today. It's our Baker's Dozen. In other words, we have 13 questions based on all the topics that have been given to you today. There are no pass or fail grades. It's just a matter of you or us highlighting certain issues that we think you need to know. You guys don't have this anywhere in any of the folders. I will give you this pop quiz at the end of our lecture. I'll send it to you through an email, or I'll give it to Tom and he'll give it to you guys. Okay, so I'm about to give you all of these questions, and hopefully it's a little bit fun in nature. Just indicate your responses to the following questions in the chat and we'll go over it. And there's no right or wrong answers. We just want to give you like help in terms of reinforcing certain concepts that we want you to know. So here we go. Question 1 says here, which of the following reduces the amount of taxes due? Take a look at that question. It's an open book test. We want to review your materials and indicate your answer to that question in the chat. We'll look at the chat. We give you a minute or two. Okay. Okay. So I know some people have responded. again, respond, guys. Either way, it just helps you reinforce the topic. So I do see that. I haven't fooled anybody. The answer is D. The answer is all of the above. And you can get the answer to this question by looking at our basic outline, slides 7 and 8. And if you remember this morning when we talked about the math behind the return, once you get tax calculated, you can reduce that bill by withholding taxes, by refundable credits, and by non-refundable credits. So all those items, A, B, and C, reduces the amount of taxes due. Some cases you might get a refund, some cases you might, but they all reduce the amount. So the answer to this first question is D. Okay, let's go to question number 2. And here are we there? Yes, the checklist you are reviewing shows that Joe is 35 years old and has 20,000 in wages. He has a child who does not live with him. Joe is not married. What is Joe's filing status? Read the question and let's see what you have in the chat. And okay. Thank you. Okay. Okay, I got more or less an idea of what you guys have responded to. I'm going to say this is a somewhat trick question. The answer is E. It's a question mark. Because based on the facts here, you need to know certain things about Joe, in particular, his child. Correct? Again, getting back to my pet topic, could Joe's child be a dependent of Joe? Yeah, from a couple of ways, whether or not the person meets the qualifying relative test, not qualifying child, because qualifying child had to live with the taxpayer at least half of the year, right? Did Joe contribute at least 10% to the total child support? You might have to fill out a multiple support agreement, 2120, right? So the answer is not really clear cut, and I kind of apologize for not giving you a clear answer. It is not A, B, C, or D. It could be A, but the wild card in this is Joe's child and how you should think about Joe's child. It could help him, right? So the answer is E. And the question is, really look into the issue of the child. It could affect his filing status. Okay. Let's see. Let's just look at the chat before we'll go on. So it says, what question should we ask of Joe to further clarify? And again, the issue about whether or not someone else is claiming the child, whether or not Joe provided at least 10% to the total person support. So again, you might need, again, the multiple support agreement, things like that. And what about the child's mother? What's happening there too? Okay. All right. Next, question 3. No more tricks, I think. Question 3, which of the following income items is not earned income? We'll take a look at the chat. Okay, so I got a good series of responses. The answer is B, unemployment compensation. Somebody thought that perhaps C is the answer. Well, it's not. Even though it hasn't been reported anywhere on the return, and you are supposed to pick up tip income that hasn't been declared by the barber. You also see it's true of waiters and waitresses who live on tips in addition to their wages that they receive. In some cases, they might have not declared certain tips that their employer doesn't know, and they're responsible for paying FICA taxes on these undeclared tips. We have a taxpayer at Fountain House who worked as a delivery person for one of those delivery companies. He receives a lot of tip income. Some of it was reported on his W-2, some of it was not. He had to pay Social Security taxes on his undeclared tips.
So tip income is earned income. And that's important because C, in addition to the earnings on my schedule C, is earned income for subject to the earned income tax credit. B, unemployment is not. It's not earned income. So the answer is B. It is not earned income. Question number 4. Your taxpayer Fred was born on February 27, 1953. His W-2 form shows wages of $13,000 and federal withholding of $500. This is his only source of income. He is not dependent of another person and his filing status is single. Is Fred required to file a tax return? And what's your answers? Hmm. Okay, so the answers are really across the board, but most of you got it. The answer is D. Okay, and before we explain why D is the right one, let's look at the question itself. We're really highlighting the word required. As you can see, it's underlined. Is he required to file a return? Okay, and in order to answer this question, we just looked at the ready reference, page 1. So Fred was born in 1953. That makes him over 65, right? So you look for the standard deduction of somebody over 65, and his number of $13,000 is under that limit. So he's not required to file a return. That's what the question says. Is he required to file a return? So the answer to this question, the way it's written, is D, no, because he's over 65. A is incorrect. He has income, but is he required to file a return? Well, based on that number we saw, the answer is no. And yes, is he, because he's over 65? No, the answer is no, right? Because of that income limit. Yes, because he filed a New York State return. But the question is asking about a federal return, not a New York State return. Okay. So it's a little bit tricky the way those choices are written. So the answer is D. He is not required to file a return because he's over 65 and his standard deduction is above that $13,000 figure. Once again, look at the ready reference, page 1. But I have another question for you, which is not really listed here. And I'm going to look at the chat. So the question is, he's not required to file a return. Question is, should he file a return? Let's see what the chat says. Okay. Okay. Yeah, the answer is yes. We would suggest to this person to file a return. And even though nobody wrote it in the chat, the answer is that $500 of withholdings. There's probably no tax bill if he were file a return, but we would suggest him to file a return so he can get back $500 of withholdings that is his and not the government's. Okay, so let's think about that next question about it's not required, but should he? And in this case, yeah, why not? Let him get $500. Okay, 5. Fill in the blanks. If a taxpayer's blank deductions are greater than his or her standard deduction amount, then he or she should blank. What's the answer? Let's look at the chat. Okay. Okay. Okay, no fooling you guys here. The answer, of course, is A. And we talked about whether or not you should itemize or use a standard. And again, you would only itemize if those deductions are greater than his or her standard deduction. So the answer is A. You can review the basic outline slide 38 for the answer to that one. Let us go to question number 7. Excuse me. Your taxpayer was born on January 25th. Today. Happy birthday, taxpayer. Mock taxpayer was born today on 2002. The taxpayer income consists of the following: interest income of $500, W-2 income of $15,000. She is single and does not have a qualifying child. Based on these facts, does the taxpayer qualify for the 2024 earned income credit? What is your answer? Let's look at the chat. Okay. Okay. Once again, a lot of the answers are across the board, but a lot of people got the right answer, and which is C. Does this person qualify for the earned income credit? No, because the taxpayer doesn't meet the age limit. The person was born in 2002, which makes her at the end of 2024, 22 years old. So even though she doesn't have a qualifying child and she meets the income limit, she doesn't meet the age limit. She's not at least 25 years old. So unfortunately, she doesn't get the earned income credit because she's not old enough. She doesn't meet the age limit. So the answer is C. Look at the basic handout, slide number 50, and you can see the answer to that. We also tell the person, come back in 3 years and you might get that credit. Okay. Number 7, question 7. Let's go there. Let's try to go there. Okay. Your taxpayer, Andrew, 48 years old, has a son named Charles, 17 years old, whom he is claiming as a dependent on both his federal and New York State returns. Based on these facts, what is the dollar value of the taxpayer's exemption on his federal return? What is the answer? Okay. 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 Again, everyone got it right, which is A. When we're doing a federal return and we're talking about a dependent, someone other than a taxpayer, there is no dollar value to the dependents. But it's important to find out whether or not a person is a dependent for all those tax attributes we talked about before. So on a federal return, Andrew claiming his son Charles yields no dollar value amount as a reduction for dependency. Look at slide 22 of the basic handout to answer that question. Let's go to the next one and let's see what that looks like. Gee, it looks like the same question as before. Your taxpayer, Andrew, has a son named Charles, whom he's claiming as a dependent on both his federal and state returns. Based on these facts, what is the dollar value of the taxpayer's exemptions on his New York State return? A little bit different, right? What's the answer? Okay. Okay. You guys are on the ball. That's right. The answer is B, $1,000. So we know there is a difference between the federal return and the New York return. Dollar values of exemptions on the federal return, 0. New York, $1,000 per dependent, or $1,000 in this case. Look at the ready reference, page 1, summarized there, and or our New York State outline slide number 8 for the answer to that question. Okay. Let us go to the next one. And where is it? It is right here. Which of the following credits can be refundable? What is the answer? Okay. Okay. The answer to this question is A, the American Opportunity Credit. B is a credit, but it's non-refundable. C is a credit, it's non-refundable. D, on the New York State side, is non-refundable. So for a process of elimination, it is A. But when we talked about A, if you remember, slide 40 of the basic outline, we said part of it is refundable. So the answer is it can be refundable, but not all of it, to the extent of 40% of the unused amount. So in order to answer this question, look at the basic handout slide 40, and for the answer to the New York State household credit, look at slide 9 of the New York State outline. Okay, let us go to the next question. Your taxpayer, Edward, is 58 years old. He worked as a delivery driver for Amazon and retired in June 2024. He received $27,000 in pension income during 2024. How much of this income is excluded on Edward's New York return? What is the answer? Okay, the majority of the people had the correct answer, and that answer is none. D, none. I've seen some people who listed the total amount 27,000, and some people listed B 20,000. And let me tell you why A is wrong. Well, we know that that person worked for Amazon, right? And he's 58 years old. Amazon is a private company, so he meets the rules of whether or not the person's 59 and a half. So his income would be subject to $20,000 exclusion, but he's not 59 and a half yet. Okay. And he worked for a private company as opposed to a state agency. So A cannot be the right answer. B is not the right answer. Again, the $20,000 exclusion, because once again, Edward, our taxpayer here, is not 59 and a half years old yet. So he's 58 and he retired. So all of his pension income is included, which means none of it is excluded. So the answer to this question is D, 0. And you can find the answer to that on our New York State outline slide number 5. Okay, got about 3 questions left. Question 11. Your taxpayer Barbara would like to fill out Form 214. You know what 214 is. Her sources of income are wages, interest income, food stamps, public assistance, and unemployment compensation. She lives alone. For purposes of filing this form, what is Barbara's household gross income? Let's see what you got. Okay. Okay, I don't see anybody yet, so just of course, it's a number crunching exercise. Just tell me what you think the number should be. Okay, just wait a little bit. I don't see any responses to this one yet. Okay, nobody has answered.
Yeah, most have answered B.
Oh, is that? No, I thought that was the previous question.
Nope,
Is that
they're
right?
answering it now
Yeah.
as B for the most part. Some A's and
Well,
whatever
yeah, I don't see anything here. Well,
in the chat.
yeah, I'm in the chat. Yeah, I don't see anybody responding. Anyway.
Yeah, I see.
Okay, Tomer sees them, and the answer to this question is B. So really, the gist of the question is what makes up household gross income? And if you remember Tomer's presentation, you do not include food stamps, right? Never include food stamps. Everything else that's listed here, even public assistance, which is not taxable, because Tomer said that when you talk about household gross income, you have to talk about taxable and non-taxable sources of income. So if you take all the other income amounts that you see here, other than food stamps, and you add it together, you will come up with $17,200. And that is answer B.
And the only comment that some people had is they were confused why the public assistance says received by Bruce. They're like, who's Bruce?
Oh, I'm sorry. Sorry, that's a typo. That should have been Barber. I'm so sorry about that. So now I know why you didn't answer it. That should be Barber. I'm so sorry. So it could see received by Barber. So I apologize for that. I mixed up on that, so I apologize. So it should see received by Barbara. I'm sorry. But once you make that little change, you add everything else, received by Barbara, and it comes to $17,200. Okay. So if that's the case, the person meets the household gross income test because those amounts in total are less than $18,000. Go to the New York State outline slide 16. Once again, apologize for Bruce and Barbara. Anyway, question number 12. Your taxpayer Eddie states that he lives with his brother George. George has already filed his 2024 tax returns and did not claim Eddie as a dependent, although he could have. Eddie receives Social Security benefits totaling $5,000. Eddie wants you to prepare Form NYC 10 New York City school tax credit for him. Can you do so? That should be, can you do so? Not so, do so. So, sorry guys, another typo. Can you do so? So what is your answer? Yes or no? Okay. Okay, the majority of the people I'm seeing here got the right answer, and the answer is no. Some people said yes, but remember what we said when it comes to the criteria for the NYC 210, it really boils down to two questions. Did the taxpayer live in New York City the whole year? Even though if the taxpayer didn't live in New York City for a whole year, that credit can be prorated based on the months he or she lived in New York City. But the second one is the trickier one. And that second criteria is can, with the emphasis on the word can. Can this person be claimed as a dependent by someone else? Based on this question, George could have claimed Eddie as a dependent, but he didn't. He can claim him, but he didn't. And it's because of that reason that Eddie doesn't qualify for this credit because he could have been claimed as a dependent by someone else, namely his brother. So the answer to this question is no. And just review the New York State outline slide number 11. The last of our Baker's dozen questions is coming up. And here it is. Community tax aid. What is the answer to this one? Okay, I'm very happy that, first of all, there's no typos in this question, apparently, but you all got it right, and that makes me happy. And of course, community tax aid is all of the above. We don't charge a fee for what we do. We are a not-for-profit, and we are the country's oldest volunteer tax preparation group. It is all of the above, I'm very proud to say. I'll go to the basic outline slide number 3. That concludes, everybody, our day. I thank you so much for being part of today's tax training session. Once again, as a reminder, next week, we have another mandatory class on our computer program and the virtual tax preparation process. It is next week, a Zoom meeting from 9 to 1 o'clock, not a full day session, but it is mandatory. Some people said they cannot make it. So hopefully you can follow us by looking at the recording that's going to be made a couple of days after that training. And then we'll talk about the next training class, the volunteer forum. We talked about that before. Once again, thank you so much for being part of CTA this season. Good health and good taxes. Just a housekeeping points. If you have not made a determination of whether or not you want to be at one of our storefronts, I think it was on the application form, or if not, let us know about it. Send us an email once you get your CTA emails. going to start compiling lists of whether or not you're going to be with us virtually or with us at one of our storefronts. I suggest perhaps, for the early weeks, maybe work at a storefront. And then if you want to work virtually, you've had that experience about working with somebody side by side, face to face. Maybe that'll help you in terms of your experience with us. Or maybe you want to be with us all season preparing tax returns at a storefront. You're more than welcome to do that. You're more than welcome to be part of our virtual crew as well. Once again, guys, thank you so much. Enjoy the rest of your day. Enjoy the rest of the weekend. And I will see you virtually next week. I'll stay on the chat a little bit to answer some of your questions. Bye-bye.